welcome to CPI. I hope everyone's doing good. Now, this is the introduction video of this coaching program, and you should make sure to watch this video completely because in this video I'm going to tell you about everything about CPI and its format and how am I going to be actually coaching you and how you're going to be learning from me. Now, as I said before, this coaching program is going to be 6 months long. And throughout these months, I'm going to make sure to improve and strengthen every single aspect of your trading, whether it's the technical part, whether it's related to your execution, trade management, or risk management. Everything is going to be covered in CPI, and I'm going to coach you about everything. Now, another important thing about CPI is that it's not actually a course, it's a coaching program. It's not a course. I could have easily recorded some videos and made it into a course and sold it to you, and I wouldn't have to do anything else, and it would have been so much easier for me not to carry all of this burden of breaking down my trades with you every single week and sharing my weekly market outlooks with you, right? It would have been so much easier for me. But that's not my goal and not my objective with this project in CPI. I actually wanted to offer you something that could actually guide you towards the right path and the correct path, right? That's why I decided in CPI, I'm going to break down my trades with you. I'm going to share my weekly market outlooks at the start of each week. So you could actually see how am I looking at the markets with the CRT and Turtle Soup perspective, right? That's exactly why most of you are here for. And I'm going to make sure that that's the exact goal of CPI, and at the end of this coaching program you have a complete idea of how you're gonna actually do your top-down analysis and take trades with CRT and Tata Soap, right? Also, I'm going to have a monthly Q&A session where you could actually ask me any question and I'd make sure to answer them. And there'll also be weekly chapters in which I will explain everything from A to Z. Now, the main difference between CPI and all of these other courses online is that in CPI, not only I'm going to explain everything to you based on current week's price action and on a weekly basis, but I'm also providing with trade breakdowns and market outlooks so you could actually see what goes behind analyzing these higher time frames and taking these lower time frame entries, right? Unlike these thousands of courses online. I know that almost all of you have watched tens if not hundreds of courses online, but they didn't help you because they just provide you with a few pre-recorded videos on old price action and explain everything in an unorganized and random way instead of explaining them in like a syllabus sort of format from A to Z, just like I've planned it out, right? They also don't break down any trades with you or provide you with any sort of like market outlooks or anything, so you could actually see how it's applied in the real markets. The way how you actually learn is by looking at someone that has already done it and looking at them apply it in the real markets, right? That's how you learn, and that's how proper learning works, not just by watching a few videos on a certain topic. So and that's the goal of CPI. Now obviously you aren't gonna learn all of this in just a month, right? Because it doesn't work like that. It's gonna take at least 6 months for you, if you have an average IQ and intelligence, for you to grasp on all of this knowledge and become an independent and profitable trader, right? Now I'm sure most of you probably already know how coaching works, but let me give you a small overview of it. So basically the way how coaching works is that we start right with the basics, right from the fundamentals, and then brick by brick we build our basics and fundamentals and our understanding of the markets, and then we move on to other phases and we develop each month together as a team, right? Now, one thing about coaching is that you either start with your coach, your mentor, right from the inception and right from the beginning of that program, right? And then he's gonna build your understanding of the markets and build every single aspect of your trading, your basics, your fundamentals, and then your advanced learning, because that's how proper teaching works and that's how proper learning works. Now, you can't just join a coaching program or a mentorship right in the middle of it, right? Because the goal is to build your whole understanding of the markets and build every single aspect of your trading from a single source and from a single coach or mentor, and not multiple sources, because that's going to create noise and you'll be confused. If you obtain information about a single topic or a single thing from multiple sources, then you know what's gonna happen. Every one of them is gonna have their own subconscious biases. One of them is gonna have their own agendas, and then they're gonna explain that particular topic in different ways, and then you'd be confused and you wouldn't know who to actually believe and what is actually the correct way of learning it and understanding it. That's why for CPI, I'm only accepting students at the first month of this coaching program, and that's it. Because I don't want to enroll anyone that's gonna join later and not understand the basics the way how I've taught it, right? In this coaching program. So moving on to the next month, every month will be a further explanation in detail of these past months, and they'll all be related to each other, and we'll be using them together cohesively as we build our understanding of the markets. Now, what that means is if you build your basics and your fundamental understanding of trading in one place, and then you build your advanced learning in another place, then you'll never make it and you'll never be profitable, because you'd have different ideas about a single topic, and then that's gonna create subconscious and conscious confusion in your mind, right? So, what you want to do and what the solution for this problem is that you would want to build your basic understanding, your fundamental understanding, and then your advanced learning from a single coach, a single mentor, and a single source, right? Now, obviously, if you're willing to give it the time and energy it deserves and willing to continue, then these first batch of students, you guys will have the opportunity to pay for the upcoming month's coaching, right? And continue. And if you want to leave and miss the opportunity and you weren't satisfied, which is not going to be the case for most of you, then the door is open for you. Now, this whole coaching program will be completely raw, unfiltered, and uncensored. There would be no production, there would be no editing or anything, right? Everything will be raw and explained on the charts on your favorite asset classes. So for that, I've chosen Euro, Dollar, and the S&P 500, right? So everything will be explained on the charts. I will break down my trades, all of them on the charts. There would be no production or no editing. I would explain everything in a raw and detailed manner, right? And these videos gonna be long, these videos gonna be boring, and that's exactly how they're meant to be, right? Now, here is the list of things that I'm gonna provide you each month, right? Now, obviously, my goal with CPI is to build your whole understanding of the markets from A to Z, and in order to do that, I'm going to provide you with weekly chapters in an organized and proper manner, right? I've already laid out the plan, so you don't have to worry about that. I'm also going to provide you with trade breakdowns each week of the trades that I take. Is going to contain both wins and losses, so you can actually see what goes behind taking these trades and what was my thought process behind taking those trades, right? I'm also going to provide you with market outlooks at the start of each week, and then at the end of the week I'm going to provide you a trade recaps of the trades that you could have taken and that you could have journaled and practiced, right? And then I'm also going to provide you with a monthly Q&A session where you can ask me anything about trading, and I'd make sure to answer it to you, and you could clear your confusion and that monthly Q&A session. Now, uh, now along with all of those things and carrying all of that burden, I'm also going to make sure to provide you with at least a few lateral signals throughout the month. Now, these are going to be a few signals, but they're going to be of high probability and high quality ones, right? Now, I'm going to provide you these signals on my own record and on my own terms, right? I'm not going to force them. If they are available and present and I'm pretty sure in them, then I'm going to provide. Now, Here is the list of things that I'm going to guide you on and teach you in CPI throughout these 6 months. Now, these are some of the things that everyone talks about and everyone brags about how important they are and how you should be using them in your trading to develop your understanding of the markets. But no one actually teaches them, right? Everyone talks about it, but no one actually tells how it's done, how it's correctly done. And that's going to be my goal with CPI, so you understand everything about time and price, how top-down analysis is done, how you're going to take your entry, and I'm going to give you a proper entry system that I use on my own that consists of top-down analysis and that uses time and price guidance, right? I'm going to tell you how you're going to be finding trades, how you're going to be finding your entry setups, and what's going to be your thought process behind them. I'm going to tell you about my execution, how they're done, and how do I manage my emotions throughout the trade and how I manage my trade. I'm going to tell you about my risk management plan for these problem challenges and even personal accounts. I'm going to tell you about journaling, which is the most important thing, and how you're going to do your journaling, where are you going to do this journaling, and what's the format of it is going to be, right? I'm going to teach you about everything. I'm going to teach you about back testing, and at the end we're going to combine it all to make you and to develop you into a profitable and an independent trader, right? Then you wouldn't have to worry about anything. Everything is gonna be covered in CPI. And CPI, I'm not just gonna explain about CRT and how you could select your CRT correctly, right? That's not the goal of CPI. Now that's going to be an important aspect of CPI, right? There's going to be the predominant theme of CPI, but that's not it, because I know trading isn't just about technicals. It's about all of these things and knowing how time and price works, how you're going to do your top down analysis, how you're going to find your entries, your execution, everything, right? So trading is a mix of all of these things and not just a single aspect, right? And the most important thing is to build each one of these aspects from a single source. If you're going to build your understanding of time and price from one person and then find your entry system from another person and learn about journaling from another person, then that's not a proper way and you're never gonna make it through that. Because I've been through these stages and I wish I had something like CPI. So you guys are really fortunate and lucky to have CPI and someone that is going to teach you about every single aspect of your trading in a proper organized manner, and I have already laid out a perfect plan for you, and at the end of these 6 months I can assure you that you'd end up being an independent trader only if you spend and if you give it the time and energy it deserves and it needs.
Hey, before we proceed, a quick word from the sponsor of today's video, SilkRoad5.com. Big thanks to them for supporting the channel. SilkRoad5.com is an international online marketplace where you can buy and sell both new and used items, or even offer services from anywhere in the world. It's like having a global garage sale and freelance market all in one place. If you've got something lying around that you're not using, maybe an old phone, camera, or even handmade crafts, you can list it in just a few clicks. Or if you've got skills like design, writing, or tutoring, you can offer services and reach clients from any country. What I really like is how easy it is to search by country, category, or price. Whether you're a buyer or seller, everything is smooth and super accessible. Silk Road also has a forum or a discussion board where you can share your experience about vendors or engage in discussion with fellow buyers and vendors openly. So if you're looking to earn a little extra, declutter, or find a great deal, check out SilkRoad5.com. Again, huge thanks to them for sponsoring this video and supporting the channel. Hit the link below or head over to SilkRoad5.com and start trading with the world.
Hi, welcome everyone to the first trade breakdown of CPI of week 1. Now, my objective and my goal with this trade breakdown is to make sure that I explain my thought process behind taking these trades and what actually went behind generating this idea on the higher time frame, and how I actually executed the trade and how did I actually manage it, right? Now, you may have watched tens of courses online, but those courses didn't help you and didn't made you reach profitability, because in those mentorships and those courses, what those guys do is they just teach you about theory and teach you technical knowledge without showing you how you can apply that knowledge and that theory in live markets, and how you can generate trade ideas through that knowledge, right? Now, is going to be completely different right here in CPI, and I'm going to make sure that I give you enough and adequate amount of trade breakdowns and trade recaps and trade signals even, so that you could actually see how am I using this CRT knowledge and this turtle soup and time and price knowledge to farm trade ideas on my own, and then you can compare it with your trade ideas and then see whether you are improving or not, and you can reverse engineer it on and back test it yourself, and then you're going to reach a certain point where you're going to be able to replicate this knowledge on your own, and you're going to reach a point of optimal performance where you're going to be able to form trade ideas on your own, and you're going to be able to execute them, which is obviously going to lead you to profitability and success, right? Now, today is Tuesday, right? And so first of all, we are intraday traders, right? Most of us, if not all, are intraday traders, and our job as intraday trader is to exploit the daily range, right? To exploit the daily range and exploit a 4-hour CRT. So our job is intraday traders is to exploit the daily range, not the weekly range, not the monthly range, but just the daily range and a 4-hour CRT, which we are going to use to farm and frame our trade idea and trade setup, and that is going to give us our stop loss, our entries, and our targets, right? Now I'm going to teach you all of them in CPI, but this is basically just an introduction to it and an overview to it of how and of what you can expect from CPI, right? Now, first of all, we're going to start off with the weekly time frame. Now, the most important time frame for us intraday traders are the daily, the 4-hour, and the 15-minute time frame, right? And this is being found through time frame alignment, right? It's time frame alignments which tells us what are the optimal time frames for intraday traders. And for us, it's the daily, the 4-hour, and the 15-minute. The daily is going to be used to find drawn liquidity and a certain buys, and the 4-hour is going to be used to find a CRT, right, during the day, which we can use to frame our trade setup on the 15-minute, which is going to be our entry time frame, and then we're going to execute that setup on the 15-minute, and that is going to give us our stop loss, entries, and targets, right? Now on the weekly, right here you can see that we had this CRT right here. Now on Twitter I had given this trade signal in live call right here, and as soon as price took out this CRT low right here and then it closed above, starting from this week I was expecting price to take out this range high right here, and then price took out this range high and it formed another CRT, and price took the CRT high and then it expanded lower, right? Now we are currently right here, and right here you can see that we have this big bulky candle right here, and we can actually treat this as a CRT, but we're not going to anticipate or expect it to be a CRT right away. We're going to need a certain context and narrative before we confirm this as our CRT, and I'm going to show you how you're going to do it. If we go to the monthly time frame, then you can see that we have this discount rejection block right here, and on the weekly you can see that this big bulky candle, right, and this CRT, this potential CRT, right, close just above this rejection block. Now the way how we're going to expect this CRT to be an actual CRT is if we expect price to come down lower, test this monthly higher time frame rejection block, a discount rejection block here, right? And price to take out this CRT low, and then we can have a reaction from here, and then this reaction can either be till this 50% of the CRT, and then the opposing end of the CRT. Now we're not going to expect it right away, but instead we're going to just expect either a retracement profile or reversal profile. Now market profiles are really important if you want to learn CRT and turtle soup to its max, right? And in this weekend chapter, I'm going to explain market profiles to you in the most refined, accurate and precise way possible, and after watching that video with multiple examples, you'll never need anything to understand market profiles. You will completely get the idea of how market profiles work, and how you can actually combine it with other concepts and other key levels and other PDAs, etc., to form and generate trade ideas, and how you can use market profiles as filters to avoid bad market conditions, right? Now, as I said, we're going to first of all expect this CRT low to be taken, and then we're going down to the lower time frame, and then based off of the price action on the lower time frame, we are going to decide either we want to treat this candle as a CRT or not, right? Now we actually haven't done it yet, so we are going to go down to the daily time frame and see how price action is forming there, right? Now I'm going to do this right here, so you can see the 50% of this range right here, and on the lower time frames, right? Now on the lower time frame, this is that big bulky candle which can be potentially treated as a weekly CRT. Now this is the 50% of that range. Now obviously, first of all, I'm expecting this low to be taken and price to react off of this rejection block and test this rejection block, and then we can expect a reaction from here towards this 50% of the range, or the 25% of the range, or maybe potentially towards this opposing end of the range, right? But it's all going to be done through confirmation on the lower time frame, right? Even if we take out this low and we have a reaction even till the 25% of the range, it's more than enough range, right? If I measure this range right here, you can see that it's almost 60 pips, so you can see that it's more than enough amount of pips, or adequate amount of pips, to offer you a trade idea or a potential trade idea on the lower time frame, and you can actually be profitable from that reaction, and you would have made money, right? Now our job as a trader is to accept losses and accept the fact that losses are inevitable. So when you are trading turtle soup and CRT, you should accept this fact, you should accept this harsh and bitter truth that you're gonna have your losses. You're gonna have times where a CRT won't work and you're gonna have losses, right? And there's going to be times where you're going to earn a lot of money, and then there's going to be a balance of both. There's going to be a balance of wins and losses, and you would want to have a higher risk to reward ratio. That way at the end of each month, you would make sure that you always end the month in green and be profitable and earn money, right? Now, so here now I've already explained what happened on the weekly. Now we're going to refine that on the daily time frame, right? I'm going to, okay, it can stay. Now you can see right here that we have this candle right here as well on the daily time frame, right? Right, and we have also this order block. Now as I'm expecting price to first of all take this low right here, this weekly low right here, so to frame that on the daily time frame, I was expecting this daily high to be taken, right? This Friday's daily high to be taken, and then price to react from here, and then potentially come down lower, or either to test this rejection block and then potentially expands either from here or from here, right? That was my buys. So when candle opened right here, my buys for the day, for the session, was first of all price to take out this high, right? Now if we go down to the 4-hour time frame, on the 4-hour time frame, we're going to see that it was also in the form of this range high right here, right? It was in the form of this range high right here, and you can see this is the 50% of that weekly candle with that weekly potential CRT, right? Now we all know that there are 6 4-hour candles in a daily candle, right? And our job as a trader is to select and find a CRT on the 4-hour and then frame a trade idea off of that CRT on the 15-minute, right? Now if you know about TSQ or the sequence, then you would know that when we have a certain range such as right here, right, let's say we have this range right here, and then we reverse from here, and this is, let's just say, our drawn liquidity. Then first of all we have model 1 entry, right? Then price reacts from here, and then it has a turtle soup here, and then before it takes out this high, what happens is that price stops right here and then retrace it, and then has another turtle soup before taking out this high. This is what we call a KOD. Now right here you can see that before we took out this daily candles high right here and this range high in the 4-hour, we stopped and came down lower before we actually took out this high, right? So when on Tuesday I was expecting this high to be taken, right? And I only take trades during a certain time of the day, and that time is during the London open kill zone and the New York open kill zone and the London lunch and the London close kill zone. I avoid taking entries during the Asian range and the CBDR, the central bank's dealers range. I avoid trading during those times, so I only take trades at certain times of the day, and then I even refine those times such as the 3 a.m. time and the 9 a.m. macro, the 5 a.m. macro, right? I'm going to teach all of them to you throughout these months, but let me explain my thought process to you. Now for some of you it might sound a bit too overwhelming, right? It might sound a lot, but that's exactly my point with these trade breakdowns. Now for some of you, you're going to find this overwhelming, but as you go through these trade breakdowns and you go through CPI and watch all of these chapters about market profile, CRT, turtle soup, Peter raise, and all of these other concepts and profiles, you're going to find out that you are now understanding these trade breakdowns, and you're getting familiar with them, and you are even finding trade ideas on your own in the live markets, right? So it's going to be a long, lengthy, boring process of you studying these breakdowns, studying these outlooks, and studying these weekly chapters, and that's going to develop you as a trader, right? It's going to be boring, and that's how exactly it's meant to be. Now I'm going to remove this right here, and then we're going to deal with the price action right here, right? Now you may know about the 9 p.m. and the 5 p.m. CRT. So this is the 9 p.m. CRT, right? This is basically the Asian range, and this together forms the flout, which is the combination of CBDR and the Asian range, right? Now first of all, I selected this this CRT right here, and I wanted to price to take out this CRT's low and then find an entry from here towards this drawn liquidity here. So our buys was first of all bullish. Now our buys was bullish, and the reason for that was that we were in the QD stage and the kiss of death stage of this whole sequence, right? And our drawn liquidity was also higher, which was this range high and this daily CRT high right here, right? Now obviously I'm expecting this range high to be taken right here. It can potentially act as our drawn liquidity for our as a target, but my job as an intraday trader using CRT and turtle soup concept is to frame a trade idea within this CRT right here. Now we're going to go down to the 15-minute time frame and then see what happened here. Now you can see right here that this is that CRT 9 p.m. CRT high right here, and this is the 9 p.m. CRT low. And what happened is that price purge this CRT low on the 1:30 AM macro, which is basically a huge macro and a really important time for CRT purges, and we purged that, and then we closed above and we had a CSD which confirmed our buys and confirmed our drawn liquidity. Now what I did is took a model 1 entry. Now for those of you that know model 1 entry, you're going to see that basically we're going to take an entry at the open of this order block, right, at the high of this order block, right, and then we're going to put our stop loss right below this swing low, and we're going to first of all target the 50% of this range, right. Our first target is going to be the 50% of this range, which is right here, and our second target is going to be the CRT high right here, right. Now so what happened right here is that I took some partials here at this 50% of the range, and then what I did is that put my stop loss at break even, and then I let my trade play out. Price was just about to take this high before it actually reversed from here and got me out of the breakdown. So even though my buys somehow or in some way was wrong, I still made profits, and the way how I actually made it is by taking my entries here and then taking some partials out right here, right. So with CRT what happened, that even though my buys was kind of wrong, it was right but it was kind of wrong based on the timing of it, but I still made profit and avoided loss, right. Now then what happened is that price reversed below again, and then we formed this 1 AM CRT. Now this was a perfect time for me to take another entry towards that drawn liquidity on the 15 minutes. So I was looking for price to purge this CRT low at the right time, which happened during the 7:30 AM, which is a good macro for price to purge a CRT low, and it was also the start of the New York Open, right. So we purged the CRT low right here during the New York Open, and then what I was waiting for price to close above the candle that dug below the low. So this was the candle that dug below the low, and then what happened is price closed above this candle's high, and then we could have taken our model entry right here at the high of this order block, and our stop loss could have been right here below this low, and we would target first of all the 50% of range, which is somewhere right here, and then the opposing end of the range, right. So these were the two entries that I had taken on Tuesday. So first of all, my expectation was for price to take out this CRT low and then target this one. This trade did not fail. The drawn liquidity and the timing of it itself failed, but I still made profits here, and then I waited for another opportunity, right. Some people would be taking trades right here and they would have ended up in loss, but what I waited for is for price to form another CRT, which was this CRT. So I did not take an entry right away, but instead what I did is waited for price to purge this CRT low at the right time, which was the 7:30 AM, right, and then I waited for a confirmation before I could actually take an entry, which was in the form of model 1 entry right here, and I waited for a CSD to happen, which occurred, and then I took my entry right here at the open of this order blocks high. My stop loss was right below this low, and my target was first of all the 50% of the CRT range, and then the opposing end of the range. This is what we call model 1, right. So this was my trade breakdowns for Tuesday, right. I hope you've learned from it. Now for some of you it might sound too overwhelming, but don't worry. Throughout these months I'm going to explain every concept that I'm using in these trade breakdowns, and then throughout time you're gonna find yourself capable enough to understand these trade breakdowns, and you're going to find yourself finding trade ideas on your own, right. Okay, so this is my execution right here. So you can see first of all I took my entry right here at this
order block right here, which was a moderate good entry, and I took some partial sale right here at the 50% of the range, and then I got out of the rest of the trade right here at break even, and then I waited for another opportunity and took my entry right here at this order block, and then rode it till this CRT high right here. And this is how, even though I was somehow wrong here with the timing, I still ended the trade with profits, and then took another trade right here, and these were two of my winning trades for the day, and ended the day in profits. It was around 4 or now. With this, even if I lose the next 3 trades, I'm still going to be in profits, right? So that's the magic of win rate and risk to reward ratio, and you should keep a balance of both.
Right. Hello everyone, welcome to chapter 1 of CPI. This chapter is going to be based around market profiles. In this chapter, I'm going to make sure that I explain everything that there exists about market profiles and how you can use market profiles to change your perspective about the markets. Now, I've organized and designed these chapters in such a way that I'm going to build every single aspect of your trading brick by brick, starting with the basics and fundamental knowledge, and then moving on to the advanced and intermediate stages once we build our fundamental knowledge, right? Now, the issue with us trader is that we are in a kind of this predicament that we think that the solution to our trading problem is by making sure to furnish and build our advanced knowledge. But in reality, the solution to those problems is making sure to build your basic and fundamental knowledge as precise and as refined as possible, right? And then moving on to the advanced and intermediate stages once that basic and fundamental knowledge is built correctly and efficiently. Now, when I first started my trading journey, I had the same issue. I gave significance and importance to the intermediate and advanced side of things and ignored the basics and fundamental knowledge, which halted my growth for a lot of time. And then how I solved that problem is by making sure that I start over right from the basics and then build my fundamental and basic knowledge in the most refined and efficient way possible. And then when I did that, everything changed for me because I started to look at the market with a dynamic perspective, and my trading problems started to fade away. Now, market profiles is basically a detailed analysis of the market dynamics and looking at the markets with a dynamic, mechanical, and objective perspective, right? Now, there are two ways to look at the markets based on market profiles. The first one being the simpler version, which only takes two profiles or two aspects into consideration and is a more basic way of looking at the markets, right? Now, the two aspects contained in it are a ranging or consolidation profile and an expansion profile. Now, let me explain these market profiles to you before we move on to the advanced market profiles, right? Now, you guys have been taught only the simpler version of market profiles and are only familiar with this one, right? Now, the way how the market moves is that it basically moves either in a ranging profile or an expansion profile. So first of all, we start with a ranging profile, and then after a ranging profile has ended, we then turn into another profile, which is an expansion profile. And then after an expansion has occurred, we cannot have another expansion after it. After an expansion profile is ended, we turn into another ranging profile before making another expansion, right? Now, you can see that based on just this perspective alone, you can avoid half of the market conditions, which are basically lower quality and lower probability conditions, right? Now, your objective as a trader is to take part only in the expansion profiles and only take part in the expansion that occurs in the market, right? And avoid ranging or consolidation conditions or profile. So if you take this into consideration, these profiles into consideration, it basically acts as a huge filter for you to avoid lower probability condition. Now, another way of looking at the markets with market profiles is through an advanced version, and this one takes multiple aspects and profiles into consideration, right? And those are a consolidation profile, an expansion profile, a retracement profile, and last but not least, a reversal profile, right? Now there's another one as well which I've added, which I'm going to explain later, but first of all let me explain these aspects to you first. Now we are familiar with both the ranging profile and expansion profile already, but on top of that we're going to add retracement and reversal profile. Now let me show you on the charts. So first we start with a range, right? Every single move in the market start with a range. So when price opens either on the week or the day, we start with a range, and then after a range there is only one possible outcome for price, which is an expansion or an expansion profile, right? Then after an expansion has occurred, we can have three possible outcomes, which are either a retracement, reversal, or another range. So now you can see that based on market profiles we've added a filter to our perspective, and based on this we can potentially avoid lower probability market conditions and only take part in high probability conditions. Now for each market profile there is a specific theme, which is that it can only have a certain outcome after a particular market profile, right? Now for instance, let's say if we are in a consolidation or in a ranging profile, then the possible outcome for price is an expansion, right? Now from a ranging profile we cannot have a retracement or a reversal profile, right? The only possible outcome is an expansion. Similarly, after an expansion profile has ended or occurred, we can only have three possible outcomes, which are a retracement, a reversal, and a ranging profile. That means after an expansion has occurred, we cannot have another expansions, right? We cannot have another expansion right away after the expansion profile has ended, right? First we're going to either wait for a retracement or a range to form and then position ourselves toward another expansion or a reversal. Similarly, after a retracement profile has occurred, we can only have two market profiles, which are an expansion profile or a ranging profile. That means we cannot have another retracement or a reversal profile after a retracement profile has ended. So you can see with each profile we're adding further more filters to avoid certain profiles after a particular one has taken place. Now the significance of this is that it acts as a huge filter for us, right? Now most of you know that 90% of the time trading is all about patience and waiting for the right setup and waiting for them, and then the rest is executing your trade, which means that most of the time you're going to wait for your setup to form, and for it to form at a specific time of the day or at a specific market profile, and then you're going to execute your trade. So if you did not know about market profiles and did not use it in your trading, then you wouldn't have a filter or anything which could make you avoid lower probability conditions, right? Now that's why the first thing that I taught you in chapter 1 is about market profiles, and I made sure that you learn everything about market profiles, so that way you can avoid certain profiles and certain market conditions, right? Now we can even further define this knowledge about market profiles even more and add another profile, which is called the manipulation profile. Now let me explain it to you why it is so important and how you could use this manipulation profile to position yourself in a trade towards a drawn liquidity. Now the manipulation profiles occur or start after a ranging profile. Now with this profile, the market takes both sides of the range and it takes out liquidity and manipulates the trader into a certain direction, and then it reverses in the opposite direction and expands, right? Now with this profile you can avoid getting caught in a manipulation, or what some people call a judo swing, right? Now you can trade this judo swing, but you for sure can never know or measure how far this manipulation is going to be Because let's say you took a turtle soup entry once liquidity was taken or a high or low was taken, then you cannot accurately measure where you're going to put your stop loss, because price can either have a big manipulation or a longer one or a small one, and you cannot measure it, right? It can take your stop loss and then expands your designated direction. So right, so for that the solution is to wait for the manipulation profile to end, and once that ends you can position yourself in the expansion profile after a confirmation has been made in the form of a CSD or a model 1 entry, which I'll explain further in other chapters. Right now, confirmation for manipulation profile ending is made once price closes below a swing low or a swing high or forms an order block. After that, the manipulation profile has ended, and now you can enter a trade and position yourself in the expansion or in the expansion profile. Now, as I said before, each market profile can have a particular possible outcome, and the same manner manipulation profile has also one possible outcome, which is an expansion in the opposite direction, right? And a manipulation profile cannot enter a retracement or a ranging profile or a reversal profile. It can only have an expansion after it, right? That means we've added another filter to our understanding of the market dynamics. Now, another important thing about market profiles is that with market profile, generally you would want to avoid arranging and retracement and manipulation profile, and only take part in expansion profile and reversal profile. That's the only two profile which most, if not all of you, should particularly focus on, and you should avoid trading the rest of the profiles. Now, for advanced traders, you can trade the manipulation profile too, but for now and for our betterment and improvement, we're going to avoid manipulation profile and only trade expansions and reversals. Now, as I said before, this is just the basic and fundamental aspects of our understanding of the markets and its dynamics, right? Now, we're going to integrate this concept with other ones like CRT, turtle soup, key levels, and PDRS, and build our understanding further while improving together in this coaching program, CPI, right? We'll be using all this knowledge in a conceptual and contextual manner, meaning we're going to use past price action to predict and anticipate further future one, and for that we're going to use conceptual and logical technical knowledge in the contextual manner. That's how we're going to build our understanding. Right, now let me give you some examples on the charts, specifically on the intraday charts, because after all we are all intraday traders and our predominant focus in CPI is going to be on intraday trading, right? Now, the way how you can use these market profiles to have a dynamic, evolved, and a refined perspective is by integrating it with key opening times, right? Now, you can have these opening times both for the daily open, which is the 17 Eastern time right here. You can use the weekly open, which is the Monday opening time, right? Now, the way how you can integrate market profiles with opening time is by knowing the fact that more often than not, and most of the time, when price opens, right, or the market opens, price straight away enters a ranging profile, right? Now, with that fake in mind, you can straight away expect a ranging profile. And as I said before, after a ranging profile, the only possible two outcomes price can have is either a manipulation profile or an expansion profile, right? Now, then you can integrate these market profiles in opening times with other concepts such as the key levels concept and CRT, and then you can position yourself towards your drawn liquidity, right? Now, it might sound a bit too overwhelming for some of the beginner traders because they might not be familiar with key levels and all of these other stuff, but you don't have to worry about anything at the moment, right? Now, this is just the first chapter of CPI, and I've already explained so much to you in just this first chapter, and how you could avoid certain market conditions and take part in other ones, right? Now, as I said before, I'm going to make sure that I analyze and show you how these concept works based on last week price action and current price action, so that way it's going to be easy for you to journal it and reverse engineer it and compare it with your perspective that you had throughout the week and how you could improve it for the next week, right? Now, so we're going to start off with last week price action, and we're going to start off with Monday and how you could have used market profiles to have a dynamic perspective, right? Right. Now you can see right here that the weekly open right here is 17 Eastern time, and as I said before, that after opening time, price straight away goes into what? Goes into a consolidation or a ranging profile, and that's exactly what happened here, right? Now you can see that after the opening time, price straight away went into a consolidation profile, and then after consolidation profile, as I said before, it can only have two possible outcome, which is a manipulation profile or an expansion profile, right? And in this case we had a manipulation profile, right? So this was the manipulation profile, and this manipulation profile ended once this candle closed above this swing high, which had taken this swing low and price formed this order block. Now this might sound a bit overwhelming to you, but don't worry, I'm going to explain everything in further chapters. This is just the first chapters, and in other chapters I'm going to integrate CSD with it. We're going to integrate key levels, turtle soup, CRT, everything, so you don't have to worry about anything, right? I'm also going to be showing you live application of it through trade breakdowns, right? Now let's get back into the chapter, right? So you can see that once this manipulation profile ended right here, let me do this, right? Then the only possible outcome after a manipulation profile is what? It's an expansion profile, right? And that's exactly what we had here. So on Monday, what happened is that we first had a ranging profile, then we had a manipulation profile which ended right here, and then after a manipulation profile we had an expansion profile. Then again you can see right here, let's see, you can see that after this opening time and from right here we had what? We had a ranging profile, right? And then after a ranging profile we had a small manipulation profile which ended right here after price from this CSD and from this order block. And then what we had is, first of all, an expansion profile, right? Then after an expansion profile, as I said, we can have three possible outcomes: either a ranging profile or a reversal or a retracement, which in this case was a retracement. And then after retracement we had an expansion, and then after expansion we had a reversal from here, and then we turn again into a ranging profile. So you can see we had a ranging profile, manipulation, and then the only possible outcome for price after manipulation is to expand in what? In the opposing direction, in the opposite direction. And then after an expansion we had a retracement, then another expansion and reversal, right? Now again, right here on Wednesday price action, you can see that after the opening time we straight away turned into a ranging profile, and then after ranging profile we can only have two possible outcomes: an expansion or a manipulation. And in this case we had a manipulation, and this manipulation profile ended right here once price closed above this candle right here, right, and form a CSD. And then after that we had an expansion in the opposite direction, right? And then we had this kind of retracement which turned into a consolidation or a ranging profile right after this opening time. And then we had what? We had an expansion in this case. So after a ranging profile, the only possible outcome for price is either a manipulation or an expansion, and in this case we had an expansion. And then after an expansion we had a retracement, and then another expansion, right? So that's exactly like how the market moves. It moves in these kind of profiles, which either the market moves in a ranging profile, a manipulation profile, an expansion profile, and then another ranging profile. Now the way how you can use it is you're gonna avoid trading the ranging profile and the manipulation profile, and only try to position yourself and the expansion profile and only trade expansions or reversal. So let's see, we're gonna start off with Monday. So on Monday, obviously you would have avoided trading this ranging profile, you would have avoided trading this manipulation profile, and you would have only traded this expansion profile, and it would have offered you this expansion exposure more towards the upside, right? Then on Tuesday, obviously you would have avoided trading this ranging profile and this manipulation profile, and only traded what? And only traded expansion profile and reversal profile from here, right? This is how you use market profiles with opening times to expect certain expansions or to avoid certain market condition or certain market profiles based on others and based on past market profiles, right? Now, as I said, this was just the first chapter of CPI, which was about market profiles, and I've explained market profiles to you in the most efficient and refined way possible, and I hope you've made notes and journal everything, right? Each week we'll have chapters like these, which is going to build your theoretical and technical knowledge, and along with that I'm going to upload and post market outlooks and trade breakdowns for you, which is going to act as a way for you to see how you can apply this knowledge in live markets, meaning live application of this knowledge in theory. And that's how you're going to learn and be coached by me, right? You're going to watch these trade breakdowns and see how you could have used market profiles and all of these other chapters which I'm going to explain in the further weeks ahead of us, right? And your understanding is going to improve by a lot, right? And your perspective is going to be changed completely. Right, hello everyone, welcome to the second trade breakdown of CPI. Now this breakdown is going to be on the Nasdaq, right? Some of you suggested that I should also break down some trades on indices, so here it is. Now this trade was specifically based around the 9am model. This is one of the top CRT model along with the 3am model. We'll discuss both of these models in the upcoming future in CPI, but first let's get into the breakdown. Now the key things around this breakdown are a micro CRT within a macro CRT on the higher time frame, meaning there's going to be a smaller CRT within a larger CRT on a higher time frame, right? Now the way how you could use it to your advantage is by aligning yourself on the micro CRT on the lower time frame towards the larger higher time frame CRTs, draw liquidity or target, right? Now we'd also be discussing some parts of TSKO or the sequence as well, which is basically the sequence of moves that occurs or forms inside a CRT before the target is reached. Now TSKO has multiple sequences and I'm going to discuss it briefly here later in the video, but for now let's get in the breakdown. Now for some of you this stuff might sound a bit too overwhelming and too much for you to digest because we've only discussed market profile so far, but as I said, this is a process-based coaching program and it's going to be step by step starting with the basics, so you've got nothing to worry about, right? I'll be explaining every aspect in detail in future chapters, right? Now let's get in the breakdown. Now first of all, I'm going to make sure that I integrate and explain this trade breakdown in terms of market profiles too, that was discussed in chapter 1, so that you can actually see that how you can apply that knowledge that was given to you in chapter 1 and use it in the live markets and take trades based off of that, right? So if we look at the price section here of the last 2 weeks right here on the 4-hour in terms of market profiles, then you can see that starting from here we've got this opening gap, right? And as soon as the week started, we straight away got into a ranging profile. As I had mentioned in the video that after opening time, price straight away more often than not gets into a ranging profile. Then after a ranging profile, you know that price can only have two probable outcomes, which is either a manipulation or an expansion, and in this case we've got an expansion. Then after an expansion occurs, we can only have three possible outcomes, either a range, a retracement or reversal. In this case, we got this range right here. Let me write it down here, right? Now, after a range, again, using the same logic, we can only have two profiles. We can either have a manipulation profile or an expansion profile. In this case, we got a manipulation profile, and that manipulation profile ended once this candle right here closed below this candle. And the reason for it and the reason for why this candle has so much significance is because this is the candle that dug above this range high right here, and then this candle closed below that candle, so that one became our order block, and a confirmation occurred and the manipulation profile ended, right? And once a manipulation profile ends, we know that we're gonna have only one possible outcome after that, and the only possible outcome after a manipulation profile ends is an expansion, but not just a normal expansion, an expansion but in the opposite direction. And you can see that we had that expansion here, and then after that expansion we had another ranging profile, and then after that ranging profile we had another expansion, right? Now when price was right here after an expansion, I started expecting a reversal. And the reason for that is that after an expansion we can only have three possible outcomes: a range, a retracement, or a reversal. And I anticipated a reversal, and the reason why I anticipated a reversal is based off of two factors. The first factor is that this expansion right here took out this range low, and once a range low is taken or a key level is taken, it can offer a small reversal there. So that's why I was expecting a reversal. But not only that, we were also inside of this opening gap right here, this key level in the form of opening gap. So that two factors together made me decide that I'm going to expect reversal profile right here. Now based off of this, you can see that you could actually analyze every single price action with a logical and a rational perspective, right? Instead of looking at it in terms of patterns, right? So we actually used logic. We used a if and then logic, right? Which basically means that if this particular thing happens, then that's going to be our outcome. But if that happened, then this is going to be our outcome. So you can see that each if logic has a particular then outcome, right? Such as if a ranging profile ends, we can only have two outcomes: a manipulation, expansion. Similarly, if a manipulation profile ends, we can only have one outcome, which is expansion in the opposite direction. So you can see we are actually using proper logic here, and we are not randomly anticipating or expecting a certain profile, right? We are using that based off of a proper rational logic, right? Obviously, now in later chapters I'm going to explain how you can expect certain profiles after a particular one has ended based on multiple factors, but that's a topic for another week, right? Now here you can see that obviously I couldn't just take a trade right away, right? I couldn't just take a reversal trade right away. Obviously I had to match it with a CRT that could offer a reversal trade on the lower time frames, and for that we had this CRT candle, right? And the reason why I chose this particular CRT candle is, first of all, it's the candle that dug below the range low, right, and dug into a key level, this opening gap, and such candle could potentially act as a strong CRT range. Another factor for it is that we had inside bars in this CRT, which generated interest above and below the CRT low and generated liquidity. But not only that, the purge of this CRT occurred at a key time, which confirmed this to be a potential CRT that we can potentially trade on the lower time frame. Now it doesn't end there. We even had a lower time frame confirmation on the 1 hour. After that, I confirmed my buys and drawn liquidity and started looking for a long trade in the form of a reversal trade. Now let's go down to the 1 hour time frame and see what we've got there, right? Now on the 1 hour you can see that we've got this CRT candle high right here, right, which I was looking for it to be taken in my drawn liquidity, and my target was this CRT candles high right here. Now obviously the purge had already happened at a key time, and then we also confirmed our buys after this candle closed above this candle right here in the form of a CSD and form this order block, right? Now obviously at this time I was unavailable, right? I was not available, so I missed this potential trade opportunity here, but our buys and drawn liquidity was still in play, right? And I started looking for another potential trade towards that drawn liquidity on the 1 hour, right? Now for that I started looking for a CRT, and then I find this candle right here, and then I chose this particular candle is my CRT. And the reason for why I chose this particular candle is because of two predominant factors. The first one being that this particular candle dug into this order block right here, dug into this key level, and not only that, this candle was formed at a key time, which is the 7 a.m. Eastern time. The 7 a.m. Eastern time, along with other times, is a key time for 1 hour CRT to be formed. So based off of these two factors, I decided that I'm gonna potentially trade this CRT. But not only that, on top of that, I waited for this CRT to be purged at the right time, and that CRT purged at the 9 a.m. key time. And that's why I said in the beginning of the video that this model was based on the 9 a.m. model. And the reason for that is that the purge occurred during the 9 a.m. candle, and that's why I had so much like faith in this CRT that it's gonna work out, right? And I traded that CRT on the 5-minute time frame. The reason why I chose this 5-minute time frame to trade this 1 hour CRT is based on time frame alignment. I'm going to discuss this as well in the later chapters as well. But what you need to know and note down is that if you are using 1 hour to find your CRT, then you'd have to trade that CRT on the 5-minute, right? Similarly, if you are finding CRTs on the 4 hour, then you're gonna trade those CRT on the 5-minute. That's what we call time frame alignment, right? Now another component behind this trade was TSQ. Now for those of you that aren't familiar with TSQ or the sequence, don't worry, I'm gonna explain it in further chapters, but let me discuss it briefly here as well, which is gonna clear most of your confusion and concerns regarding it, right? Now what you need to know about TSQ is that, let's say we've got this CRT high and CRT low right here, right? Now let's say we are expecting this bullish prices, right? So what we're gonna do is we're gonna wait for this CRT low to be purged, and once this CRT low is purged at a key time, we're gonna then wait for a confirmation to prevail, and that confirmation prevails in the form of a CSD, or when price closes above the candle or the swing low that dug below the row, right? Now when price closes above and goes above the swing high that took the CRT low, which is this swing, and price closes above it, it forms an order block, right? Now what you need to remember is that there is a specific sequence of price action that price follows before it reaches the opposing end of the CRT or the opposing end of the range, right? And now that sequence consists of an order block entry, right, a breaker entry, an OTA entry, and last but not least a KOD entry, right? Now the order block entry forms immediately, which is when price retests that swing that took the CRT low, and then price reacts off of that. Then we have a breaker entry and OT entry like this, and then just before this opposing end of the CRT is reached and the drawn liquidity and the target is reached, what happens is price stops and then it retraces back, right? Just before the target is reached, what happens is price retraces again, and then price forms a turtle swoop there, and then takes the CRT range high or the opposing end of the range. That's what we call a KOD entry, or the kiss of death entry, which is basically the last move before the drawn liquidity is taken or the target is reached. So as you can see right here on the price section on the 1 hour, you can see that just before this CRT high right here was taken, price retraced below, formed this order block, then it turtle swooped that CRT, and then it went above and take that drawn liquidity. And this price section right here is what we call a KOD, or case of death entry, right? So that was another main reason behind this trade as well, and that's why I had so much faith in it, because I knew this was going to be a KOD entry, and KOD entry are one of the highest probability entries. That's why I framed my entry based off of this framework right here.
Okay, so here is my execution of that trade. You can see that this CRT low was purged right here. I then waited for a CSD to form and waited for an order block entry right here, and then I closed my trade once this high was souped. Now I usually take around 1 to 2 trades per week. I don't take that much trades throughout the week. I only wait for high probability trades. That's why you wouldn't find me trading each and every single day, because that's not how trading works. If someone has said to you that you need to be trading every single day, then they don't know what they're talking about and they're full of shit, right? You only need to find 1 to 2 high probability trades throughout the week, and that's more than enough for you to make a living out of it. Now you can see right here, and euro, I only took this trade this week, and that's it, right? I'm still waiting for another opportunity, high probability opportunity, before I take another trade. Last week I took this trade and only this trade right here that I broke down for you, and this opportunity right here, and that's it.
Alright, hello everyone, welcome to Trade Breakdown on EU. Now, this is a trade breakdown from last week. It's a bit delayed because I was traveling and I had a sore throat, which you could probably guess from my voice, but forget about it, it's not a big deal, right? Now, let's move on to the breakdown. Okay, so we're gonna start off with the 4-hour time frame because that's where the trade idea was based on, right? Now, based on range trading, we know that what happens is that we get this range low and range high right here. And what happens is that price ranges or consolidates inside this range. And then when price is about to break out of this range, what happens is that price first takes out one side of the range or one extreme of the range, and then the drawn liquidity for us becomes 50% of that particular range, and then the opposing end of that range, right? Now what you need to remember is that even when price continue its journey towards the opposing end of the range or our drawn liquidity, it doesn't move straight away in a straight line, right? It always moves in expansions and then retracements and then another expansions towards those drawn liquidities. Now the first retracement of after the expansion occurs when 50% of the range is taken, right? Or an inside range high or low is taken, right? In this case we've got this inside range high which was taken, and then after that we had a retracement towards either a key level on the same time frame or a higher time frame, and then we continued our journey toward the opposing end of the range, right? What happened is a price and that retracement profile test a key level, and then again it continues its journey higher and reaches the opposite end of the range. Now here on the charts you can see that we've got this range low and this range high right here, right? Now what happened is that price took out this range low, right? Now based on range trading mechanics and dynamics, after a range low is taken, what happens? The thing that happen is that then price starts its journey higher, right? Now what you also need to know and remember is that choosing a range high or a range low also has a proper framework and logic behind it, right? And it takes a proper thought process in deciding the range high and range lows. And also there is a huge higher time frame framework behind it, right? So you're gonna learn all of this in later chapters, and don't worry, I'll teach you those things at the right time throughout these 7 levels of CPI. But in a nutshell, this is how range trading works, right? You should note these things down. Now going back to the charts, we can see that after price took out this range low, our drawn liquidity became what? It became the opposite of the range and the 50% of the range, which is this high right here, this inside high right here within the whole range, right? Now price expanded higher and took the range high and 50% of the range, and after that, you know what happens more often than not. Remember what I told you a moment ago. More often than not, after price takes out an inside range high which lies in the 50% of the range like this, right, or reaches the 50% of the range, what happens is then price has a retracement profile, and after that retracement profile, price either expands higher or continues journey lower. Now in this case, what I did is I expected this range retracement profile on the 4 hour with a 15-minute entry, right, 15-minute time frame entry. Now, the thought process behind this was based on a logical framework. So first of all, we took out 50% of the range, which is this range high right here. And now based on that, we can expect a retracement profile before we can move on and expand higher and continue our journey towards the opposing end of the range right here, right? Now, another thing is the time of this retracement profile right here. You can see that if we plot on the opening times on this day, Thursday, you can see here we've got this opening time there, here, and there we got the closing time of Thursday, right? Now you can see that right away after opening time, we went straight away into an expansion and took out that range high right here, right? And we already had a huge expansion for the first half of the day on Thursday, and now we can potentially cap the daily candle range and retrace and form the wick high of the daily candle. Now obviously if there wasn't any thought process like this, then we wouldn't have expected anything as such, but right here we've got a proper reason as for why price should retrace before moving higher, and for that we matched it with the daily intraday time of New York kill zone and London close kill zone, right? Now based on intraday profiles, if London kill zone has had an expansion move and that expansion has now tested a higher time frame key level like this, then during New York or London close kill zone, we can expect either a retracement profile or a reversal profile, and in this case I expected a retracement profile during the New York and London close kill zone, right? Our first objective is gonna to be expect a retracement profile, and then we're gonna see the price action on the lower time frame and decide whether we want to expect a reversal profile, right, and want price to continue going lower, right? Now after that retracement profile is ended, price can again go to another expansion profile again and continue its journey higher, but in this case I exploited this retracement profile here on the 4 hour on the 15-minute time frame, and I took a short trade there. That's the logical framework and thought process behind the trade idea. Now right here you can see that price took out this range high with this big candle right here, and coincidentally this candle is formed at the 5 a.m. Eastern time, right? So this candle has taken out a key level in the form of this range high. It's formed at a key level, a key time, right, which is the 5 a.m. key time. And not only that, it was purged at a key time, which is the 9 a.m. Eastern time. So you can see based on these factors, we can potentially regard this candle right here as a CRT for us, and we can trade it on the lower time frames, right? That's why based on all this logic right here, after price took out this CRT high at a key time, I went down to the lower time frame and started looking and waiting for my entry setup, which is basically in the form of a model 1 entry. Now let's go to the 15-minute time frame and see how I took my entry on the lower time frames. Now you can see right here as this is the CRT high, right? This is the CRT low right here, and this is the 50% of the range. Now I waited for this CRT high to be purged, right? And as soon as this high was purged at the 9 a.m. Eastern time here, after that I waited for my setup, which is in the form of model 1 entry, which is basically an order block entry, right? So now you can see that this candle right here is the candle that dug above this high right here and closed above inside of it. Now what I did is I waited for this candle to be engulfed, meaning I waited for price to close below this candle, and then I waited for price to retest that order block, take my entry there. My stop loss is going to be above that order block, and I targeted the opposing end of the ranges, the 50% of the range and the opposing end of the ranges. Now here what I did is only targeted for 3 hours, because the daily candle had already capped and now the daily candle was about to close, right, which usually is a time for ranging profile to start. So for that reason I closed my trade right here at this time and took my profits. This is how my trade looked. Now I could have held it down towards the opposite end of the range and I would have made a lot more profits, but I took my profits at the right time and closed my trade objectively because I knew that the daily candle was about to close and price was going to go to a ranging profile, which it did, right? So now this was the trade breakdown. One thing is you need to remember that you have to be content with what you receive from the markets, right? And never see perfection. If you are going to see perfection every time and always adjust your model based on just a few minor factors, then it's not going to end up good for you. Your objective as a trader should be always to only follow your brain and follow your routine consistently with discipline, right? Now, based on all of the breakdowns that I've shared with you till now, you could see that all of my entries have a specific logic behind it. And almost all of my entries are pretty much the same, right? And that's exactly what your aim as a trader should be. All of your trades must look like the same, feel like the same, and obviously they're gonna look the same, so they're gonna be boring as fuck, right? This is exactly what your aim should be. You should see a proper theme and a proper pattern behind your trades, and the third process, the higher time frame third process and the lower time frame entries should be the same and look the same and feel the same, right? That's your aim as a trader. And obviously it's going to be boring, it's going to be repetitive, and that's exactly how it's meant to be. If you're always seeking for excitement, then I'm sorry, but it's not going to end up good for you. Yeah. Hello everyone, welcome to chapter 2 and 3. These two chapters will be extended together in this single video. Now, this chapter is about key levels and integrating key levels with market profiles, right? Now, I've already explained what market profiles are and what are the different intricacies of market profiles, but now we're going to take that even further and add another concept, which is the concept of key levels and period arrays. We're going to combine that with market profiles and refine our understanding even further. Now, the way how this is going to work is that first of all, I'll explain each concept individually, and then I'll teach you how you could combine and integrate these concepts with each other and use them cohesively to produce or generate trade ideas. Now, we've already explained what market profiles are in chapter 1, and if you haven't watched chapter 1, then you should first of all make sure to watch that first and then continue with this chapter. Because the way how these chapters have been designed is that they are step by step, right? I'm coaching and teaching you them in an organized, proper manner, and every single chapter is connected with each other, right? So if you haven't watched the prior chapters, then you wouldn't understand the later ones. That's how it works. Now, before we get into the chapter, I just want to point out and address something. There's some of you have been making some really good notes of these chapters and breakdowns that I'm sharing with you. And I was really overwhelmed by the positive reviews and responses. So let me tell you this, that this is just the inception and there's a lot of stuff ahead of us that you'd really enjoy. Now, as I said before, these theories and technical knowledge in these chapters is all fun and games, and it develops and refine your understanding. But what you also need to know is that you need to see some live application of these concepts, right, in the markets, and how you can use them to find trade ideas and how you can execute them, right? That's why you also need to make sure to properly watch and learn from these trade breakdown videos that I share with you as well. Because without those videos, you won't know how you can use it in live markets. And those videos show you live application of this theory, of this technical knowledge, which is one of the key aspect in learning a theory or concept or anything, right? All right, now let's get on the chapter. So, key levels. The basic definition of a key level is basically important price points, areas or zones or whatever you want to call it on the price chart where significant expansions and reversals occur, right? Now, this is the basic definition of what a key level is, and it can be broadened and refined even more. But for the time being and for the sake of efficiency, we are just going to deal with this definition at the moment because it's the most accurate one and the most understandable one. Now, key levels have certain characteristics, right? They can serve as areas for potential CRT to be found. They can serve as zones for potential expansion profiles and the reversal profiles to occur. They can serve as catalyst, or you could say a reactant for expansions to occur, right? They can be used as confluences for your trade ideas, meaning if you found a potential trade idea and it has a key level as a factor, then you can potentially regard that idea as a high quality trade or an A plus setup. But similarly, if it doesn't have any key level as a confluence, then you can respectively manage your risk on those sort of trades and trade them accordingly. So you can see how you can use key levels to manage your risk, right? Not only you've used key levels to find high probability trades, but you can also use it to manage your risk based off of it, right? That's why it has so much significance, and almost all of my entries are based off of key levels and never alone. Now, last but not least, you can use key levels to frame trade ideas based on the above factors, right? These were some of the characteristics of key levels. Now, the reason why I explained them to you is so that you know what you're going to be dealing with in this chapter and you're going to be ready for what's ahead of us in this video, right? Now, this key level concept is going to breed a new life in your understanding and is going to refine your understanding of market profiles even more. Now, these key levels are referred to by multiple names, right? Some call them PDRAs, some call them precursors, some call them even point of interest or POI, and I myself call them key levels, right? Now, the name itself doesn't matter. What matters is the theory and the technical significance behind it. You could call it whatever you want or whatever you like, but for the sake of our understanding and for the sake of efficiency and pattern recognition, we all are going to refer to them together as key levels, right, instead of any other name. So that way, if we are discussing key levels, it would be more easy for us to break down, explain, and relate to, right? Now, let's discuss some important and relevant key levels here. Now, some of the most important ones are the following. The first one, and my favorite one, is the order block. Now, order blocks have a proper and rational logic and narrative behind it, right? There's a proper logic behind how order blocks are formed and how you can use them as key levels. The reason why order block is my favorite key level is due to the fact that order blocks are one of the most objective and least objective key levels. And there's a proper way of how can you choose and select an order block, right? Now there's a hierarchy of key levels from least significance to more significance, and in that hierarchy, order blocks are the most important ones and work the best every time if you properly integrate it with market profiles, right? Now, the second one is the breaker block, which is also a really good key level and you can use it to frame trade ideas. Now, each one of these key levels have a proper logic and narrative behind how they are formed, how they can be used. And I'm going to discuss them later in the video, but for now, let me just give you a brief introduction today. The third one is an FEG. Now, an FEG is basically just a lower time frame turtle soup or a higher time frame CRT, but for the sake of efficiency, as I said, which is the main aspect of CPI, which is efficiency, we're just gonna call it and refer to as an FEG, right? The next one we've got on the list, a really important one, a rejection block. This is also a form of an order block, but it's an extreme one, and it lies on the extreme ends of an expansion swing and ranges, right? And when chosen correctly, it offers really good trade ideas. Now, last but not least, the two most important key levels after an order block, which are highs and lows. Now, if I had to only choose two key levels for my trading, then I'd choose order blocks, highs and lows. These are the only two key levels I use most of the time in my trade ideas. I barely use breakers or FVGs. Most of my trade ideas are based around either order blocks, highs or lows. Now, there are many key levels like mitigation blocks, propulsion blocks, liquidity voids, opening gaps, and much more, but they are mostly just to create noise and distraction. And in my respective opinion, you don't need them. I don't even use them myself, right? I only use the one that I've mentioned in this list right here. What you need to learn about and master is these key levels right here, right? I've chosen these particular one intentionally because that's what have worked for me and have worked for other students of mine, and those will work for you as well. If you add in a other key level in there, it's just gonna add more variables to your understanding and it's going to create confusion for you, and you wouldn't know which one to choose and select. That's why I'm going to explain only these important ones to you that I use myself, right? Trading is mostly about having a balanced and appropriate approach. If you don't have enough knowledge, then obviously you don't have a chance at succeeding. But at the same time, if you learn every single concept out there and use every single concept that there exists, then it's going to create so much confusion for you that you're going to end up being a victim of analysis paralysis, right? And you wouldn't be able to analyze the charts properly with a balanced perspective, right? That's why technical knowledge is important, but only when it's balanced and doesn't end up on either of the extremes, right? This is exactly how these chapters have been designed. I could talk for hours on these things right here, but that won't help you as much as if I explain them in detail efficiently and tell you what's right and what's wrong right away, instead of going sideways around it and being indirect like most so-called gurus and mentors, right? I'm going to be completely straight and direct with you and only explain the things that I know are important for your understanding. Now, you could probably guess someone's technical knowledge and expertise just by listening to them talk about it, right? You could straight away point out or guess if someone is actually really about it, or they're just clowns who don't know what they're talking about and here just for a quick buck, right? You can straight away find convictions in someone's teaching just by listening to them. My job here is to make sure I tell you about the right thing straight away and be direct and straightforward with you, instead of being a diplomatic political dickhead who just want to avoid controversy and discussions and always tries the safe approach. Now, obviously, I've learned these things myself from other people like Romeo, and it's not like I was born with it, but the thing is that I added my own touch in it through research and backtesting and experience, right? And that's exactly how you can succeed in trading. If you're just being a copy paster and not adding your own touch to it, then it's not going to end up good for you. But also, you need to remember that it's something you need to do once you learn everything and then backtest and research every single concept, and not now, because your job at the moment is to master this stuff and add your own touch after you complete and finish CPI and gather the appropriate amount of experience and intuition that it needs, right? Because everyone has their own way of looking at things and approaching things, and everyone has a different mindset and perspective, and everyone has a different taste, a different emotional and rational thinking, right? So you need to do a self evaluation and then choose the style that suits you the best, and not anyone else but only you. Now let me explain to you what an order block is, right? So the most refined definition of an order block that I could find is this one. This is Romeo's definition of an order block, and it's the most refined and accurate one I could find. So here's the definition. The candle that ducks above a high or ducks below a low when engulfed, when that candle is engulfed, is considered an order block, right? Now here in this picture right here, you can see we've got this low right here, and what happened is that price came down here to turtle soup this low and take out that low. Now for an order block to be considered a valid one, it must have a turtle soup and must be formed after a turtle soup. If there is no turtle soup, the order block won't be considered correct, right? Now here you can see this is the exact candle that dug below this low right here. That means now we're gonna wait for this candle to be engulfed. And what I mean by engulfed is for price to close above it, and once price closes above it, it will become a valid order block for us, right? Now you can see right here price closed above that candle and formed this order block, this big bulky candle which became an order block. After that, we're gonna wait for price to retest this order block, find support there, and then expand from there, and this is what we call an order block. After an order block is tested, price is gonna expand from there and take out the opposing end of the range. Now let's discuss breaker blocks, right? So the definition of a breaker block is the following: the high that takes out a low, or the low that takes out a high when broken and retested, is known as a breaker block. Now in the hierarchy of key levels, breaker block is in the mid range, right? In the mid range of significance, but it's an important key level that you could use on the higher time frame. Now you can see right here that we've got this high and this low right here. And what happened is that this high took out and turtle swooped this low, and then it got broken above after that, and after that it became a breaker block. Now we're gonna wait for it to be retested and find support there, and we're gonna expand from there. Now you could use the opposite to see how a bearish breaker looks, right, or a bearish order block looks. Now how about I give you a homework here, right? What you should do is show me how a bearish breaker block and a bearish order block look. I've already shown you a bullish one, and you should go on your chart and find a bearish one on the chart and show it to me, right? All right, now let's talk about an FEG. Now, one thing you need to remember is that if you know about turtle soup, then all of these key levels will be really easy for you to understand and get a hold of. We've already discussed what order blocks and breaker blocks are, and you saw there that the only reason they were considered valid and correct were due to the fact that it had a turtle soup before them, right? Now, even when it comes to an FEG, it's just basically a lower time frame turtle soup. And if you look at a higher time frame FEG on the lower time frame, then it's just gonna basically look like a lower time frame turtle soup, as I said. Now, the definition of an FEG is basically is a price gap between consecutive candles which suggest an imbalance in price action. But as I said before, it's basically a lower time frame turtle soup and a retracement profile. Now, let's move on to the most important key levels, which are highs and lows. Now, highs and lows are some of the most important key levels in the hierarchy, and they have the top spot. And if you look at the charts, then you'd see that most of the expansions and reversals occur around significant highs and lows, and they're basically the key things and the key factor that moves the market, right? During a reversal profile, what happens is price swoops above a high and then it reverses straight away. Similarly, if even during expansion, price first of all takes out a low or a high and then takes liquidity before it continues, right? Now let's get into another slide. Okay, so here we got a chart, right? And on this chart, we're going to explain the anatomy of a price swing or a swing, right? So this is ideally how the market moves. Now it's not going to look sweet and short like this, but basically on an objective and mechanical level, these are the phases in a price swing, and this is what we also refer to as the sequence or TSQ as well. So what happens is that a price swing starts when the price takes out a significant low or a high. And in this case, we've got this low right here, and price swooped that low and it swooped it with this candle right here. Now, based on the definition of an order block, when such candle is engulfed, it becomes what? It becomes an order block. And here you can see the price closed above that candle that dug below the low, and it became an order block, a valid order block. After that, what happens is price retests it and expands from there. Similarly, when price is Similarly, when price closes above the high that broke the low, it becomes what? It becomes a breaker block. And then price tests that breaker block, finds support there and expands from there and continue its price swing. Then at the end, the way how price swing ends is also by a turtle soup. So price swing starts with a turtle soup and ends with a turtle soup, right? And once that ends, it then start another swing through those mechanics and dynamics. This is basically ideally how the market moves and swings. And you're gonna find this mechanic in every price swing. They might have variable looks, but the core concept will be the same, which is this one right here. Now that was it for key levels in chapter 2. Now we're going to move on to chapter 3. In chapter 3, we're going to discuss how we can use key levels and integrate it with market profiles to expect and anticipate expansion and reversals with a high accuracy and precision, right? This is one of the most important chapters till now, and you should carefully watch this one and make as much note as you possibly can. We're going to be using proper rational and sound logic to profile price on the charts in conjunction with key levels. Similarly, we're going to see what are the different combination and different outcomes for key levels and market profiles when combined with each other. Now, the integration of profiles and key levels would act as a major filter for us to avoid lower probability market condition. Now,
Our job as a trader is to only trade high probability and high quality trades throughout the week, which only form like 2 to 3 times, and the rest of the time our job and our objective is avoiding lower probability condition and waiting for our setups patiently, right? Now you've heard it from me before and I'll say it again. The important part about trading is waiting for your setup. And more than 90% more than 90% of the time, all you would be doing is just waiting patiently for your setup to form, and then you're gonna execute it. And that doesn't take that much of your time. Most of your time is spent on waiting on the charts and not doing anything stupid in between trades. And that's where market profiling and key levels come in, right? That's where you would need a filter that could make you avoid lower probability conditions. If you didn't have a filter, then all you'd be doing is trading every sort of market condition, and that wouldn't be profitable for you or work out for you. So most of the time you wait and then you execute only in high probability condition. So market profiles and key levels together will give you filters. Similarly, you're going to avoid trading certain combinations of market profiles and key levels and trade others, right? Now, last but not least, we're going to use these two together to expect or anticipate other market profiles, right? These are the main things that we're going to be learning in this chapter. Now, the first combination we've got here is the combination of ranging market profile and key levels, right? Now, what you need to keep in mind is this line right here represents key levels on the higher time frame, okay? So whenever you see this dotted line right here, it would represent a key level on the higher time frame. Now, there are only two possible outcomes or two possible combinations or scenarios we can have based on this combination of ranging profile and key level. The first one is when price forms a range and the ranging profile ends without testing a key level, right? Now, this key level could be in the form of an order block, a breaker block, or maybe a high and a low, right? That doesn't matter, right? What matters is the logic behind it. Now, the first scenario is when price forms a range above a key level, and you can see it right here that the ranging profile has ended without any key level tested, and that key level isn't tested in the ranging profile, right? So in that case, we're going to expect what? We're going to expect a manipulation profile to form, and that manipulation profile will test that key level. And once that key level is tested during the manipulation profile and that ends, right, we're going to wait for that manipulation profile to end, and then the only profile we can expect after a manipulation profile is what? Is an expansion profile in the opposite direction, right? So that was the first scenario we can have based on combination of ranging profile and key levels. On the other hand, the second scenario is when price forms the range inside a key level, meaning the key level has already been tested inside the ranging profile, and in that case the market profile that we're going to expect is an expansion profile without any manipulation profile in between, right? Now, and the other one we expected a manipulation profile because, as I said, the key level wasn't tested, and price first had to test a key level as a catalyst for it to expand higher. That's why we expected a manipulation profile. But in this case, we already have tested a key level in the ranging profile, so there is no need for a manipulation to occur. Here we can straight away expect an expansion profile, right? So you're seeing that we are using a proper sound logic here, and we aren't pattern trading it, right? You see that we are using if and then logic, right? So these were the combination of ranging profiles and key level. Now we're going to discuss another combination. Now let's discuss the combinations of expansion profiles and key levels. Now what you need to know is that this chapter right here that we're discussing is related to the first one. So first of all, you should watch that one first, so that way you know what are the different possible outcomes for price after a certain market profile ends, right? So right here you can see that the first scenario based on the combination of expansion profile and key levels is when the expansion profile ends inside a key level, meaning we've tested the key level in the expansion move. And in that case, we're going to expect a reversal profile straight away because a key level has already been tested, and that key level is going to act as a catalyst for expansion in the form of a reversal profile. Now, based on the first chapter, we learned that the only outcomes after an expansion profiles are a ranging profile, a retracement profile, and a reversal profile. Now that we've combined it with key levels, we can see that we can cross out the ranging and retracement profile and only expect a reversal profile in this case because a key level has been tested, right? So you can see that we are adding filters to our understanding and our understanding of market profiles. So before we could have expected three possible outcomes, and now we brought it down to a single one based on market profiling in key levels, right? Now the second scenario is when the expansion profile ends before it tests a key level, and in that case we're going to expect a reversal profile. We're not going to expect a reversal profile straight away because a key level hasn't yet been tested. So in this case, what we're going to expect, that we're going to expect either a retracement profile or a ranging profile. In this case, we've got a ranging profile, and then we go back again to the first combination of ranging profile and key levels. And in this case, ranging profile hasn't tested the key level. So what we're going to expect, we're going to expect a manipulation profile, right? So that a key level is tested, and then after that we're going to expect an expansion. So you can see here we are using again proper logic and sound logic to expect or anticipate market profiles based on the combination of profiling and key levels. If the expansion profile has tested key level in the form of if the expansion profile has tested key level in the form of an order block or breaker block or whatever, then we're going to expect a reversal profile straight away. But if it hasn't tested any key levels, then we're going to expect a ranging profile, and then use the same logic over and over again to expect other profiles and profiles the market. Now the third scenario is when expansion profile doesn't test a key level, but then after it has a retracement profile, and then after that retracement profile we can expect another expansion towards that key level, right? Now in this case the second expansion has now tested a key level, so what we're going to expect, we're going to expect a reversal profile, right? Because that expansion profile has tested a key level, right? Are you liking it so far? Now let's move on to the another combination of market profiles and key levels, and that is the combination of reversal profiles and key levels, right? Now in this case we've got two key levels right here, one above and one below. Now first of all you can see that we were inside of our range, and then we had an expansion profile, and that expansion profile tested a key level. So what we're gonna do, we're gonna expect and anticipate a reversal profile straight away. And this case that reversal profile ends, and then it ends inside a key level, right? You can see that this reversal profile has ended inside a key level. So in that case we're going to expect a range to form there because the reversal profile has now ended, and now we can expect a range to form to cap the price swing. Similarly, in scenario 2, the reversal profile ends without testing a key level. So that in that case we're going to expect what? We're going to expect a retracement profile to form because a key level hasn't been tested yet, and the drawn liquidity is still in play and still above, which is the key level above, and we're going to expect first a retracement profile and then an expansion higher again, right? So these were the combinations and outcomes we can have when integrating reversal profile in key levels. Now let's discuss some more intricacies and details of market profiles and key levels. Okay, so first of all, as I said before, this integration of market profiles and key level is going to be used as a filter for us to expect certain outcomes and avoid certain combinations, right? Now we're going to only trade expansions and reversal profile, as I said in chapter 1, and we're going to avoid trading retracement profile, manipulation profile, and ranging profile. Now you can trade these profiles too, and I'll teach them to you in later months, but for the sake of efficiency and for the sake of time being, what you need to remember is that only to trade expansions and reversal, because those are the only profiles that offers the most accurate and precise price swings, right? So for example, if a manipulation profile ends, then you can trade the next profile because you know that the only possible outcome after a manipulation profile is an expansion, and you can trade that expansion, right? Similarly, If an expansion profile ends inside a key level, then you can trade the next profile too, because you know that after an expansion profile ends inside a key level, you can expect a reversal profile there and you can take a reversal trade there. That's how you're going to be anticipating market profiles and trading them. Now let's discuss some combinations and outcomes of market profiles again, right? So here we got a format, right? The first variable in this equation represents the last profile that has ended, and the second variable represents a presence of a key level and whether a key level has been tested or not, or whether it's present or not, right? And then combining them together gives us a possible outcome, which is the constant of this equation. So here in this we can see that if the last profile that has ended as an expansion profile and it ends before testing a key level and a key level hasn't been tested yet and a key level isn't present, then we're gonna expect what? We're gonna expect either a retracement or ranging profile, and we're gonna avoid trading them because we only trade what? We only trade expansion and reversal profiles. Similarly, if the expansion profile is ended inside a key level and a key level is present there, then we're going to expect a reversal profile there. And as I said before, we're going to trade that because it's a reversal profile. Similarly, we've got other combinations below as well that can potentially refine your understanding even further, right? Now, these aren't the only combination, we've got others too, but these are the most important one, and you must note them down and remember them to improve your understanding. Now let's move on to another slide, right? Now here I'd be giving you a proper framework around time frame selection and how you can integrate market profiles with key levels, and what you need to know is that you won't be using the same time frame for both concepts. You'd be using higher time frame for finding key levels and then the lower time frames for profiling in market profile. You'd be using time frame alignment for deciding the different times for both, right? Down here you can see some combinations of time frame elements and how you can use them. So if you're an intraday trader, then you're going to be using the 4 hour for finding key levels and the 15-minute for profiling the market. Similarly, for scalping, M15 or the 15-minute time frame is going to be used for key levels and the 1 minute time frame is going to be used for profiling. This is the framework that you're going to be using to integrate key levels with market profiles in a logical manner. My objective in CPI here is to teach you how to use all of these concepts in a logical manner instead of looking at it with a perspective that is predominantly based on patterns, right? Yes, I know that patterns don't work, and what work in this market is logic and narrative, and this is what I'm teaching you at the moment. And this is what I taught you so far. Alright, let's get into the charts now and let me explain market profiles and key levels to you on them, right? Now, as I said before, we're going to be using time frame alignment to decide our time frames, and as I'm an intraday trader, that's why I'm going to be using time frame alignment and using 4 hour to find my key levels, and then I'm going to be using the 15-minute to find to market profile for market profiling. So the 4 hour for finding key levels and then the 15-minute for market profiling, and that's how we're going to integrate them with each other, right? Now I'm going to study in this now we're gonna study and discuss the price action of the last 3 to 4 days, and we're gonna see how we could have used market profiles and key levels to potentially trade that price action, and how you could have seen it with a different perspective than what you have right now currently, right? So we're gonna obviously start off with key opening times right here, and you know that the daily candle opens and closes during the 17 Eastern time or the 5 p.m. Eastern time. So we're gonna start off with right here, and right here you can see that we could use a key level either in the form of an order block, right? We can use them order block, we could use a breaker block, an FVG, or a high and low, right? These are the key levels that we can use and find on the 4 hour to integrate it with market profiles and potentially generate trade ideas, right? Now this right here you can see that on Wednesday what happened is that we had this expansion below, right? These three consecutive dawn candles expanded below, and it did what? It took out this swing low right here, this 4-hour swing low right here. Now we're gonna look at the price action on the intraday charts and see how we could have used market profiles to trade it, right? Now, as I said in the first chapter, after price opens right here is 17 Eastern time or 5 p.m. Eastern time, right? It straight away goes into what? It goes into a ranging profile, and that's exactly what happened here. Price opened right here and it straight away went into a ranging profile, and the reason why price straight away goes into a ranging profile is due to the fact that the Asian range starts, and on the major currencies like euro and pound dollar, um, the liquidity is quite low at that time, and the algorithm tends to range during that time, right? Then after that ranging profile ends, what we have is that we have this expansion right here after a ranging profile ends. Then we have this kind of small retracement down here, but after that retracement ends, we have this another huge expansion. And with this expansion right here, what we did is we also closed inside a key level, and this expansion move tested a key level, and this expansion profile ended inside a key level. And based on what I've taught you so far in the video, after an expansion profile ends inside a key level and tests a key level, the next profile that we can expect is what? We can expect a reversal profile straight away, and that's exactly what happened here. You can see that after this expansion ended inside this key level, we reversed from here, and price straight away went into a reversal profile, right? You could have traded this reversal profile and this reversal expansion right here based on this factor right here. So we match this 4-hour key level in the form of this low right here with this market profile in the form of an expansion, and expected this reversal right here. Now we're gonna move on to the next day and see how we could have traded that, right? Now on Thursday we can see right here that on Wednesday we had taken out this low. Now after price takes out a low, the next target for us becomes the opposing of the range, right? So if price takes out one side of the range, we're gonna then take out the another side of the range, and so here's the 50% of the range, and here we got this side, and then the opposing end of the range is this one right here. So based on range trading and range profile, I'm going to teach you this in the later chapters, and we're going to see that after price takes out one side of the range, then our drawn liquidity becomes 50% of the range, and then the opposing end of the range. This is how basically range trading works in a nutshell, right? We're going to learn about them, and we still have to learn a lot before we move on to the other chapters, and I can assure you that you're going to learn this in the best, in the most accurate way possible. But first let's get in the chapter and discuss how we could have traded this price action right here, right? Now on Thursday what happened is that obviously we already had taken out this low on Wednesday, and price went straight into a reversal profile right here. Now on Thursday, and also as I said that we've got this key level right here as a drawn liquidity as a key level for us to punish a trade or market profile, right? Now you can see that again price opened right here and went straight away into a reversal profile, into a ranging profile, sorry. So after price opened right here, it straight away went into a ranging profile, right? And then after ranging profile, it had an expansion. Then we had this retracement right here, and after a retracement profile ends, the only possible outcome we can have is an expansion higher, and we had this expansion right here, right? Now the unique thing in the what can we say, the unique thing about this expansion profile is that it also took out this range high, right? This range high and swing high in the which is our 4-hour key level, and this expansion profile ended inside a key level and tested a key level. So what that means is now you can expect what? You can expect a reversal profile, right? And that's exactly what happened. After price with this expansion tested this key level right here, this 4-hour range high, and closed inside of it and tested it in this expansion, we're now gonna expect a reversal profile from here. Now if let's say if price hadn't closed inside that key level and hadn't took out that high right here, for example like this, and the expansion profile had ended there, then we would have expected a range and then a manipulation and then an expansion down. But in this case, the expansion profile tested the key level, so we then straight away expected a reversal profile from here, right? Now this is the Friday's price action right here. Now this is a homework for you, and you should study it on the 4 hour and the 15 minute. Tell me how you could have traded it with market profiles, and how you could have integrated market profiles on the 15 minute and key levels on the 4 hour to to have a unique and a dynamic and a mechanical and objective perspective, right? This is a homework for you. You should send it to me. Now let me discuss this price section right here as well, right? Now let's remove all of this right here. So we've got this range low, this range high, but also this range high as well, right? Now this is Monday right here, and price opened with this huge opening gap right here, and it opened after this 17 Eastern time or 5 p.m. Eastern time, right? Now again, based on the same logic as I said before in the first chapter, price straight away goes into what? It goes into a ranging profile. And then after ranging profile, it has one possible outcome, which is an expansion or a manipulation. In this case, we had an expansion, right? Now the unique thing about this expansion again is that with this expansion, what we did is we took out another key level, which is in the form of this 4 hour swing high or range high, and this expansion tested a key level. So after that, what can we expect? We can expect a reversal, right? So you can see here that we are using proper logic here. We started with the range, then an expansion, then this expansion tested a key level, and after that expansion profile ended, we had a reversal profile, right? This is how you could use market profiles and key levels and integrate them with each other to have a dynamic, objective, and a unique perspective of the charts. And you're going to be using time frame alignment for that.
Alright, hello everyone, welcome to chapter 4 in 5 of CPI. Now, in these chapters, we'll discuss time frame alignment and time frame selection. It's one of the least talked about and at the same time one of the most important topic. No one really talks about it or gives it that much significance, but when it comes to CRT or ICT trading, it's one of the key concepts that leads to a logical trading framework. Without the correct time frame alignment and time frame selection, you won't be analyzing the charts with an optimal performance, right? No matter how good other parts of your technical analysis are. Therefore, you must know about the correct time frame alignments and time frame selection and use them in the correct manner, both logically and conceptually. So, in these chapters, I'll make sure to cover everything about time frame alignment and time frame selection that there exist. And after watching this video, you won't have any confusion left about time frame alignment, right? Now, the reason why CRT works so good and has such an unbelievable amount of accuracy and precision is because of this concept right here. All these other concepts work cohesively together because of time frame alignment. It's actually this concept right here which inherently integrates all these other concepts and make them meaningful and rational. Okay, so let's get in the video now. So the first thing that we're going to discuss is time frame selection, right? Now with this concept, you're going to get to know what every higher time frame is used for and what is the purpose of every higher time frame, right? That way you can use these higher time frames in the most efficient way possible and use it in a way that suits your style and your mental capabilities the best, right? So inside higher time frames, the first one we've got is the monthly chart, right? Or the monthly higher time frame. Now, the monthly time frame inherently is used for position trading, right? Position trading is the type of trading where you trade ranges on the monthly time frame. But as we all know, it takes a whole month to form just a single candle on the monthly time frame, right? And you know, most of us don't have the ability to wait for that longer for our setups to form, right? And you would have to wait for years for your setup to form. So the monthly time frame is just for position trading, but that doesn't mean that we as an intraday traders or swing traders aren't going to use the monthly time frame. We're still going to use it to farm a higher time frame directional bias or to have a better understanding of what price could potentially do in the future and what is the higher time frame telling us, right? We're going to still use the monthly time frame even though it's used for position trading, so we can have a better perspective of what the market is trying to tell us, right? Now we're going to delve on it later in the video, but let's get into the other types of trading. Now, position trading is mostly done by big institutions, hedge funds, or big firms who got a lot of money and their liquidity is pretty large, right? So their orders are mostly executed on the monthly chart or the monthly time frame because of spread, slippage, and all of these other things. But that's not our concern because we are retail traders and we're mostly either intraday traders, short-term traders, or swing traders. That's our main concern, right? Now, another hard time frame we've got is the weekly chart or the weekly time frame. Now, the weekly chart is inherently used for swing trading, and swing trades usually form either once or twice a month, and you're basically trading the weekly range or the range on the weekly time frame, right? But as I said before, even as an intraday trader, we're still going to use the weekly time frame to refine our buys and to determine a drawn liquidity on the higher time frame. We're going to first do that on the monthly time frame, and then we're going to refine that on the weekly time frame through a top-down approach through different concepts, and we're going to reach a conclusion regarding our directional buys that we're going to have as an intraday trader or short-term trader. Now, as I said, it doesn't necessarily mean we're going to strictly trade in that particular direction on the lower time frame, because on the lower time frame we can even have some counter trend trades that we can take. But for the most part, if you just stick to the direction of the weekly and the monthly time frame, then it will offer you only high probability trades, right? Now, you might be wondering, why am I telling you about all of this? But there's a proper logic behind it, right? And I'm going to discuss that in detail in just a minute. But before that, let's discuss the rest of the higher time frames. So the next one we've got is the daily chart. And if I'm being honest with you, it's one of my favorite higher time frame, right? And if I had to choose a single one, or if I had a gun to my head to choose a single time frame, that would be the daily chart or the daily time frame. Now, the reason why daily time frame is so important and has so much significance is due to the fact that it's a time frame which suits both intraday traders and short-term traders, right? Doesn't matter if you are a short-term swing trader or an intraday trader, the daily chart will offer you assistance in finding the correct drawn liquidity and the correct directional buys, right? And you're gonna do that with concepts like everyday data ranges, daily ranges, CRT, market profiles, and key levels, and so on, right? You're gonna use all of these concepts together and integrate them with each other in a logical framework that I've shown you. I've only shown you about market profile and key level till now, but in the next levels of CPI, we're going to discuss all of these concepts together, and in the same way I've taught you these concepts like market profiles and key levels, we're going to integrate all these other ones too in a logical framework with a if and then logic, right? And we're going to use them in a system to that they could help us in finding the correct drawn liquidity and the correct directional buys on the daily chart, right? We're going to do that later in CPI. Now, the daily time frame or daily chart is one of the most optimal time frame for intraday trading and short-term trading. Your job as an intraday trader is to trade the daily candles range, right? And try to position yourself and that particular directional bias and that particular drawn liquidity. Now, last but not least, we've got the 4-hour time frame, right? Now, for 4-hour time frame or less, it's used for intraday trading or scalping, right? Most of your analysis is going to be done on this time frame as an intraday trader. You're going to find your higher time frame key levels on this time frame. You will have to match your higher time frame key levels with the CRT on the 4-hour time frame, and most of your work is going to be done here. So your aim should be to get to know the 4-hour time frame as much as possible and as much as you can, and master all of its intricacies and all of its different subtle details. Now, another part of time frame selection is defining your model, right? Now, my job as a coach is to just explain each one of them to you and explain every one of them in detail so that you could get to know them better. And then it's your job to decide for yourself which approach or which trading style suits you the best, right? Now, I've already done my self evaluation and I already know myself that I've got a swift and quick and aggressive personality, and I can look at charts for longer, but I can't hold trades for longer. And the way how I got to know myself this way is by actually monitoring my performance and monitoring my behavior and my emotions when I'm holding trades for longer. And what I found out is that I can't actually manage my emotions when I'm holding trades for longer than a day or a week, and that messes up with my emotions and messes up with my performance. That's why I've got to know through hard work, through monitoring and through self-evaluation, that the style that suits my personality the best is intraday trading, which basically consists of holding trades for just a few hours, and that's the type of style that suits me the best, right? Now, that doesn't mean that those styles of trading don't work, or other style of trading like position trading, swing trading, or short-term trading don't work. I don't know how to trade them, but rather it's mostly due to the fact that my mental capability suits a different style of trading, which is intraday trading, right? Now, your job is to try out each one of these trading styles, right? Because if you don't try each one of them, then you wouldn't know how you behave when you're trading different styles of tradings, right? And then when you are trading these different styles of trading, like swing trading, short-term trading, position trading, scalping, and so on, what you're going to do is you're going to monitor your emotions and your psychological aspects and see which style of trading offers you the most optimal performance in terms of operating and following your model, right? Now, obviously, in the beginning, you're going to lose with all of these styles because losses are inevitable, and it's these losses which shapes you as a trader. But the point is to monitor your performance as an operator, right? And see how good you are able to follow your plan and stick your plan. And then you're going to compare these results with each other and stick to the one style that offers you the most optimal performance, right? That's your job as a trader. Now, that's something that no one really talks about, right? In trading, the psychological aspect of trading, which is rarely talked about, and that's why most traders lose in the first place and just give up because they don't know that trading isn't just about technicals. It's all about, now it's not all about, it's you got to have a balance between your risk management, your technical analysis, your technical aspect, and even your psychological aspect. You got to have a balance between all of them. And you, if you're just going to focus your attention on just a single one, like just technical analysis, then obviously you're not going to succeed with that. But if you focus all of your attention on just your psychological aspect and be ignorant to your technical knowledge, then obviously that won't also be end up good for you. That also won't end up good for you, right? So you as a trader must have a balance between all of them, and you have to focus on each one of these aspects for you to succeed as a trader and become consistently profitable. Now, that's the main reason why there are so many different courses. Like there are hundreds and thousands of good trading courses, and almost everyone has watched them, but people still suck at trading. And that's because they haven't yet found it out their style of trading or this approach of trading that suits their personality, right? And not even that, most of these traders haven't even diagnosed this problem, right? So imagine if you don't even know about the problem, then how the fuck are you going to solve that? The first step to solve a problem is to diagnose and identify that problem. And then solving is the easy part of it, right? But people are too stubborn and ignorant to do that because the narrative is that strategy is everything, a model is everything, and the solution to your problem is a new strategy, right? That's what narrative that they are using on Twitter and all of these other social media platforms. But the real thing is that you need to have a balance, as I said before. Now, don't get me wrong, if you don't have a proper system in a trading model, then obviously you don't have a single chance at succeeding. But also at the same time, you have to and you gotta look at your psychological mental parts too and focus on them as much as you focus on your technical parts of your trading. And if it was that easy and the solution was just technical analysis, then everyone would be profitable, right? But you know that's not the case. Not everyone is profitable. And once you realize this part, everything changes for you, right? Now let's get into the video. So the first one is a position trader who basically trades the monthly range, or the range is on the monthly time frame. And as I said before, only firms and hedge funds with huge amount of money, liquidity and capital, and huge firms have this style of trading. And you won't find a single retail trader having this approach. And the reason for that is simple. A position trader waits for months and even years for a setup to form, and obviously most of us just don't have that amount of patience or mental endurance, right? Now the second one is a swing trader. A swing trader trades the weekly range, and range is on the weekly chart or the weekly time frame, right? Now, typically for swing trader, their setup takes a few weeks to a few months to form, and then the average duration for their setup also ranges from a few weeks to a month, right, or a month or two. Now, this style of trading uh, works too, but this usually works best in expansion profiles on the weekly chart, and we know that most of the time price is in ranging profile, so that means you'll have to wait for a lot of time to wait for your setup to form and then to execute that setup as a swing trader, right? Another style of trading is short-term trading. A short-term trader trades the ranges on the daily chart. Now, the objective of a short-term trader is to trade the ranges on the daily chart inside a weekly range. And what I mean by that is that inside a weekly candle, we've got 5 daily candles, right? Meaning 5 days. So as a short-term trader, our job is to trade that weekly range on the daily chart and exploit that range. And as a short-term trader, you would be using the daily chart as your higher time frame, and you would be profiling in taking entries on the 1 hour time frame. That's how you're going to use the correct time frame alignment for short-term trading. So moving on, we've got day trading or intraday trading, right? An intraday trader trades the daily candles range, right? Now remember, there's a difference between the two. A short-term trader trades ranges, like complete ranges on the daily chart, whereas an intraday trader or day trader just trades the daily candles range, like a single candles range, right? That's what I'm talking about here. So your job as an intraday trader would be to trade that daily candle range on a daily basis, and your entries and exits would be within a day. So you won't hold any trades overnight or over the weekends, and your job would be to get in and get out on a daily basis inside of a single day. That's what we call intraday trading, and that's my personal approach to trading. Now, another form of trading, which is an aggressive type, is scalping. A scalper trades the hourly range on the 5 minute time frame or the 1 minute time frame, right? Scalping is a really aggressive type of trading, and the margin of profitability for scalping is pretty small as compared to the other types, right? And it's an advanced type of trading that you need to be pretty quick with your execution and your thought process and in your analysis, right? It's also something you could definitely try and see whether it suits you or not, right? But as I said before, the margin of profitability is quite smaller, comparatively speaking. Now, in scalping, the average trade duration ranges from a few minutes to an hour or two. So these were the higher time frames and their purpose and objectives and what they are used for. And along with that, we also define the different styles and approaches to trading and how they are done on a surface level. Now we're going to move on to another slide and discuss the higher time frame in more detail and what are the purpose that these higher time frames serve. So here we got a monthly time frame, right? And here I've chosen the small price action right here. Now it seems pretty small, but this price action was formed over a year and a half, and it has got a range of like 2000 pips, right? Now the monthly chart is the first one, and that you're gonna start analyzing with, right? It doesn't matter if you're a swing trader, a short-term trader, or any trader. You're gonna still start off with the monthly chart to find and determine your directional bias, and you're going to do that with different concepts which we'll discuss. But also at the same time, the monthly chart is going to give you conviction in your directional bias and your drawn liquidity. Now, the monthly chart is actually going to do a lot of assistance for your trading and your analysis, right? Obviously, the monthly chart moves extremely slow, but throughout CPI, you're going to see that the precision and accuracy that I have has had to do a lot with the direction that's derived from the price action on the monthly chart. The monthly chart is our basis for our trading and our top-down analysis. We start right with the monthly chart and find a particular drawn liquidity or direction which we further refine on the lower time frame, such as the weekly or the daily. We're comparatively speaking, right? If we compare weekly and daily to the monthly time frame, then obviously they are lower time frame. But in the grand scheme of things, comparing them with the hourly or the 15-minute time frame, obviously they're higher time frame. So everything is relative. There's nothing absolute, right? You have to remember that. Now, as I said before, I'm not a long-term position trader because I tend to change my mind a lot, and I got like an aggressive and swift personality, so I'm more suitable for intraday trading and not position trading, because I know that I can't hold trades for much longer, and I tend to fuck up if I hold it, right? That's why most of my entries are intraday trades or day trades, and the average duration of them tends to be between 4 to 5 hours, right? This is the thing that no one really talks about in trading. You gotta find a style of trading that suits you the best. For instance, you might see someone who's actually a really good swing trader and holds onto position for weeks and is profitable. And let's say he teaches you his strategy, right? Now that doesn't mean you're gonna be profitable with it too, because your personality might be different than his. Your mental capacity and your mental capabilities might be different, and it's your job to evaluate yourself, get to know yourself, and really dig deeper into who you are and what kind of behavior and attitude you have, and what is the approach to training that suits you the best. The only person that could do that for you is you and no one else, and you're gonna do that by actually taking trades and journaling your thoughts and your psychological aspect and seeing whether it's causing issues for you or not, or whether you are comfortable with the mental capacity or not, right? Now, the different concept that you're gonna use to analyze the monthly charts in order to come to a conclusion about the directional bias that you're gonna trade are concepts such as quarterly shifts, seasonal tendencies, dealing ranges, key level CRT, and so on, right? Now, quarterly shifts and seasonal tendency are gonna help you build a narrative, and you're gonna use these other concepts to build a directional bias and frame a trade idea. Now, we still have yet to discuss all these other concepts in detail, but I'm just giving an introduction to them here. And throughout the next levels of CPI, we'll discuss how you can use these concepts to assist you in your higher time frame analysis. Now, as an intraday trader, you're not going to necessarily trade in the direction of the monthly directional buys, right, or drawn liquidity. You're still going to trade setups in the counter direction, because we all know that the markets never move in a straight line, right? And it always has ranging profiles and retracements before it reaches its targets, right? So that means, let's say we've got a certain drawn liquidity on the monthly chart that we're looking at, right? Now obviously it's going to take a weeks for price to reach there, and throughout this time price is going to be in different market profiles in the lower time frame. We're going to have retracement, we're going to have ranging profiles, and then expansions, right? We're going to have different market profiles towards that direction. Now the retracement profiles on the higher time frame are still tradable on the lower time frame, and you can counter trade them because on the lower time frame they'll be logically looked at as expansions or reversals, right? So that means inside of a higher time frame expansion there are multiple lower time frame retracement ranges or reversals profiles, right? The higher time frame market profile is made up of multiple and various lower time frame profiles consisting of various types of it, right? We're going to discuss such advanced market profiles in terms of time frame alignment too in further chapter, so you can have a better and dynamic perspective to it, right? So the idea is to And the idea is that on the monthly time frame, you're going to use these concepts to build a directional buys, and then your long-term directional buys and on liquidity would be exactly that. And you're going to stick to that unless there is a change in market dynamics or price action on the lower time frame that tells you otherwise, right? You could also use this as a filter to manage your risk too. For example, if you find an intraday setup or a short-term setup in the directional of the monthly directional buys, then you could regard that setup as an A plus setup or a high probability setup. But if it's in the counter direction, you could comparatively regard that setup as a setup or a lower probability setup, and you could then still trade that setup, but you're gonna just manage your risk on that particular trade accordingly, right? That's exactly how I manage my risk on my intraday setups too. Now let's discuss some price action here on the monthly chart. Now we know that there are different protocols and intricacies for finding and selecting CRT correctly, right? And then using that CRT correctly. But on a fundamental level, the idea is that every single candle is a range, and every single candle can be treated as a range on its own, right? That's like the main statement of candle range theory. Now, when one side of a CRT range or a typical range is purged, our drawn liquidity become the opposing sides, right? Now, we're not going to discuss the different protocols here because we're discussing time frame alignment, and that's a topic for another day. But we're going to keep that fundamental principle of CRT in mind, and we're going to look at this price action right here with that particular perspective. Now, obviously, you need to remember that if you were analyzing this price action in real time, then you would be using all those other concepts as well that I mentioned earlier, and use them together to reach a conclusion or to determine a directional bias. But for the sake of simplicity, we're just going to look at it with a fundamental basic level CRT perspective, because we haven't yet discussed all those other concepts yet. So once we discuss them and explain them, right? Once I explain them to you in the later chapters, then we're going to integrate it with these principles right here, and we're going to look at it with a logical framework. But for now, this is what we are going to be working with, right? Now we know that when price engulfs a candle, that particular candle becomes a key level for us, and price use that price action for future reference to react off of, right? Now keeping these two principles in mind, let's look at this price action. So starting off here, we can see the price took out this candle's low right here, and then it closed above and inside that candle's range. So now when price takes a candle's low and then closes inside just before taking out the opposing end of the range, what happens is, starting with the next candle is open, our buys and our drawn liquidity becomes the opposing end of that range, and we started looking at that high is our drawn liquidity and our buys, right? Now in this case right here, you can see the price eventually took this high and closed above. So you can see that for this particular monthly candle right here, for the whole month you would have had a bullish directional buys because the drawn liquidity is high, and for this particular month you would be looking for longs, particularly on a short-term trading basis, right, and day trading basis. Now as I said before, you're not just gonna necessarily look for just long or bullish trade, but counter trades too. But the directional priority would have been bullish for you during this month, right? Because the drawn liquidity is high. Now we know we've got like 20 trading days in each month if we exclude bank holidays and other days like NFP and CPI, because we're not gonna trade them, right? So when we exclude those days, you would have 20 trading days to look for longs and potentially exploit this directional buys on the monthly time frame, right? Now you could see that this monthly candle closed above inside this candle right here, right? Now we know that when price closed above a candle's range, what happened is that particular candle is then used for price as a key level to be tested and for price to react off of, right? That's a basic idea of a key level. Now keeping that in mind, when the next monthly candle opens here, what would you be expecting is for price to first of all retrace to the open or the high of this candle right here. So it means your directional buys for the first half of the month would be bearish. So and you would be expecting bearish prices until this candle is open or high is tested, and then your directional buys would again become bullish because now you know that price can find support here and expand higher. So you can see here we are using logic here again and looking at it with a dynamic and logical perspective, right? Now, moving on to the next monthly candle, you can see that we've already tested the previous candle's open as a key level to react off of, and now our directional bias is to expand higher and potentially make another higher high, right? So with the start of the next monthly candles open, you would be expecting higher prices because candles has closed above, and your directional bias would be bullish for the next monthly candle. Similarly, that would be the case for you for the next candle too. And then using the same principle, you see that this was the first time price closed inside a candle's range, right? You can see it right here, and formed a huge wick. And you know what that means? It means that price has now shown bearish signs because first of all, it closed inside the candle for the first time since 3 months, right? Since 3 monthly candles. And second of all, it formed this huge wick, which is a bearish sign because wicks represent bearish signs, right? Or lack of energy or momentum. So based on these factors, you would then, for the next monthly candle and the next month, you would expect bearish prices, and your directional bias would be bearish and lower. Similarly, again, you can see right here that this candle closed below the open of that candle. And based on the definition of an order block, when such candle which takes out liquidity and takes out a CRT high or a high or test a key level, and then such candle when it gets engulfed, it becomes what? It becomes a bearish order block, right? So with that in mind, with the next monthly candles open, we would start looking for that candle to be retested, and then we would look for price to expand lower from there, and our buys and our drawn liquidity would be towards this monthly candles range lower CRT low right here, and you can see price exactly did that. Similarly, with each monthly candle, you're going to look at it with the same logical perspective and principles, and you're going to determine your directional buys for the month, and that will assist you in your trading, and that would be really helpful for you. That's going to increase your accuracy and precision by a huge margin, right? If you analyze the monthly price action. Now remember, we are just using only two logical principles right here to analyze the price action and the monthly chart, right, in this video, and we haven't even used the other concepts yet, and still it works so good. Now imagine when you learn about the other concepts and you integrate those ones with this logical framework. Now imagine how much it will assist you in finding a directional bias on the higher time frame, on the monthly time frame, right? That's the power of CRT and a logical framework, right? That's what's happened when you look at price action with a logical perspective instead of a perspective that is predominantly based around patterns. Because I know, everyone knows, everyone that is profitable knows that patterns don't work. What works is finding a correct narrative through a conceptual and contextual logic, and then having a framework that is based on logic, and then framing trade ideas through the help of those aspects, right? That's how successful and profitable trading works. Now I'm analyzing this price action right here with only these two principles because we haven't yet learned and discussed the other concepts yet, right? But as we move on to the next levels of CPI, we're going to start learning about those other concepts, and we're going to start integrating those concepts with these logical principles right here in a logical framework, right? Now again, moving on to the next price section, we can see again the next candle opened and formed a ranging candle and closed inside this big bulky candle right here and formed a wick too, right? Now again, another interesting thing is that this candle right here also tested the original candle that we started off, right? So this monthly candle was a ranging candle. It closed inside, which shows bullish signs, right? And it also formed a wick, which enhances the bullish scenario even more because a wick represent lack of momentum, lack of energy. In this case, it's representing bullish signs because we've closed inside and we formed a wick, right? So based on these factors right here, You're going to start looking for bullish trades as soon as the next month's candle is open, and your directional buys would be bullish, right? And your drawn liquidity would be this high right here, right? Now, as a homework for you, I want you to tell me how you would analyze and reverse this price action right here with the same logic. You're going to use the same logic, and make sure to send it to me, and I'll give you my feedback on it and whether it's correct or whether it's wrong, right? So that was it for the monthly chart. You saw how you're going to use this monthly chart to assist you in finding a particular directional buys, and how you're going to use monthly chart to find your buys and drawn liquidity, right? We've just discussed basic level technical knowledge right here, but this alone is more than enough to assist you for the time being, right? And moving on, we'll integrate other concepts and logics with it too. Now let's move on to the weekly chart and look at that same price action with the weekly charts perspective. So you can see that these significant highs and lows right here, where price made these reversals and these expansions, these highs and lows are the monthly CRT highs and low that I just showed you before, right? Now right here you can see that it's the monthly candle, right? And price purged this low with this candle, and then it closed above and inside of this range right here. So for the next weekly candle open, you would be expecting higher prices till the opposing range high is taken, which is this high right here. And you can see right here, for the next few weeks, we kept pushing higher, and our directional buys for the time being was bullish. Then after price action closed above this high right here, this high became a key level for us, because this high led to taking out liquidity, right? And now price is going to use this high as a key level and tests it and expand from here. Such high are called what? They are either called mitigation block or breaker block, right? So for the next week, you're going to expect price to retrace to this key level and then find support there and expand from there. Now remember, each one of these is a weekly candle, right? So you can see that you've got 5 trading days inside each weekly candle to trade, right? And you've already found your monthly's directional buys, and now you've refined it even more on the weekly candle, and now you're gonna trade on those 5 days and that particular directional buys that you've determined or that you found through this analysis right here, right? And you can see right here, if your logic and narrative was correct, you would be right for all these weekly candles, and your buys and your drawn liquidity would be better than most traders, and you would have had a better precision and accuracy in terms of directional buys than anything else, right? Now trading them on the lower time frame is a different topic in itself, and we're going to discuss that. But in terms of directional buys, you would have a really high precision and accuracy if you determined and if you use these price action right here in this way on the higher time frames, right? Now again right here, looking at this price action, you can see that once we tested this key level right here and retraced to this key level, for the next week we would expect bullish candles and bullish prices in the opposite direction, and we would look for price to expand from here, right? Now with this candle right here, you can see that price expanded higher, and then with this expansion above and closed above this candle. Now what that means is, now we can use this candle as a support or a key level, and price is going to test that and expand higher from here, because we know that close above represent bullish prices and close below represent bearish prices, right? Similarly, again, when price closed above this high, again it again tested and formed this FVG and then filled that FVG and expanded high. Then what happened? We formed this monthly CRT, we went above and then reversed from that and closed inside that CRT. So our directional buys would then become bearish towards the monthly CRT low, which is this low right here. So you can see, again, using the same logic over and over again, you can see the rest of the price action here again with that perspective, right? Now, I'm 100% sure that you are already looking at this price action with a different perspective, right? Than what you had before when you started this chapter, right? And that's the exact purpose of these chapters, to make sure to explain these complex and advanced concepts in such a way, in such a simple way that everyone understands it, right? That's my goal with these chapters. Now, as I said before, the daily chart is mostly used by short-term traders and intraday traders, right? And you're going to use the same concept here again to analyze this price action and reach a conclusion regarding your directional buys for the day. You're going to refine all that analysis that you've done on the monthly and the weekly chart and refine it down to the daily chart, right? And use it to assist you in finding a directional buys, right? Or a drawn liquidity. Now you can see there's a logical process and framework for how you're going to do that. And I'll even make a separate chapter for that. But for now, I'm just explaining the purpose of every different higher time frame here, right? And you just saw it yourself. We're going to use concepts like CRT, dealing ranges, CRT market structure, order flow, EBITDA data ranges, weekly profiles, market profiles, and so on to analyze price action on the higher time frames such as the weekly, the monthly, or the daily chart, and then reach a conclusion. Now, your purpose as an intraday trader would be to determine your directional buys for the day and then trade in that particular direction, right? And predict and anticipate where the daily candle is potentially headed to or where it's going to potentially close, right? That's your aim as a trader. Now, these were all the different functions of each higher time frame ranging from the monthly down to the daily time frame, right? What you should do is note all of these down and note all of its characteristics that I just told you about, and then remember what is the purpose of each time frame and what is the purpose that each time frame serve, right? Next one we've got is time frame alignment, right? As I said before, it's one of the most important concepts when it comes to CRT or ICT trading, right? And the way how CRT and all of these other concepts work so accurately and precisely is due to the correct integration of them through time frame alignment, right? So if you don't know how to align time frames correctly, then you wouldn't be able to integrate these concepts together in the most accurate way possible, right? So in order to learn how to integrate these concepts together, you must know about the correct time frame alignments and the correct combinations of time frame alignments. So let's discuss time frame alignment. So for each style of trading, there's going to be three main active time frames and other passive time frames, right? Now it doesn't mean that these are going to be the only one you're going to use. You're going to still use other higher time frames too, but on a basic level, you should stick to these main active time frames, right? If you're a beginner. Now we've got the higher time frame, the intermediate time frame, and last but not least, the lower time frame. Now the higher time frame is going to be used for two functions: for finding CRT and for finding key levels, and then merging them together and integrating them together. That's what the higher time frame is going to be used for. Then we've got the intermediate time frame, on which we'll determine structure and order flow. And structure is basically seeing whether price is breaking highs and rejecting lows, or it's rejecting highs and breaking lows. That's what we call structure on a fundamental level. We're going to discuss structure in detail too in other chapters, but on a fundamental level, that's what we regard structure as, right? Then we've got the lower time frame, which will be used for two functions: for profiling the market, meaning using market profiles to expect or anticipate other profiles, and then using the lower time frames for taking entries and finding entry setups. That's where you're going to execute your trades on. So these are going to be the three main time frame we'll use for our particular side of trading. Now let's discuss some different time frame elements for different style of tradings, right? So the first one we've got is swing trading, right? So for swing trading, our higher time frame will be the monthly chart or the monthly time frame, and we're going to use it for two functions which I mentioned before, which is marking out key levels and finding CRT. And then we've got the daily time frame, which will be our intermediate time frame, and we're going to use it for determining structure and order flow, right, through different concepts. And then last but not least, we'll be profiling the market and finding entries on the 4-hour time frame, which will be our lower time frame for swing trading, right? So for swing trading, these are the main time frame that they'll use to accurately and correctly do a top-down analysis, right? This is how you're going to do your top-down analysis as a swing trader. And next one we've got is short-term trading, right? And for short-term trading, we've got weekly is the higher time frame. We're going to use the weekly chart to finding key levels and finding CRT and then matching them together. And then we've got the 4-hour time frame as our intermediate time frame to determine structure correctly. Now, one thing you need to remember is that we're not talking about conventional market structure here, right? And conventional market structure shifts because those things don't work. We're going to determine market structure in a complete different manner with a logical framework, which we'll learn that in a different chapter. But for the time being, let's discuss time frame elements for now. So the 4-hour for structure, and then we've got the 1-hour time frame for our lower time frame entries and profiling, right? Next one we've got is intraday trading. This is my personal style of trading and this is how I trade, right? Now I don't want to force a certain style of trading on you, and as I said before, you should find your style of trading on your own by experiencing each style of trading and self-evaluation, right? So that's up to you. So for intraday trading, we've got the daily and the 4-hour time frame is our higher time frame. I specifically use the 4-hour as my higher time frame, but when price action is not clear, then you can use the daily time frame as an alternative too. So you could see the bigger picture. Then we've got the 1-hour time frame for structure. It's our intermediate time frame. And then last but not least, our lower time frame for entries and profiling the markets is the 15-minute time frame, right? Now, what you need to remember is that even as an intraday trader, you still are going to use and analyze the monthly chart, the weekly chart, and the daily chart, because that's going to provide you with a higher time frame perspective and a higher time frame directional bias. But your main time frames as an intraday trader will be these three ones right here, right? Then last but not least, we've got scalping. And for that style of trading, the correct time frame elements are the following. You can read it right here. So moving on, here is a graphical representation of how time frame alignment looks like. So we've got the three main time frame, which are the higher time frame, lower time frame, the intermediate time frame, right? So again, remembering the purpose of each one, you could see that the higher time frame will be used for two functions: marking out key levels and finding CRT, and then matching them and integrating them together. Then you'll use the lower time frame for determining structure in gaining conviction in your analysis, and then the lower time frame which will be used for, you guessed it right, profiling and entry setups, right? You're gonna use all these time frame and a logical framework with each other and gain insights into a better understanding of the market through this approach, right? Now let's say we are scalpers, so for us the higher time frame will be the 15-minute, intermediate would be the 5-minute, and the lower time frame would be the 1-minute time frame. That's how you're gonna use them. Now let's go over some charts and let me give you some example of time frame elements. So I'll give you an example of time frame elements of intraday trading, right? So let's start off with that. So you're gonna do all of your higher time frame analysis and determine your directional buys on the monthly time frame, the weekly, and the daily time frame, right? And then come down to the 4-hour time frame and refine all of that analysis down to the 4-hour time frame to frame a trade idea either towards that directional buys or counter to that directional buys, and manage your risk accordingly based on those factors. So the main higher time frame for intraday trading is the 4-hour, right? Here we would be finding our key level, right? And also we would be matching that key level with a CRT, and then we would move on to the intermediate time frame to determine structure and add the time factors to it. And then last but not least, we will take our lower time frame entry and based off of the profiling, right? So right here on the 4-hour, you can see that we've taken out this high right here in the form of our key level, right? If you've been watching my trade breakdowns, then you'd know that I took an entry here, right? And you'd know exactly why I took an entry here and why did I expect price to retrace from here. But for the lazy one that haven't watched it yet, let me explain it to you. So what happened here is we had this expansion once this range low was taken, right? And now we know that once range low is taken, our drawn liquidity becomes the 50% of that range, and then eventually the opposing at end of that range, right? Now before we move on and expand higher again to take out the opposing end of the range, we have to have a retracement first, because that's how price moves, right? Price doesn't move in a straight line. Even if the drawn liquidity is higher, price is still gonna have these retracement before it eventually moves higher and takes out the range high. And the second factor is that we've taken out an inside range high during the New York kill zone, and the New York kill zone and the London close kill zone, and such scenarios tend to be either reversals or retracement, right? That's why I expected price to retrace from here on the daily basis, right? So in this case, I expected a retracement on the higher time frame, which is going to be a reversal on the lower time frame, right? So for that, I try to first match it with a key level on the higher time frame 4 hour, which is this high right here, right? And second, we have this CRT, which I matched with this key level, and the two function that I was supposed to do on the 4 hour time frame were done and finished, right? That was my higher time frame thought process. Then I moved on to the intermediate time frame to determine structure and also add time factors to it, right? And so look at the price action with a more refined perspective. So here on the 1 hour time frame, you can see that if we add the opening times, right, here the 17 Eastern opening time and then the closing time, you can see that we had a ranging profile straight away after price opened, and then an expansion, and with this expansion right here we took out these equal highs, and we did that during the second half of the day. Now based on structure, even if our higher time frame draws liquidity is higher, we still can expect price to retrace before moving higher. Now there is a lot more intricacies and details into structure which we'll discuss, but this is what the thought process for this day right here was, and this is how I gained conviction in my trade idea. Then I moved on to the 15-minute time frame for profiling and entry setup. So let's move on to the 15-minute time frame. On the 15-minute, you can see that you can see these different profiles here, right? We've got this ranging profile, then this expansion profile, then this retracement profile before expanding higher again. And with this expansion profile right here, the last one, we tested a key level in the form of a 4-hour inside range high. Now based on market profile and the key level integration, the only possible outcome after price test a key level with an expansion move, the only possible outcome after that is a reversal profile, right? So based on these factors, I expected a reversal, but obviously I couldn't just short right away, right? I had to first wait for a confirmation and wait for my entry model, which is basically a model 1 entry which formed right here, and I traded that. This is how you use time frame alignments in the correct way, and in this video I explained the different time frame alignments. I explained how you can use the correct time frames for your trading, for your style of trading. I explained different style of trading to you. I explained and defined different models to you, right? What are the different styles of trading? This was chapter 4 and 5. Hope you've enjoyed it. Hope you've made notes, because that's how you learn as a trader and you evolve as a trader, right? Thank you.
SilkRoad5.com. Buy or sell for free.
Hello everyone, welcome to the Trade Breakdown on EU. In today's video, we'll be breaking down 2 trades, and I'll also be showing you the answers to the test that I gave you yesterday. Now, as we all know, we learned about market profiles and key levels this past 2 weeks, right? And I gave you a logical framework for it and showed you how you can look at these concepts with a logical perspective. But it doesn't end there. You also need to be shown how you can apply these concepts in the live markets. And that's where these breakdowns come in. You're going to see how I use that knowledge to form trade ideas. And I'm going to show it to you in these breakdowns. That's the main purpose of these breakdowns, right? Now, these two concepts weren't the only one that led to this idea, but they certainly did play a huge role in it. So I'll be making sure to explain these trades based on these concepts. I'd also touch on the other ones too, but the predominant focus is going to be these two concepts, right? Now, I'll be showing you what was my higher time frame thought process behind these two trades and what were the factors that led to this trade idea. So let's get in the breakdown. Now, we're gonna start off with the daily time frame because that's where I found my buys and determined my drawn liquidity. And then I refined them down to the 4-hour time frame and framed a trade idea there, right? Now, on the daily chart, you can see right here that we've got these equal lows right here. And what we did is took out these lows right here with this candle, right? Now, based on the rules of range trading, we know that when one side of the range is purged, our drawn liquidity becomes the opposing 50% of the range and eventually the opposing end of the range, right? This is basically how range trading works in a nutshell. Now, after one extreme of the range was purged right here, what happened is that over the next 2 to 3 days, we closed above the candle that purged the low. And basically the candle that had purged the low got engulfed, right? Now, based on the definition of an order block, which I told you in chapter 2, when such a candle gets engulfed, it becomes a valid order block for us, right? Now, you can see right here that the week or the weekly candle opened right here with this opening gap. And on Monday, we formed this ranging candle right here, just above this order block that we formed newly, right? Now, we know that our drawn liquidity is higher, which is this range high right here, right? So based on that logic and framework, we can potentially use this Monday's candle as a CRT and match it with this key level right here in the form of an order block and wait for it to be purged during Tuesday and then use this CRT's high as a drawn liquidity for us on the lower time frames for the rest of the week, right? And you can see right here that is exactly what price did. It purged this low, tested this key level, this order block, right? And then over the next 2 days, it started its journey towards the opposing end of the CRT, which is the Monday CRT's high, right? Now, that being said, let's move on to the 4-hour time frame and see what was my thought process there. So, on the 4-hour, you can see right here that we purged this Monday CRT on Tuesday and then immediately reversed from there and closed inside the CRT range. Now you could have traded this 4-hour CRT on the lower time frame as well and could have potentially exploited it, but that's not the topic for today. Now, what we are dealing with in this video is the price action on Wednesday, right? Now, let me first of all put on the opening and closing times for the daily candle so we can see what we are dealing with, right? So, you can see Monday formed the CRT range, right? You can see the opening closing times. And then on Tuesday, we purged that CRT range low and closed inside, right? And also tested a key level on Tuesday, which is like the main factor for us. Now, on Wednesday, we can expect the price action to take out the opposing end of the CRT. Basically, expecting the Wednesday candle to take out the opposing end of the CRT, right? That's what I expected on Wednesday. But obviously, as we all know, we can't just take an entry right away, right? First, we have to position ourselves towards that drawn liquidity with a CRT. And as an intraday trader, that CRT for us would be on the 4-hour time frame. Now, you can see right here that the Wednesday's candle opened right here and straight away went into a ranging profile with these candles. You could probably see it too. These two candles right here are comparatively smaller than the other expansion candles, which clearly means that on the lower time frame price was inside of a ranging profile. Now, also you can see this price action right here. These consecutive candle down close candles together purged the Monday CRT low on Tuesday, right? And then price closed above these candles in the later price action, right? Now we can use these candles together as a single order block too and use it as a key level. Now the refined version of this order block would be this candle right here because this was the exact candle that purged the low.
But based on a logical framework, we can see that these consecutive down close candles together took out the Monday CRT low, and then price closed above them, right? So this price section right here can be used as a key level too. Now the idea and logic behind key level isn't based on pattern or anything, right? The main reason we use such price section as key levels and then we've named them all these different names is because such price section have led to either taking out liquidity, generating liquidity, or filling liquidity, right? And that's exactly why price uses such price action for future reference and test it and expand from there, right? And that's what we call key levels. Any price action that have led to either taking out a liquidity, generating liquidity, or filling liquidity will always be used for future reference. And just for the sake of simplicity, we call such price action key levels, and we've named them all these different names. For example, if you take an order block is basically a candle that have taken out liquidity, meaning it has a proper narrative behind it. This candle right here has taken out liquidity, so we can use it for future reference, and price can use it for future reference to find support and then expand from there. Similarly, if we take the example of a breaker block, then a breaker block is basically the high that have taken out the low, meaning it has taken out liquidity. So again, price could potentially use that high as a future reference for price to find support and expand from, and we call such high a breaker block. Even when it comes to an FVG is just basically a price gap between consecutive candles, meaning they've generated liquidity on the lower time frame, right? And again, as I said before, price can use such price action for future reference and then turtle soup that FVG and price and find support there, right? That's basically the idea and the logic behind key levels and why they are so important. Now enough with that, let's get into the breakdown. So you can see that this is the higher time frame key level for us, right? And also right here in this condensed price section right here, you can see that these two candles closed above the key level without testing it, which means they've generated liquidity and we can use them as a CRT because they've generated liquidity above a key level. Now let's go down to the 15-minute time frame and see what we've got there. Right here you can see that after opening time we straight away went into this ranging profile right here, and this price section right here is the price section of the first 2 4-hour candles of the day, and these 4-hour candles closed right here just above the key level and didn't test the key level, right? We saw that on the higher time frame. Now based on market profiles in key levels, we can see that we formed a range just above a key level, and the only two possible outcomes for price after a ranging profile are either an expansion profile or a manipulation profile. But you have to remember one thing, that if we hadn't done all that higher time frame analysis, right, if we hadn't determined our buys and drawn liquidity on the higher time frame, then we wouldn't know to which side or which particular direction this expansion or manipulation is going to happen. The expansion could happen to the upside or it could happen to the downside, right? It could have happened to either of the side and we wouldn't have a single idea about that, and we would be just randomly guessing the direction. But that's not the case for us, and you know why? Because we already determined our drawn liquidity on the higher time frame, on the 4-hour and on the daily time frame, and we have a clear direction, right, towards which the price is drawn to, and that is the Monday CRT high on the higher time frame. So based on the higher time frame analysis that we did before, we already know what our higher time frame drawn liquidity is, which gave us a bias, which gave us a level that we can look at as our draw for price, or towards which price is going to be drawn in the future. So based on that logic, right, we are going to exclude the downside or the bearish scenarios because price is drawn towards the upside and the drawn liquidity for us is higher. So we're going to remove the bearish biases and the bearish scenarios and only work with the bullish ones, right? Now we are left with another problem again. We know that we can have two possible outcomes after a ranging profile, right? And those are expansion and manipulation profile. Now again, if we hadn't done that higher time frame analysis, then we wouldn't know which profile to expect. Should we expect an expansion profile or a manipulation profile, right? We know that our drawn liquidity is higher, but another problem is that which profile to expect, right? We can have two possible outcomes. So what are we going to do in this case here, right? But again, that's not a problem for us because we did our higher time frame analysis and we drew this key level on the 4-hour time frame in the form of an order block. And on the lower time frame, we can see that price didn't tested that key level, right? And formed the range just above that. So using the same logic over again, right? We know that if price is going to expand higher, first it has to test a key level, right? So based on that logic, we're going to exclude the idea of expecting an expansion profile right away because we haven't yet tested any key level whatsoever. So therefore, we're going to expect a manipulation profile first so that price tests a key level, and then after that, the only possible outcome for us is going to be an expansion profile in the opposite direction, right? Now, you just said yourself, we had multiple scenarios that we could have had and expected, but through the help of a logical framework with the help of market profiles and key levels and the help of higher time frame analysis, we use a rational logic to weed out or exclude the lower probability or the unlikely scenarios. And at the end, we were left with only one scenario, that is the manipulation profile into a key level and then an expansion higher. That's what I'm preaching here. Using a logical framework instead of randomly guessing scenarios out of nothing, right? And that's exactly our aim as a trader should be. Our aim is to use logic to exclude other unlikely and low probability scenarios and only trade the ones that are high probability and the ones that are based on proper logic, right? You're gonna hear me use the word logic over and over again in this CPI because of how important it is, right? Now, right here you can see that we had a manipulation profile after the ranging profile ended, and then right after that we formed this order block right here on the 15-minute time frame, which basically gave me a confirmation that this manipulation profile is about to end, and now we can potentially position ourselves towards that drawn liquidity and trade it higher. And then I took an entry right here at this order block and rode it higher. And right after that, we had an expansion profile towards the drawn liquidity. Now, again, the expansion profile ended here, and we got into this ranging profile again. Now, remember our drawn liquidity is still higher, which is the Monday CRT high, right? So we can now again look for an entry on the lower time frame towards that drawn liquidity and position ourselves. Now, after a ranging profile, we all know that we can have two possible outcomes, which are either an expansion right away or a manipulation profile, right? So we're going to use the same logic to see what are we going to end up with at the end, right? But before we do that, let me remind you of TSQ again. We know that inside of a CRT range, we have a sequence of moves after one side of a CRT is purged and before the drawn liquidity is reached. And those sequence of moves are an order block entry, a breaker block entry, an OTE, and the last but not least, we've got the case of death or KOD, which is basically the last move or the last turtle soup before the drawn liquidity or the opposing end of the CRT is purged or reached. Now, one thing about KODs or case of death entries are that they are one of the highest probability moves inside of a CRT range or inside the sequence of TSQ. So whenever you see a KOD, you can potentially regard that as a high probability scenario for yourself, and you can trade that with the right framework and context, right? And right here you can see that we're just about to take this opposing CRT range, but before that we form this ranging profile. But we don't know whether we're going to have a manipulation profile first or an expansion profile right away. So for that, we're going to use the logic of key levels and market profiles again. So right here, you can see that with this ranging profile, we already tested a key level, which is this breaker block right here, or this CRT high on the 4-hour time frame. Let me show you. This candle's high on the lower time frame is basically a breaker, right? And we can use that as a key level. Now, one thing you need to remember is that we've already tested an important higher time frame key level with this manipulation profile right here and tested that order block, that 4-hour order block. And now with this second ranging profile, we can only at least expect it to test a lower time frame key level, and then we can expect an expansion profile. And in this case, we've done exactly that. This ranging profile tested the breaker block, and also along with that we had this last turtle soup right here, and after that we can start to expect an expansion here. And you can see right here that we had an expansion after this ranging profile. And the reason we didn't had a manipulation profile is because this ranging profile had already tested a key level, so there was no need for any manipulation profile to happen, and we can just straight away expect an expansion profile right away, right? And the way how I took an entry here is I waited for a model 1 entry, which is this entry right here. This is the candle that dug below this low, and then I waited for it to be tested, and then I took an entry here. So that was it for the trade breakdown for you. I hope you've liked it. This week's chapter is going to be about time frame alignment and time frame selection, and those chapters will cover and clear all of your confusion about time frames and the different styles of trading. Now I need one thing from you, and that is for you to tell me whether you like these breakdowns or not, right? Because I want to see and read your reviews of it and see whether you are taking it seriously or not. You can also feel free to send me suggestions about these breakdowns in my DMs, and I'll make sure to read them and even apply them, right? Now, starting with next week, I'm going to start accepting payments for the next month's subscription of CPI. Obviously, if you wish to continue. Next month, we're going to have some really hot topics. We're going to move on to the level 2 of CPI, and we're going to refine this knowledge even more and start adding other important concepts and theories too. So payment for the next month start next week, and you'll have only 5 days to submit the payments. Otherwise you'd be kicked out. Crystal clear, 5 days, right? You can send your receipts and screenshot of the payment to my personal DMs, and once you're verified, you'll be led into the next level of CPI. Thank you. Hello everyone, welcome to Trade Breakdown on EU. Now, if you haven't watched the trade breakdown before this on gold, then make sure to watch that one first, because I've explained some really important things in that one, right? And make sure to make notes of that. Alright, let's get into the breakdown. So first of all, we're going to start off with the weekly time frame and the daily time frame to do 3 things, right? We're going to use these time frames to first of all determine our higher time frame drawn liquidity, right? We're going to use them to determine our higher time frame buys, and then last but not least, we're going to use them to build a narrative for us, and then we're going to refine them down to the 4-hour time frame and look for a trade idea there, right? And we're going to match it with a key level in a CRT on the 4-hour time frame. So starting off with the weekly time frame right here, you can see that since last few weeks I was expecting higher prices, right? We had formed this weekly CRT, and once this was purged right here and price closed above, my drawn liquidity after that was then higher, and I've been expecting and anticipating higher prices until this drawn liquidity is reached. Now right here you can see that we finally reached this drawn liquidity and we've taken out this range high. Now at the moment we are in a unique position, right? We now have to determine where price could potentially head towards this particular week, right? One thing you need to remember is that once a drawn liquidity is reached, you don't start looking for a reversal straight away, right? You should never do that. The only scenario in which you're going to expect a reversal once drawn liquidity is reached, right, is if the higher time frame monthly and weekly time frame is backing it up with at least 2 to 3 concepts like key levels, market profiles, and etc., right? That's the only time you should expect reversal, and there has to be a clear logical framework behind it, right? And there also must be a lower time frame confirmation, right?
But in most cases, once drawn liquidity is reached and price takes out a significant opposing end of the range, your objective is to first of all just to expect a retracement, not a reversal but just a retracement, right? That's what you should expect first. So right here you can see that we've taken out the range high. Now I will expect a retracement before we could either move higher or we could reverse completely, right? Now that's a topic, that's another topic in itself. But after you expect a retracement, you're then gonna analyze the lower time frame price action and see whether we can turn this retracement profile into a reversal profile, or whether we're gonna continue higher and expand higher, right? That you're gonna conclude that based on the lower time frame price action and lower time frame confirmation. Now, but as I said before in the beginning, retracement profile is what you will expect, right? Retracement profile is the one that you're going to expect once a drawn liquidity is reached or a significant range high or range low is reached, right? And then that retracement could either turn into a reversal or maybe an expansion profile, right? Now I'm going to go down to the daily time frame and we're going to see what we've got there. So right here you can see that this Friday's candle, right, closed just below this range high, and then this candle right here, it was purged on Monday, and also with that it also tested a key level in the form of taking out a weekly range high, right? So this candle right here will now become a CRT for us, right? And our objective once it's purged and our objective once it's purged will be to first of all target the 50% of the CRT and then eventually the opposing end. But the first target is always going to be the 50% of the CRT range, right? Now you can see that we've determined our drawn liquidity on the weekly and the daily time frame, right? On the weekly time frame, we expect a retracement profile, right, which gave us a bearish scenario, and on the daily time frame we've got this bearish CRT and we are targeting 50% of this CRT right here. So our drawn liquidity based on the higher time frame analysis is bearish, right? Our bias is bearish, and similarly we also build a narrative for our trade idea here on the higher time frame, right? Now I'm going to go down to the 4-hour time frame to find a CRT there and then position myself toward this higher time frame drawn liquidity and take a trade there. So right here, let me first put the weekly opening and closing times right here. Okay. So on the 4-hour right here, you can see that after this weekly open, we straight away went into this expansion profile, right? And with this expansion profile, we also tested a key level in the form of weekly range high and Monday's CRT high, right? Now, based on market profiles, we know that when expansion profiles test a key level, the next likely market profile is going to be a reversal profile, right? Now, obviously, we can't just expect or anticipate a reversal profile right away. We first have to match it with the CRT and look for a lower time frame confirmation that now that the expansion profile has ended, and now we can start looking for a reversal profile. That's how we're going to do that, right? Now here you can see that this 1 a.m. big bulky candle right here, right, and price purged it, and also with it it tested a key level, right? Now we can use this candle as a CRT and look for entries on the lower time frame. Now if we go to the 15-minute time frame, you'd see that it actually offered a short trade, but then price went above and took out the stop loss, and this trade turned out to be a losing trade. But that's completely normal, and our narrative and our drawn liquidity and trade framework is still in place, right? Here on the 15-minute, you can see that it was purged right here, and then we had this USD occur which formed this model 1 entry, and then price eventually took out the stop loss and this trade lost. But as I said before, the framework is still in place, and you could still look for a new trade and exploit the narrative that we had built on the higher time frame. Now I'm going to be completely honest with you, right, and keep it completely real with you right here. You need to remember that you're gonna have losing trades and you're gonna lose trades, right? Even with CRT, it's not like it's gonna offer you 100% or a 90% win rate, right? It never works that way. And anyone who claims to have a win rate higher than 80% with any strategy or system is full of shit, right? Trading isn't about the wins and losses, but rather it's a game of probabilities and being content with what you get from the markets. Now, if a single loss or even multiple losses or even a losing streak messes up with your psychology and you started panicking out, then first of all, you got to work on your psychology, because without a proper mindset and without a proper way of thinking, you cannot succeed in the first place. The way you can actually do it and solve that problem is by gathering as much data as possible, right, regarding your model, and then live testing that model as much as you can and being confident in that strategy, and also being aware of the losses and treating them as part of the game and treating them as an inevitable part of the game, right? That's how you should think about losses. And moreover, you need to think in terms of probabilities and be aware of the relationship between win rate and risk to reward ratio. Now, when you are aware of the distribution of losses and wins, and you are aware of the relationship between win rate and RRH, risk to reward ratio, then you would never panic, right? And losses will never mess up with your head. For example, if you have a win rate of 50% with a risk to reward ratio of an average 3R, and you are fully aware of it and you're confident in your strategy, then you would know that even if you lose 10 out of 20 trades, you'd still be in profits, right? Because of the risk to reward ratio edge. And you will start treating these losses as a business cost or an opportunity cost rather than actually treating them like actual losses, right? For example, right here you can see that the first trade was a loss, but then it offered another one right here, which offered another 3R, which means not only it recovered the first loss, but also made us another 2R profits. That's the magic, and that's the magic of RR, right? Now let's say you weren't that confident in your system and you didn't had a proper mindset, right? Then in that case, when you had your first class, you would have started panicking out, and maybe you could have missed the second trade and ended the day with losses instead of profits, only if you had just followed your plan and had been confident in it, right? And you need to be aware that you got to think in terms of probabilities and focus on the long-term horizon rather than the short-term profits. You're gonna have times where you will have losing days or even losing weeks, but when you got the right mindset, right, they won't mess with you, right? Those losing days and losing weeks or even months won't mess up with your head, and you'll stay unfazed, still following your plan without a doubt, right? Okay, that was enough with the psychology shit. Let's get the breakdown again. Okay, so we can see that the first trade was a loss, right? But as I said before, the narrative in the trade framework is still in place, and we can start looking for another trade, right? You can start looking for another trade towards that drawn liquidity. Now, I did not took this first trade right here because I wasn't on the charts and somehow I missed it. But just know that if I was on the charts and if I had seen this opportunity, then I would have definitely taken it, right? I wouldn't have missed it, and it would have been a good loss for me. You know why? Because I would know that I had followed my plan, and that's all that matters to me. I don't care about the losses or the P&L. My objective is following my trading plan and not caring about the outcome and just following my plan, right? But today or yesterday I wasn't on the chart, so I missed this trade right here. But remember, if I was on the charts and I had seen this opportunity, then I would have taken it, right? You need to remember that. So right here you can see that with the next candle is open, it took out this candle's high, but one thing is that this particular candle right here never closed above this CRT, but rather it closed inside, which increases the odds even more, right? Because if this candle has closed above this CRT, then I wouldn't have had that much conviction in it, right? And I would have stayed away from taking another trade, right, after the loss. But right here it closed inside, which showed bearish signs. So even after first loss, I still looked out for another trade because of the bearish signs, right? So once this high was purged, I went to the 15-minute time frame, and right here on the 15-minute time frame we can see that this candle was purged during the London close scan zone, right? And we know that the London close scan zone is a really good time in macro for reversal. So with that in mind, I had more conviction in this trade idea. So once it offered a model one entry right here with this USD, and with this candle closed below that candle, I took an entry here, right? And you can see we reached the drawn liquidity, and this trade turned out to be a winner, right? This was the trade breakdown on EU. Hello everyone, welcome to chapter 6. This chapter is going to be about dealing ranges, expansion swings, and how we're going to combine them with concepts such as market profiles and key levels. We're going to continue making and integrating these concepts together in logical framework that we've been doing since the first chapters of CPI. Explaining each of these concepts individually and explaining their intricacies is one thing, but then integrating all of these concepts together to create a proper logical framework is a different phenomena. You may have even learned about these concepts before, but I know you're still struggling with how you can actually integrate them all and create a proper framework. That's where you lack proper knowledge, and my objective is to fill that gap and to make sure you know how to actually integrate them and use it in your trading system. Now, other people don't talk about these things, maybe because they don't want to teach you the right things, right? But I doubt that's the case. I believe the reason they don't talk about these things is because they don't know about it, right? That's what I think is the case for majority of these so-called gurus. Now, let's get in the chapter. So, this chapter I'm going to explain everything that there exists about dealing ranges, right? So, first of all, we're going to start off with the definition of dealing range and what actually is a dealing range and how we can identify a dealing range. So basically, when price takes out both swing low and swing high, right, and has an expansion swing, that particular swing is considered a dealing range. Basically, when you see a move in the market where price takes out both opposing end of the ranges and takes out both sell side liquidity and buy side liquidity, and then it expands, that particular swing is considered a dealing range, right? You might be wondering what's the importance and significance of dealing ranges and why should we be familiar with dealing ranges, right? Well, I'm going to delve on that later in this chapter, but first of all, you need to know how to correctly identify and find a dealing range on the higher time frame and how to correctly draw it out. Now, another thing about dealing ranges is that when you divide a dealing range to equal halves, it gives us a matrix. The upper half of that matrix is called the premium, and the lower half is considered a discount, right, or the discount region. Then last but not least, the 50% of that dealing range is called equilibrium. This is basically how a dealing range looks and works. A dealing range is formed after price takes out both sides of a range and expands, and when that swing is divided into two halves, it gives us a dealing range with discount and premium regions, which we can potentially use for making better trading decisions, or they can assist us in our higher time frame analysis and thought process. Now, another thing about dealing ranges, right? Dealing ranges are similar to PDRA metrics, right? Or let's say it's a type of PDRA metrics, right? Now, it's not just a typical type, right? It's a specific type of a PDRA matrix, which is for those type of swings which takes out both swing low and swing high, right? That's what we call a dealing range, and when it is divided into two halves with premium and discount, it gives us a whole framework on the higher time frame which we can use which we can integrate with market profiles on the lower time frame. Now, I hope that part about dealing ranges is clear to you, and if it isn't, you can watch and listen to this again and it will clear your confusions. Now let's move over to the next slide and discuss dealing ranges and PDRA metrics. Now here on the screen you can see this range, right, with this line in the middle. This line right here in the middle represents the equilibrium or the midpoint of this range. And then above this midpoint we've got the premium region, and the lower half right here is our discount region. Now what you need to remember is that inside this dealing range or this PDRA matrix we will have multiple key levels, right? And these key levels will be both in the premium region and the discount region. Now these key levels could be in the form of order blocks, breaker blocks, rejection blocks, fair value gaps, or maybe even in the form of highs and lows. Now this dealing range or PDRA matrix will be used to filter out key levels, right? And will be used to choose or select the correct key level based on market condition that we are in. For example, if we are in a bullish market, then our main priority or concern will be the key levels inside the discount region or near the equilibrium, rather than the key levels inside the whole range or inside the premium. Similarly, if the market structure in order flow is bearish, then our main focus would be on the key levels inside the premium regions instead of the ones that are in the discount. So now you can see that we've added a logical objective filter to the key levels that we're going to be dealing with. That's why it's called a dealing range. If we didn't have this filter or this PDRA matrix, then we would be selecting every random key level inside this range. But now thanks to this concept, we've added a filter and we've literally excluded half of the key levels based on PDRA matrix and based on the market conditions that we are dealing with. Now, the reason why we use this dealing range in PDRA matrix is pretty simple. It can be explained through market profiles. Now, we know that according to market profiles, price never moves in a straight line up or down, right? Now, based on that, we know that the way how price actually really moves is in ranges, expansions, and retracement, right? Now, with that in mind, we have to determine what is the correctly key level and how to correctly select a key level that we can match with these different market profiles on the lower time frames, and how we can actually measure and gauge the different retracement profiles on the higher time frame. And for us to in order to do that, we're going to use these dealing ranges and PDRA metrics, which will gives us a filter to weed out the unlikely and the lower probability conditions and scenarios, and we will be only left with the ones that are high probability. And our job as a trader is to stick with those scenarios and avoid the others. Now you're going to have times where price will play out the lower probability scenarios, but your job is to not be intimidated by it, right? And be content with missing those moves and just following your plan no matter what. You should never be influenced by recency bias, right? That's a disaster for your trading and your analysis. If you're always after the new best thing and you always fall victim to the shiny object syndrome, right? Then you wouldn't be able to succeed in trading because you can't stick to one thing. That's why you need to have confidence in your system, and even if you miss moves, even if you lose trade, you must still have the confidence in your system and never let recency bias mess up with your head. That's the quality that separates the best traders from the losing ones. You must remember that at all times. Now, when I explain this whole chapter to you, you will have a proper filter and a proper logical framework in your hand, with which you will be able to catch high quality or high probability moves in the market. And if you consistently stick to those principles and those rules, right, with discipline, it is going to completely change your trading. But there is a huge but. The thing is that you will also sometimes see moves in the markets where price will not respect a dealing range, right, and just breaks out of it without doing the right thing which is supposed to do, right? It's gonna do those things sometimes, right? And your job would be to classify those moves as lower probability moves and just let them play out without influencing your thoughts or your thought process, and just be content with missing them, because after all they are lower probability moves and your job is only to catch the ones that are high probability, right? And that gives you an edge over the markets, right? So that's how you will have to think about these things. I get many DMs from students saying, why did this not work, or why did I miss this move? And the plain and simple answer to that is basically how that's how the market moves. That's how the market works. You're gonna miss moves, you're gonna lose trades, but then at the same time, if you stick to the right things, you will also win trades, and those wins will make sure you end up profitable in the long term, right? That's what trading is all about. You should never adjust or change your system or influence your thoughts based on short-term results, right? Or small track record of data. You have to think in terms of the long horizon and be content with your system at all times, right? Hope that is crystal clear to you. Now let's move on to the next slide and let's discuss dealing ranges in a bullish market or in a bullish scenario. So here you can see we've got this range low and range high right here, right? You can clearly see what happened here is that first of all we took out the range low, right? And then we went above to take out the range high, and then we closed above it. Now when this swing ends and stops, that gives us a dealing range right here. This whole range of price taking out the range low or the swing low and then taking out the range high gives us a dealing range, and when this is divided into two halves, it gives us the premium and discount region. Now as I said before, the case study that we are analyzing here is in a bullish market condition, right? Which means that the structure is bullish, or maybe the order flow is bullish, right? So now we're going to explain what price often does in such market condition when price forms this sort of dealing range. So right here with this expansion swing, or when this swing ends, it forms this swing high. We know that according to market profiles, we're going to retrace, right, before moving higher again. Now let's say there are multiple key levels both in the upper region and in the lower region, right? Meaning both in the premium and the discount region. Now you're going to be confused with whether which key level to choose and whether what's going to happen at each key level on the lower time frame. Now in order to clear those confusion and be more familiar with the market dynamics, we're going to use this dealing range and PDRA matrix, right? And divide this range into two halves with discount and premium, which also means that now the key levels have also been classified into two groups. So we've got the discount key levels, meaning the key levels that are in the discount region, and then the premium key levels which are in the upper half of this dealing range. Now based on that, if you're on a bullish market, our main focus and our main concern is going to be the key levels that lies in the discount region, because the market makers or the algo or whoever the fuck is moving the markets prefers to retrace price to the discount or the equilibrium of this whole dealing range to buy at a cheaper price before moving higher or continuing higher. That's how price usually moves. Similarly, in a case of a bearish market condition or bearish order flow, the algo or the market maker tends to retrace price to a premium region or to a key level inside the premium or near the equilibrium before moving lower, because they want to sell at an expensive or a premium price that will offer them more profits, right? Because their main objective is profits. And that's the basic analogy and thought process behind it, right? Now it doesn't matter who moves the market or who does this stuff, but what you need to be familiar with is why it does it and that it does actually happen. And if you are familiar with it, you can then exploit this and turn it to an edge for yourself over the markets, right? So let's sum it up again. In a bullish market condition, after a swing ends, price usually tends to retrace price to a discount key level before moving higher or expanding higher again. That's what happens. Now let's move on to our dealing range for bearish market conditions, right? So in case of a bearish dealing range, price will tend to retrace price to a premium key level or to the equilibrium of this whole dealing range before moving lower, as you can see in the graphics. That's what happens in a bearish market condition or inside a bearish dealing range. Now let's further discuss how we're going to combine and integrate dealing ranges with market profiles and key levels, right? So first of all, in order to do that, we're going to use the correct time frame alignment and use them all in a proper manner.
You must watch the chapters before this to be familiar with the integration of market profiles in key levels and also the correct combination of time frame alignment and how time frame alignment is used, right? You must be familiar with that. So for integrating dealing ranges and market profiles, first of all, we'll use time frame alignment, right? So the way how it will work is that you're going to use the higher time frame for your trading style, and that will be used for identifying and selecting the dealing ranges or the expansion swings, and then you'll have a lower time frame which will be used for profiling or market profiles, right? Let me say it again. You will have a higher time frame for dealing ranges or selecting dealing ranges and finding key levels, and then a lower time frame for market profiles and profiling the markets or profiling the price movements, right? These will be the two main time frames you're going to use to properly integrate these concepts together, and you can use the time frame selections for it, right? That's how you're going to use them. Remember that, right? Now you might be wondering what's the importance of dealing range and PDRM metrics and how it can assist us in our analysis and in our trading, right? So here is the list of some of the things that dealing ranges and PDRM metrics will help us with, right? So first of all, the most important of all, dealing ranges are used as a filter, right? It will be used for filtering out key levels, right, and market profiles. Similarly, dealing ranges would be used to build a higher time frame narrative for your analysis, and you could use it to assist you in filtering your drawn liquidity and your buys. Dealing ranges are used to filter out your targets, right? You could even use it for that purpose as well. You will learn how you're going to do this in the later part of this chapter, but you must remember that you could use it for this purpose as well. Then last but not least, it will also be used for managing risk based on filtering, right? These are some of the things that dealing ranges will help you with, right? Let's move on to the next slide. So here we're going to discuss different case scenarios for dealing ranges and market profiles, right? The first one we've got here is the different scenarios for bullish order flow, bullish market conditions, or when the drawn liquidity is higher, right? So first one we've got here is when the market condition is bullish and price forms a bullish dealing range, and then price on the higher time frame retraces back to a premium key level, right, with a lower time frame expansion, right? Hear it again. Price on the higher time frame retraces back to a premium key level with a lower time frame expansion, right? In such scenario, the possible outcome for price would be a retracement profile on the lower time frame, not on the higher time frame, but a retracement profile on the lower time frame. That's what you will expect in this scenario. Similarly, another scenario is when price on the higher time frame retraces back to a discount key level inside a higher time frame bullish dealing range with a lower time frame expansion profile, right? And in that case, the possible outcome for price and the most likely outcome for price is a reversal on the lower time frame and an expansion on the higher time frame towards the drawn liquidity, right? Remember, lower time frame reversals and a higher time frame expansion, right? You need to look at it with a dynamic top-down perspective, right? You should be able to look at it with a dynamic perspective. Now, let's look at some graphical representation of the different scenarios, right, that we've got. So, considering the drawn liquidity is bullish and the market condition is bullish, and we're combining it with this higher time frame dealing range and the lower time frame market profiles. As I said before, it will be based on time frame alignments, right? So here you can see that we've got this high and this low right here. And what happens is that first we take out the low, right? And then we take out the swing high right here. Now with these two purges, we form this dealing range, right? Now dividing this whole range into two halves gives us a discount and a premium, right? And there are different key levels inside of this whole range, right? Both in the discount and the premium. And these key levels inside both regions will be classified accordingly. Now remember what I told you before about market profiles and dealing ranges, right? So
once this swing high ends right here, you can see that price will then have to retrace on the higher time frame to a key level, and then we will see how it reacts to that different key level inside both the premium and the discount on the lower time frame in case of a bullish market condition. One thing you must remember is that these key levels are on the higher time frame, right? Just as the dealing ranges are on the higher time frame. But the market profiles that we will discuss and that we will be discussing would be on the lower time frame. So don't confuse the two between, right? Don't confuse both of them with each other. One is on the higher time frame and the other one is on the lower time frame. This whole dealing range and key level we are seeing, and this whole dealing range and key levels that we are seeing are on the higher time frame, where these profiles that you are seeing right here are a representation on the lower time frame, not on the higher time frame, but rather on the lower time frame, right? We are seeing what's happening on the lower time frame, right? I've just made it simple and plain for you on this graphical representation. Now you must remember that you must remember this while going through this chapter, right? So it doesn't confuse you at all. So now on the screen you can see this blue line, right? This blue line is representing a key level. Now this key level could either be in the form of a breaker block or any different key level, right? That doesn't make a difference, right? You just need to remember that this blue line right here represents a key level on the higher time frame. And also along with that, this key level, you can see that it's in the premium region. It's in the upper half of this region. Now, based on what I told you before, in a bullish market, price usually tends to retrace to a discount key level before moving higher. But in this case, we've only retraced back to a key level in the premium region on the higher time frame, right? So based on this, we are only going to expect a retracement on the lower time frame, right? And not a reversal, right? Or not a reversal on the lower time frame or an expansion on the higher time frame, right? Because we still have yet to retrace to a discount key level before we can move higher. Now there's going to be times where price expands straight away without testing a discount key level, right? But that's not a matter for us. What we need to remember is that more often than not, price will tend to definitely retrace to a discount, and that's what should matter to you. So let's see it again. We have this expansion on the lower time frame towards this key level, right? Which is in the premium region. And now based on the combination of this, the most likely outcome for price is a retracement, not a reversal, but a retracement. Now, if you remember the first few chapter, you would remember that I told you that when expansion profiles test a key level, the most likely outcome for price will be a reversal. But in this case, we've taken it further and we've made it more advanced. Now, even with a key level, we're just going to expect a retracement instead of a reversal, because we've combined it with higher time frame dealing ranges and higher time frame premium and discount, which have given us further filter to our understanding of price movements and markets, right? So you can see we've added a more advanced filter to it, and you're building an advanced narrative, because first you would have expected a reversal and price might have stopped you out, but now you would only expect a retracement, right? So then you could manage your risk appropriately on any trade in the key level that are in the premium region in case of a bullish market condition, and you could be a bit more cautious with your trades in such market conditions, right? So let's move on. Here you can see on the charts the most likely outcome of price, what price is going to most likely do after it tests a key level inside the premium. So here you can see that even with bullish order flow and bullish market structure, price tested a bullish key level, but it only offered a retracement at the lower time frame, and then on the lower time frame price expanded lower again towards a higher time frame discount key level, right? And then it expanded from there. Now for most of you, this would be a really important answer to most of your questions, right? I've received hundreds of DMs asking me why this particular key level only offered a small movement, and why did this key level worked, right? And this one didn't. And this right here is the answer to that question. You might have chosen the wrong range, or you might have chosen the wrong key levels, and maybe you didn't know about dealing ranges and premium and discount key levels, and maybe you were choosing the wrong key levels, right? That could be the problem for you. And now you've learned about dealing ranges, right? And now you know about how you're going to correctly identify and select a key level, and how you're going to be cautious around different key levels inside residing inside premium and discount based on market condition, right? Now you know about this, and now you can use it as a filter, and you can use it to build a narrative, right? Now you've learned about it. So let's say another time you are dealing with a bullish market structure, and you've seen a bullish dealing range, and you've got a key level inside the premium. Now you're going to be cautious around that key level, because you know that price is most likely going to retrace price to a discount key level before it could move higher. But we also had this premium key level, so you're going to be wondering what's going to price do in this key level, right? So when you see that price has offered this movement, you're going to regard that movement as a retracement instead of a reversal, and you'd be cautious, and you'd know that the most likely scenario for price is now to go over that retracement, right, and expand lower again before it could move higher, because price still has yet to test a discount key level, right? You're going to be cautious about that. So you should keep this in mind. Now you can trade the key levels in the premium too, but remember they're going to be lower probability trades, right? You have to be extremely cautious when trading them and not fumble, right? And for the most of you, it will be best if you avoid them, right, and only trade the ones that are in discount in case of a bullish dealing range or bullish market conditions. Now after retracement right here, you can see that price expanded lower again, and then with this expansion it tested the equilibrium and went into the discount region and tested a discount key level, and after that the most likely outcome is a reversal, and price reverse from there on the lower time frame, and that reversal on the lower time frame is gonna be an expansion on the higher time frame. You need to remember that this whole price action regarding market profiles is a retracement on the higher time frame, but on the lower time frame it's been divided into these multiple market profiles, right? So you must remember that and not be confused by it, right? Now let's move on to another slide. So here we got the second scenario in case of a bullish draw and bullish order flow, right? Now what's gonna happen when they are combined with dealing ranges in lower time frame market profiles. So right here you can see that on the lower time frame we straight away expanded lower to a discount to the discount region and tested a discount key level. Now this key level, as I said before, could either be in the form of an order block or a breaker block, an FEG, whatever, right? That doesn't make that big of a difference. What you need to remember is that it's a discount key level. So in this case, price has done its retracement and it has now rebalanced the whole range, right? It has rebalanced this dealing range, and now it can have a reversal profile in the lower time frame straight away, which will be a higher time frame expansion, right? So now based on market profile, we know that when expansion profile tests a key level inside the discount region, it leads to a reversal profile, and that's exactly what would happen, right? And that's exactly what happened right here. Now let's move on to another slide now, right? So here we'll discuss the different scenarios and combinations for bearish market conditions, right? Or when the higher time frame drawn liquidity or the higher time frame order flow is bearish. So first of all, here we got the first combination, right? When price reaches a higher time frame discount key level inside the higher time frame dealing range with a lower time frame expansion, right? And a bearish dealing range. So in that case, the most likely outcome will be a retracement on the lower time frame. Similarly, the second scenario is when price reaches a higher time frame premium key level inside a higher time frame dealing range with a lower time frame expansion profile, and then in that case the most likely outcome will be a lower time frame reversal, which is going to look like a higher time frame expansion. So you can see clearly again we are adding filters further in the bearish scenario as well, right? Now let's move on to the next slide and let's discuss its graphical representation and how will it look, right? So here again you can see that we've got this range high and range low Price took out the range high and then expanded lower to take out the range low and broke below it. And once this swing ends right here, we'll have this dealing range where two halves they're discounting the premium, right? That's the basic framework of it. Now in this case, we're in a bearish market condition, so our main focus would be on the premium key levels, because in a bearish order flow, price tend to drive price higher to a premium key level before it could continue its journey lower. So right here you can see that we've got this dealing range, and what happens is that at the lower time frame we retrace higher to a discount key level, right? Which basically means a key level inside the lower half of the dealing range, right? So in this case, we will only have a retracement even though it tested a key level on the higher time frame, right? And we will not expect a reversal profile because we still have yet to test a premium key level before having a proper reversal on the lower time frame. Now you can still trade, as I said before, you can still trade this lower time frame retracement off of this discount key level, but you got to be cautious around it and manage your risk accordingly on such setup, because they tend to be lower probability setups. And make sure to take profits early, because price can in any time expand on you and take you out of the trade. And for the beginners in the trade, intermediates, you should just avoid them at all cost, right? You should just not trade them at all, and that would serve you well. Then right here you can see that what happened is that after the retracement we had another lower time frame expansion higher, which went higher to test the premium region and equilibrium, and now it can reverse from here properly, because now the range or the dealing range has been properly rebalanced, and now the market can continue its journey lower, right? You need to remember that. Now another scenario we can have in a bearish market condition is when price has a lower time frame expansion straight away to a higher time frame premium key level inside a higher time frame bearish dealing range, right? Then in that case we'll have a reversal, in a proper reversal, which will look like an expansion on the higher time frame, because now we've properly rebalanced the range and we can continue going lower. Now I want to make it clear again that the market profiling that we are doing right here will be done on the lower time frame, whereas the dealing range and the key levels will be chosen on the higher time frame, right? You need to remember that market profiling done on the lower time frame and key level and dealing ranges chosen on the higher time frame. You must remember that, and you must use the correct time frame alignment and in the correct manner, right? Now I have explained all the different scenarios we can have based on the integration of dealing ranges and market profiles and key levels, and you've seen all of the highly likely and high probability scenarios and how you can use them as filters in your trading, and how you can use them to assist you in your higher time frame analysis and your lower time frame thought process, right? Now you need to remember that you're also going to have times where price plays out the lower probability scenarios, but as I said before, you got to be content with missing them, and that shouldn't influence you at all. Your job as a trader is to just catch the high probability moves and filter out the lower probability ones, right? Now let's move on to the next slide. So right here we've got the three main advantages or the three main aspects of dealing ranges, right? And what they are used for. I've already explained them to you, but let me explain them to you once again, because we know that repetition teaches the donkey. So yeah, there's that, right? So first of all, the first significance of the dealing range is that when it's properly combined with market profiles and key levels in the correct time frame alignment, it will help you build a proper narrative both on the higher time frame and the lower time frame, and then you can use that narrative to properly position yourself on either side of the markets inside a CRT, right? That's what the purpose of this whole chapter is. The second aspect of the dealing range is that they are used as a filters, right? They are used as a filters for weeding out and filtering out the lower probability scenarios or the low quality scenarios, and only ending up with the ones that are highly likely and high probability in nature. Now remember the first few chapters about market profiles, and those chapters I taught you that when expansion profile tests a key level, the next likely profile is going to be a reversal profile. But now in this chapter you've learned and you saw that if you integrate dealing ranges with it, then that's not always the case, because you can also have a retracement too, and you'll have to look at the discount and premium levels before deciding whether we will have a retracement or an actual reversal profile on the lower time frame, right?
That's what we call filtering, and that's what dealing ranges are mostly used for. The third aspect of dealing range is that it can be used for determining and refining your drawn liquidity, right? Let me tell you how. For example, if we are in a bullish market condition, if we've got a bullish dealing range, right? Now we know that in bullish market condition, price will tend to retrace price to a discount key level before moving higher, right? So with that factor in mind, when this swing ends right here and price start retracing to a discount key level on the higher time frame, your drawn liquidity on the lower time frame will be a discount key level or the equilibrium of this whole dealing range until price reaches the discount region in the equilibrium, and then you can trade towards the higher time frame drawn liquidity, right? And you can in the same way you can use this same concept for bearish market conditions too. Now let's move on to another slide. So here we got some important points regarding dealing ranges that you must be aware of, right? And the first one is that you should only trade the retracement and the reversal profiles on the lower time frame only after a lower time frame confirmation, and that confirmation could be in the form of a CSD or a change in the state of delivery, right? You must only trade those reversal and retracement profiles on the lower time frame only after a confirmation happens, right? You should never trade them before the confirmation. That's what you should stick to. If there is no CSD, then you shouldn't be trading it. A lower time frame confirmation in the form of a CSD gives you more conviction in your analysis and increases the probability, right? Now, the second point is that you should avoid trading the counter expansions followed by the retracement. For example, if we are in a bullish dealing range, and let's say we react to a premium key level and we have a retracement. Now we know that the most highly likely scenario for price is going to be another expansion lower towards a discount key level before moving higher, right? So the talking point here is that you should avoid trading that particular counter expansion because they tend to be lower probability, and you should rather trade the reversals followed after that expansions. Now you need to remember these points when analyzing price action with dealing ranges, and that way you will stay one step ahead and you'll be analyzing everything with a logical framework which I've given you in this chapter. Now let's discuss some example of higher time frame dealing ranges and its integration with lower time frame market profiles. So right here you can see that we've got this range low and this range high, or you could say swing low, swing high, right? You could call it whatever the fuck you like or whatever you want, right? Now you can see price with this particular swing took out both swing points and formed this dealing range right here. Now when we divide this whole range into two halves, we get the discount region and the premium region with their respective key levels, right? Now this is a bullish dealing range and our drawn liquidity is higher, so we're going to use the the bullish framework here, and we're going to see how we will analyze and dissect this price action. So first of all, here you can see that we've got this FEG right here in the premium region, right? And then we got the consequent encroachment or the midpoint of this FEG, which is below the equilibrium inside the discount region. So based on what we've learned in this chapter so far, when we are looking at this dealing range and price retrace to this premium key level in the form of this FEG, we're only going to expect a retracement market profile on the lower time frame instead of a reversal profile, right? That's what you're going to expect. But if it retraces down to the midpoint of this FEG, which lies inside the discount region, then you will expect a reversal from there. So first we've got the premium key level, which is the high of this FEG, and it lies inside the premium. That's why it's a premium key level, right? So if price tested, our expectation will be a retracement and not a reversal on the lower time frame, right? But if price tests the midpoint of this FEG, which is a discount key level on its own, then price would have a reversal profile on the lower time frame. And from there, because now the bullish dealing range has been rebalanced, right, and we've tested our discount key level and the range has been rebalanced, and now pricing continue its journey higher. Now let's look at how this price action would look on the lower time frame with a market profiles perspective, right? So right here on the lower time frame, you can see that we expanded lower to the premium key level here, but it only offered a retracement, right? Because it was only a premium key level,
and the range has not yet been rebalanced. So that's why you can see that after this retracement, price then expanded lower again towards this discount key level, and once it tested this discount key level, it then reversed from there and had this reversal profile. And this reversal profile will look like a higher time frame expansion. All of this price section right here to the left will be looked at as a retracement on the higher time frame, and this reversal profile would be looked at as an expansion, right? So you can see that the dealing range was finally rebalanced and price tested a discount key level in a bullish market structure in a bullish dealing range, and now it can reverse from here and continue its journey higher, right? This was the first example. So here we got another example of dealing range and its integration with market profiles and key levels. Now again, you can see the same framework for dealing range and the different key levels inside the discount and premium region. Now this one right here is a bearish dealing range, right? So we would be using a bearish framework for this instead of the bullish one. So what you can see here is that first we got this bearish FEG in the discount region, and then we got this order block right here in the premium region, which perfectly aligns with this equilibrium of this dealing range. Now when price retraces above and tests this FEG in the discount region, right, the most this discount key level will be able to offer is just a small retracement, but then price would expand higher again on the lower time frame to go and test the higher time frame key level in the form of this order block, right? And then once it tests that order block, it will rebalance the whole range, and then it will move lower again and continue its bearish journey. So our main focus in this bearish dealing range would be the premium key levels, and we would ignore the discount key levels. Now let's look at how it would look on the lower time frame with market profiles and how we could have gauged this info. Now right here on the lower time frame, you can see that price straight away had this expansion to the premium order block, right? So inside the dealing range, the range has now been rebalanced by testing the premium region and also testing a key level inside the premium. So now the most likely scenario for price here is to reverse from there, because now an expansion profile is tested a key level, and the most likely outcome is going to be a reversal profile in the lower time frame, and which is going to look like a high time frame expansion. And you can see that this is exactly what happened here. Now let's move on. Here we got another example of a bearish dealing range, right? You can see that we've got the same framework for the dealing range with premium and discount key levels, right, of their own. Here in the discount, we've got this key level in the form of this high right here, and then in the premium we got this premium breaker block, right, bearish breaker block inside the premium region. Now based on what we've learned so far, the discount key level will only able to offer a retracement on the lower time frame, and the premium key level will be able to offer a complete reversal on the lower time frame and an expansion on the higher time frame. Here you can see price went above to the premium region and tested a bearish premium breaker, and then it expanded from there on the higher time frame because it rebalanced the whole dealing range. Now this is how it would look on the lower time frame with market profiles. So you can see price took out first of all the discount key level in the form of this high right here, but you can see it only offered this retracement, but then price expanded above again and tested the breaker block, the premium breaker block key level on the higher time frame, and from there price reversed and exploded to the downside. This is exactly how you can catch expansions on the higher time frame and the reversals on the lower time frame. These are the exact same concepts you're going to use in a logical framework to catch expansions or reversals, right? Now here are some of the important points regarding dealing ranges. Now the first one is that dealing ranges are mostly used to build a narrative, right? Once you build a narrative and all the different concepts are aligned with each other, you can then start looking for CRT towards the down liquidity and position yourself and trades on the lower time frame, right? Another point is that apart from dealing ranges, you can apply the same concept for expansion swings and typical ranges, right? We will delve on this in later chapters, but you need to remember that you can apply the same concept for those type of stuff too, right? Another thing you need to remember is this is just the price aspect of the markets, right? We haven't even yet discussed the time aspect, so keep that in mind. And later levels of CPI, we will discuss time and price together, which will completely change how you look at the markets, and it will completely change your trading, right? But first of all, as I said before, you must build your fundamental understanding and you are understanding of price action with this logical framework and look at it with this refined perspective. Now, another important thing about this concept is that dealing ranges only makes up like a quarter of the market movements, right? Most of the time price is either in a range or inside expansion swings. So when you go over your charts, you can apply all these same concept to expansion swings and ranges too, and not just dealing ranges, right, but expansion swing and typical ranges too. Dealing ranges are just the advanced and the high probability versions of this whole framework, right? This logical framework. You must use the correct time frame element when using this framework, otherwise it won't work accurately, right? Now let's move on to another slide. Here we got dealing ranges and expansion swings, right? Now the difference between the two is pretty clear. A dealing range takes both sides, takes out both sell side liquidity and buy side liquidity in the form of range high and range low, and then it forms this swing right here, and when this swing is divided into two halves, it gives us a dealing range. But on the other hand, an expansion swings forms after a dealing range, and it only breaks above one side of the range instead of two. That's the difference between expansion swings and dealing ranges. This is how dealing range and expansion swing basically look in a nutshell. Now, as I said before, you can apply the same concepts for both of them, right? You need to remember that. Hello everyone, welcome to Trade Breakdown on EU. Now I'm gonna start off this breakdown on the weekly time frame because that's where the whole higher time frame thought process started from. So let's go ahead and discuss what was the overall thought process and analysis on the weekly time frame. So in the last few breakdowns, I kept mentioning this range high right here is our drawn liquidity, right? Now you can see that we finally reached that drawn liquidity for the short term. But now we have to determine what is our short-term drawn liquidity for the next week or two, but also what's our overall long-term drawn liquidity, which price will be drawn to. So we have to determine two things: our short-term drawn liquidity and buys, and then the overall higher time frame buys and drawn liquidity. Now, in order to do that, we'll use concepts such as market profiles, key levels, and dealing ranges, and so on, right? And we're gonna use them to measure where price currently is, where did it came from, and where it is potentially headed to, right? These are the three questions that we have to answer. Now also remember that along with this higher time frame analysis, there is a whole monthly time frame thought process and analysis on its own too, with its own monthly CRT and key levels involved. But for the sake of not making this breakdown too overwhelming, I'm gonna skip that part for now and just discuss what we've got here on these weekly and daily time frame, right? So let's go over the charts and see what we've got there. So on the weekly time frame, you can see that we are inside of this range right here. Now what happened is that we first of all took out this range low and we took it out with this big bulky candle, and with this particular candle we also tested a weekly order block in the form of this candle right here. Now the reason this particular candle is my key level and I considered it a proper valid key level is because this particular candle took out this range low. Now when this candle gets engulfed and price closes above it, this will become a valid key level for us, right? Because this particular candle took out this range low, which means it purged liquidity or took out liquidity. And now when this candle gets engulfed and price closes above it, this will be used for future reference and we will call it a key level. Now what happened is the price came down below, took out this range low, and also with that it tested this key level in the form of this order block, and it tested it with this particular candle right here. Now when this candle gets purged or when this candle got purged, I started looking for the opposing of the range to be taken as a drawn liquidity. And then what happened the next few weeks is that we started our journey higher towards the drawn liquidity, which is the opposing end of this CRT. Now when this range high or this CRT's high was taken, right, price then had this down close candle and formed this swing high. Now according to market profiles, price never moves in a straight line, right? It always moves in expansions and then retracements and then another expansion, right? Now what you can see right here is with this particular expansion swing, we took out this range low and this range high, and price formed this swing high, and after price formed this swing high, this whole range became a dealing range for us. This is how you identify a dealing range. When price takes out both sides of the range with an expansion swing, that particular expansion swing becomes a dealing range for us. Now we're going to divide this whole dealing range into two, right? And it's going to give us two regions, the premium and the discount region. Now remember what I told you in chapter 6 about dealing ranges. When we are in a bullish dealing range, we're going to expect price to retrace back to the discount region and wait for price to test a discount key level before it can move higher and expand higher again. Now the discount key level in this whole dealing range was a monthly rejection block, which was right around here. Now you can go over your charts and see it yourself on the monthly time frame, but you can do that yourself, right? So price came to the discount region and it tested a discount key level and also formed this CRT right here and had this retracement profile, and then after that price expanded higher again. Now right here, before price made this expansion swing, you can see that we've got this particular candle, and when this candle gets purged, you're gonna wait for the opposing end of the range to be taken as a drawn liquidity, right? And then eventually the opposing range high, and this is going to be the CRT for us, right? Because this CRT was formed inside the discount region just above discount key level, and then price purged the CRT, tested a monthly rejection block, and then price went higher again to take out the opposing end of the CRT and eventually the range high. Now we've taken out this range high, right? And we are now in a unique position, right? We know that our overall drawn liquidity for the long term is this range high right here, which is yet to be taken. But before that, we have to measure or analyze what is price going to do on the lower time frame before it starts moving higher again to take out this range high. Now our job on the higher time frame is to expect and anticipate what price is going to do before it starts moving higher. Now we know that according to market profiles, price moves in expansions, retracements or ranges, and then expansions again, right? So right here we're going to expect a small retracement because we've taken out a range high, right? And what you can also see right here is that we formed this CRT right here, right? And then we purge this CRT, and now our drawn liquidity for this week is going to be the 50% of this CRT right here. So for the short term on the lower time frames and for the first few days of this week, the drawn liquidity is going to be the 50% of this CRT, and once this drawn liquidity reaches, then we're going to analyze the price action on the lower time frame and see if price shows bullish or bearish signs, and then we're going to decide whether we want to expect higher or lower prices, right? So this was the weekly thought process, right, that I had on Monday, and my drawn liquidity was the 50% of this CRT. Now let's move on to the daily time frame and see what we've got there. So on the daily time frame, you can see the 50% of this weekly CRT right here, but I'm going to remove that for now, and I'm going to analyze and dissect what we've got here, right? So right here, what you can see is with this expansion swing, we took out this range high, and now we can expect price to retrace and have a retracement profile before it moves higher, and that's exactly what I expected here, and that's exactly what price did. So when this high gets taken with this particular candle, and then the next candle opens and price closes below it, this candle becomes a valid order block for us and a valid bearish key level for us, right? Now what's going to happen is price will test this bearish key level, react off of it, and then reach the drawn liquidity, which is lower, which is the 50% of the weekly CRT, right? So on Monday and Tuesday, my drawn liquidity was this FVG right here, which also aligns with the 50% of the weekly CRT. This is our drawn liquidity, and this was my drawn liquidity, right, that I had expected on Monday and Tuesday, which is today, right? Now you can see right here is that on the weekly and the daily time frame, we determined our drawn liquidity for the first few days, and we also determined our buys, right? Now we're going to keep that drawn liquidity and buys in our mind, and we're going to refine that down further to the 4-hour time frame, and then we're going to find CRT there on the 4-hour time frame towards this higher time frame drawn liquidity and position ourselves in this particular direction, right? Now let's move on to the 4-hour time frame and see what we've got there. Now on the 4-hour, you can see that we've got this range low and this range high right here, right? We've also got this range low which aligns with the daily FVG, right? So you can see that these two lows are our high time frame drawn liquidity. Now our job is to position ourselves in a CRT on the 4-hour towards this drawn liquidity, right? Now after taking out this range high, we had this expansion lower, and we almost took out this low before we stopped and formed this swing low. Now for those of you that know about TSK or the sequence, you would know that this is exactly what happens before drawn liquidity is reached, and this is what we call KOD or case of death sequence, right? And what happens is that we have a counter move just before the drawn liquidity is reached, and then what happens is that price confuses the traders and does a turtle soup, forms this turtle soup, and then it again forms another expansion swing lower and reaches the drawn liquidity, right? And this is exactly what happened here. We stopped just before taking out the range low, and then we have this counter move in the opposite direction with this turtle soup, and also with that we tested this FVG right here, this 4-hour FVG, which is our key level. Now if you plot the opening and closing times on Monday, then you'd see right here is that the Monday candle opened here, and right away it tested a 4-hour key level in the form of this FVG and reacted off of it during the Asian range, right? So you can see that a key level has already been tested during Asian range, and now during the other half of the day we can straight away expect price to expand lower towards the drawn liquidity. Now what happened here is that during London Open we formed this CRT just below this rejection block, and then price took out the CRT during London lunchtime and price expanded lower explosively. This was the thought process on the 4-hour, right? Now let's move over to the 15-minute time frame and see what else we got there. So on the 15-minute, you can see that as soon as this daily candle opened, we had this expansion, and with this expansion we tested a 4-hour key level during the Asian range and the CBDR, right? Now when this happens, you can straight away expect price to expand lower towards the drawn liquidity. Now what happened during London is we formed this CRT, and then during London lunchtime, which is from 5 AM to 7 AM Eastern time, we purged the CRT high with this particular candle, and then price engulfed and closed below this candle and gave us a model 1 entry right here. After we formed this order block and price closed below it, we're gonna take our entry at the open of this order block, right? Stop loss is gonna be above the swing high or the order block's high, and the drawn liquidity or the target is going to be the CRT low and eventually these equal lows right here. This is the model 1 entry that I took based off of my overall higher time frame thought process. You can see that we followed and I followed a logical framework. First of all, I determined our buys, my buys and my drawn liquidity on the weekly and daily time frame, and then I brought it down to the 4-hour and found it a CRT there, and then I matched that CRT with a 4-hour key level, and then I took my entry there on the 15-minute time frame, right? You can see that I followed a proper objective and mechanical logical framework, right? And this is exactly how you should be doing your analysis, and you must have an objective logical framework that you must be following in order to take entries, right? Now you shouldn't just binge watch these breakdowns, but instead you should take notes, and your goal and your aim should be to do your analysis in such logical fashion, right? Don't just watch these videos, but actually make notes and reverse engineer these trades and try to replicate this process overall, and you'll see a huge shift in your trading and your analysis. Now these chapters alone aren't enough to help you. That's why along with the chapters in CPI, I'm also making these trade breakdowns, right? So you can actually see how I apply those concepts and knowledge in the real time, right? Everything is intended everything is intended and nothing is random in CPI. Remember that, right? there's a proper reason behind why I do these and why I make these trade breakdowns, because I want to show you how I actually use these concepts, right? Just those chapters alone aren't going to be enough to help you, right? So you should watch both of them and make notes, both for the chapters and even these trade breakdowns. Hello everyone, welcome to this mini chapter on order blocks. Now, I've already explained what order blocks are in chapter 2 and I explained it in great detail, but I received like hundreds of DMs from students asking me about order blocks and its different intricacies and details, right? So I decided, why not, instead of replying to each one of them, let me make a full video on it, right? Let me make a full video on order blocks explaining every single aspect of it, right? How they are formed, why they're so important, and most importantly, how can you correctly identify an order block, right? So here's the mini chapter. Now, after watching this chapter, I don't think you'll have any confusion left about order block, right? And you'd be fully capable of differentiating between the different forms of order blocks, and you'd be able to correctly identify it and annotate it on the charts, right? So let's get into the video. So first of all, let's define what an order block is. Like what's the definition of an order block? So if you've been following ICT or all these other people on Twitter and YouTube, then you must have heard that the way they define an order block is that they consider the last down close candle or the last up close candle before the down move as an order block, right? That's how they define an order block. But that's the wrong or incorrect way of identifying or defining an order block, because that's predominantly based on patterns instead of logic, right? And what we must seek in trading and in our analysis is logic and a logical framework, right? So that's the incorrect way of defining an order block. And you might have seen hundreds of times when you identify an order block based on that definition and based on that vague and incorrect definition, it always ends up not working for you, right? And you miss moves because of that. And then you try to second guess yourself, wondering what the actual fuck happened and why did this happen, right? Now I know for sure that this is the case for most of you when you deal with order blocks and key levels, right? And you might be wondering how to solve that problem, right? Now to solve that problem, I've came up, I don't know someone else, but this is like the most refined and objective definition that I could come up with for an order block. And moreover, it's the correct definition and it's the logical definition for an order block, right? So an order block is a candle or a sequence of consecutive candles, right? So that means it can either be a single candle or it can be a sequence of consecutive multiple candles, right? That either takes out liquidity in the form of taking out a high or low, or it fills liquidity, right? This is like the basic definition of an order block. A candle or a consecutive sequence of multiple candles which purges liquidity or fills liquidity. Now, when such candles get engulfed and price closes above or below it, an order block forms, right? Meaning that candle or those sequence of multiple candles turn into order block when price closes below or above it, right? Now, this is exactly how you can identify and define an order block in the most refined and objective manner. If you just stick to this definition, you're going to change your whole perspective on order blocks, and you would start looking at it with a refined and objective perspective based on proper logic. Now let's move on to the next slide and let's discuss the core concept of order blocks. Now we have to know exactly why does an order block has so much significance and why is it considered a proper and valid key level, right? Now the two main reasons for why an order block is considered valid and a valid key level are the following. So these are the two purposes that order block serves, and that's exactly why when price close above or below it, price uses such price action for future reference as a key level for price to react off of, right? So the first core aspect of an order block is that it purges liquidity, which is like the main prerequisite for a key level. So an order block purges liquidity in the form of taking out highs and lows, right? Which mean it has taken out liquidity. That's why it's considered a valid key level. The second purpose that an order block serves is that it fills liquidity in the form of filling or testing FEGs or testing previously untested and unmitigated order blocks, right? Now that's how you can correctly identify an order block. If a candle has taken out liquidity, right, and then price closes above it, then you could use that candle or that sequence of candle as an order block. Similarly, if a sequence of candle or a single candle fills liquidity in the form of filling an FEG or testing an order block, and then price closes above or below it, then you can use that particular candle as an order block, right? That's how you identify and draw out an order block. So these are the two main things that an order block does, right? Now it doesn't have to do both of them, right? But it has to at least do one of these things. It must do or does either one of these things to be considered a valid key level in a valid order block. Now let's move on to the next slide to see some examples of how price purges liquidity and how an order block forms. So right here you can see that we've got this range low, right? And beneath this low lies liquidity, right? As we all are aware of, right? We know that above highs and below lows lies liquidity, right? Now what happens is that price comes down below and purges this low, meaning it purges liquidity or takes out liquidity, and it does it with these sequence of consecutive candles right here, right? This particular candle right here is the exact one that purges the liquidity and takes out the liquidity, meaning it takes out the low, but then also the next two candles with it also plays a role in purging liquidity. So when price close above these candles, we would regard this sequence of candles as an order block. Now you can see what happened is that price went above and closed above these candles with this particular candle, and now these candles are considered a valid order block, right? Because they've done and followed the two main important rules for an order block. First of all, it purged liquidity in the form of taking out and purging below this low, and then second of all, price closed above it, so this is a valid order block. Let's move over to the next example. So right here you can see that we've got this range high, right? And what happened is that price purged that high with this particular candle, right? Meaning this particular candle right here purged liquidity and took out liquidity in the form of taking this high. Now when price closes below this candle will become a valid bearish order block. And you can see right here, price closed below it and then it tested this bearish order block and reacted to it explosively, and price expanded lower again, right? Let's move on to the next example. So right here, first of all, you can see that with this candle right here, we took out a low to the left and we purged liquidity by taking out that low, right? Now you cannot see that low on this chart, but I've drawn out this high, this low right here, and you can see that price went below that low and purged it, and now when price closes above it, it will become a valid bullish order block, right? And that's exactly what happened. Price closed above it and then it came down to test it and then reacted off of this order block. Now what you can also see right here is that before we tested this order block, this bullish order block, we formed this high right here which generated liquidity below this low, and then price came down below and took out this low with this particular candle right here. And now again, based off of the definition of an order block, you can see that we've taken out this range low, right? And we purged liquidity below this low with this candle. And not only that, but also with this particular candle, we also tested a previously existing order block, which means this candle also fed liquidity, right? So now this candle has done two things. It purged liquidity, and also along with that, it filled liquidity in the form of testing an order block. So now when price closes above it, this will become, and this candle will become a high probability and a high quality order block. And you can see we reacted to this order block and expanded above explosively, right? This was a type of an order block which not only purged liquidity but also filled liquidity. So this was a high probability order block. This is how you identify a high probability order block. Now let's move over to an example for an order block which only fills liquidity, and let's see how it looks and how it forms. So right here we can see that we've got this FEG right here, and what happened here is that with this down close candle we felt it liquidity in the form of testing it, right, in the form of testing this FEG. Now you can see that with this candle we did one of the core things that is needed to be done by an order block before it's considered valid, and that is that this candle filled liquidity in the form of testing this FEG. Now when price closes above this candle right here, this candle is going to become an order block, and you can see that the price came down below and tested this order block and reacted off of it and exploded higher. But you can also see another order block of the same form in nature right here as well. You can see that we tested this previously existing order block with this candle right here, which means that this candle has filled liquidity in the form of filling the unfilled liquidity of this untested order block, right? And it did it with this particular candle. So that means now when price closes above this candle is going to become an order block, and price is going to test it and react to it, right? And that's exactly what happened here. In this example we had two order blocks, right, which didn't purge liquidity, but it did fill liquidity, so that's why they were considered valid. This is how you identify an order block which fills liquidity instead of purging liquidity. Now here's another example. We've got this order block right here, and you can see there's proper logic and reason behind why this candle is considered an order block, right? And that is a homework for you to figure out, and you have to tell me how is this candle an order block, right? Sorry. This candle right here is an order block, and it's a homework for you, and it's a test for you, and you have to figure it out and then tell me why is this candle a valid order block. Okay, so the fact of the matter is that this candle is an order block, and what happened is that price came down below and tested this order block with this candle right here, which means this particular candle filled liquidity in the form of testing this order block. Now when price closes above it, this candle will become a valid order block, and you can see that that is exactly what happened here. Price reacted to it and exploded higher. Now with this particular order block, you can see that I only chose the body of this order block, whereas for the other ones I chose the wicks too and included the wicks too, right? Which brings us to another topic for order blocks, right? So let's move on to the next slide and discuss whether to choose the wicks or the bodies for an order block, right? Now the simple answer to that is that it depends, and there's like no black and white to it. You have to look at it. You have to look at the scenario that it's in and then decide it based on how price reacts and how price action forms near the order block, and then you can decide whether you want to choose the body of the candle or the wicks of the candle as an order block. So the different scenarios we've got are the following. The first one is that if price closes just above or below the open of that candle that purged liquidity or filled liquidity, then you would use just the body of the candle as an order block, because price is only closed above or below the open, and it hasn't closed above, below or below the wick, so you would only choose the body as the order block. So it basically means, right, that if price closes below or above just the open of the candle that purged liquidity or filled liquidity, instead of closing above or below the high or the wick, then in that case you would only use the body, right, because it hasn't yet closed below or above the wick, so you can't choose the wick in that case, right? So that's the first scenario. The second one we've got is the opposite of the first one, which is that if price closes below or above both the open, right, both the open and the wick of the candle, then in that case you would choose the whole candle as an order block, right, including the wicks with it, right? This is the second scenario for how you can choose an order block. Now let's look at some examples here. So here you can see that this candle purged liquidity and then price closed above it, but it only closed above the body or the open of the candle, right, and not the wick. So in this case we only choose the body of this candle as an order block, and price would react to the body of this candle only, right? And you can see that's exactly what happened, right? Now again here in this example you can see that this that price purged liquidity by taking out this CRT, right, and then price closed above the candle that purged liquidity, but it only closed above the open. So in this case again we'd use the body as an order block and not the wick, right? Let's look at another example right here. Again, in this example that I also showed you previously, right, you might have been wondering why I only chose the body of this candle as an order block, and now you know why, because price only closed above the open or the body. That's why I only chose the body as the order block. So here's the scenario 2, and in this case price closed above the whole candle including the wick. So in this case we would also use the wick of the candle as an order block too, right, and we'd include the wick as well with the body. Now here is another example in which price closed above the wick, so I use the wick as an order block too. So you can see right here, this is how you basically differentiate between the different forms of an order block, and that's exactly how you can decide whether you want to choose the open or the body of the candle or the whole candle including the wick too. That's how you decided, right? You decided based on how price has closed above it. If it closed above the body, then you'd only choose the body, but it closed above the whole candle, then you choose the whole candle. You can see that we decided that based on proper objective logic, right? And we didn't just random guessed it, right, based on pattern on anything that most people do. That's how you identify and draw out an order block. Now let's move over to another example. So here again, another way of choosing between the bodies and the wick is by looking at the size of the body and the wick. So if the wick is significantly smaller as compared to the body, then you can just use the body as an order block even if price has closed above or below the wick, right? But in case if the wick is larger compared to the body, then you can include the wick too and use the wick and the body as a whole as an order block. Now it's up to you whether you want to choose between the wick or the body based on this approach that I've given you or based on the one that I gave you before, right? It's completely up to you. I'm not gonna force anything on you. That's completely your choice, right? I've given you both the approaches. Both of the approaches have their pros and cons, and it's your job as a trader to decide which one suits your style the best. Now choose only one approach off of the two, right? Don't just interchange between the two approaches, just choose one. Now if you had to ask me for advice on which approach is better, then I would say that I don't know. It's up to you to decide and to gather data. But if you ask me which one I choose personally, then I'd say that I choose the first approach because that one is more objective and that one is based on logic. Now let's look at some examples here. You can see that the wick of this order block is comparatively smaller as compared to the body, and even though price closed below the low in the wick of the candle, you could choose the body because the wick is comparatively smaller. Another one we got here is this example right here. In this case, you can see the wick is larger compared to the body, so you're going to include the wick too as an order block. That basically sums up order blocks, and this video explained everything about order blocks and its different details. I hope you enjoyed it, and hopefully you've made notes.
SilkRoad5.com. Buy or sell for free.
Hello everyone, welcome to Trade Breakdown on NQ. Now, I'll be breaking down this trade based on the chapters we've discussed so far, and I'll also delve on some other concepts briefly too. That way we'll have this smooth transition to level 2 of CPI with these new concepts that I've prepared for you, right? Now, last chapter we discussed time frame alignment and time frame selection, right? Now, as intraday traders, we'll be using the 4 hour, the 1 hour, and the 15-minute time frame, right? Now, the 1 hour isn't as important as the 4 hour and the 15-minute, but you could definitely use it for gaining conviction in your analysis and in your trade ideas, right? Now, obviously, as I said before, we'd be also using the higher time frame like the daily and the weekly in our analysis too for determining our drawn liquidity and our directional buys, right? So let's start with the breakdown. So for NQ, the 4 hour candles are 1 hour ahead, right? So you'd be using the 2 Eastern time, 6 Eastern time, and the 10 Eastern time for your 4-hour candles, right? So starting off with the 4-hour, we can see that since last few weeks we are in this bullish trend and we keep making higher highs and higher lows, right? And price is respecting this bullish trend by rejecting lows and breaking above highs, meaning it's not able to break below lows and it can only reject it by taking counter liquidity and then moving higher, right? This is what a typical bullish structure looks: rejecting lows and breaking above highs, right? So now based on market profiles, we know that in bullish structure we start off with a range, right? And then after that ranging profile ends, we then expand from that range either straight away or after a manipulation happens to a key level, right? And then after that expansion profile, we then either have another range or a retracement before moving higher, right? And expanding higher. Also, one thing is that this is just basic market profiles, right? We haven't integrated time factors with it, right? Which is going to even further refine your perspective even more. We'll delve on that later, but for now let's discuss what we are dealing with here. Okay, so let's get in the breakdown right here. So right here you can see that as soon as this week opened right here, right, we straight away went into a ranging profile, right? Now we know that according to market profiles, after a ranging profile ends, we can only have two possible outcomes. We can either have a manipulation profile or an expansion profile straight away, and in this case we got this expansion profile straight away, right? Now we know that after an expansion profile ends, we cannot have another expansion profile right away. We cannot have another expansion profile right away, right? That's not how price moves. The way how price moves is after an expansion profile, we can either have a ranging profile to form and then price can expand from there, right? This is the one scenario we can have after expansion profile ends. Or the second scenario is that we will retrace back to a key level and then we're going to react off of that key level, and this is going to be a retracement profile for us, and then we're going to expand higher again, right? In this case we got what we got, this retracement profile, right? And this retracement, and with this retracement profile we tested this key level right here, and then we expanded higher again, right? So we started off with the ranging profile, an expansion, a retracement, and then another expansion. When you were right here, if you hadn't used market profiles, then you would be expecting higher prices, which would be a wrong way to approach the markets, because after an expansion profile ends, we cannot have another expansion profile straight away, right? We will either have a range or a retracement before making another expansion, right? Now so now we've got this candle right here, which I was looking at as a key level for price to retrace to, right? Now I told you that this expansion profile right here, right? And I told you that this expansion profile ended right here. Now you might be wondering, how did I expect it, or how did I found out or determine that this expansion profile is now ended and now I can anticipate a retracement, right? You might be wondering that how you can do it, right? So the way how you can do it is, when price right here, first of all it has to take out a key level, and the key level for me here was this Monday's high right here. So what price did on Tuesday is that it took out Monday's high, right? So what it did, so let me try it again. So we've got this ranging profile, then we've got this expansion profile, and now the way how I was expecting retracements is, first of all I was waiting for a key level to be tested, or waiting for price to take out liquidity, which was in the form of this Monday's high right here. So what price did is, on Tuesday it took out this Monday's high right here, right? But that wasn't enough. Next thing I did is I waited for price to have a CSD, or to form a CSD on lower time frame, so which is basically a change in the state of delivery, and that CSD formed or occurred after this down close candle right here, closed below these candles right here, right? I'll tell you how I determine this CSD to be valid, but let's focus on the higher time frame for now, right? So what you need to remember is that after this down close candle, and after this candle closed below these candles right here, a CSD happened, we took out liquidity, and now I can expect this expansion profile right here, which is this price action. Now I can expect this expansion profile to end, and now we can enter a retracement on the lower time frame, which is going to look like a reversal on the lower time frame, right? A retracement on the higher time frame looks like a reversal on the lower time frame. That's how you logically look at price action, right? That's how you look at price with a logical perspective, right? So now you learned that the way how you can expect a certain profile to end is by waiting for a CSD. In this case, we had this CSD which confirmed that this expansion profile is now ended, and now I can expect a retracement. And with this retracement, my drawn liquidity was this key level right here, right? Now I'll tell you in a minute why I consider this candle right here as a key level, but you can see that after we tested this key level, the retracement profile ended, and we then had another expansion higher again, and we made another high, right? So we started off with a ranging profile, then an expansion, a retracement, and then another expansion, right? Now, on the lower time frames, there are certain time windows where price expands and other time windows where price retraces or reverses, right? This is like a really important time concept. But also at the same time, you need to remember that it's all relative, meaning time is relative to price the same way price is relative to time, which basically means that they are both dependent on each other, right? For instance, you cannot for sure say that on this particular day price is going to reverse, or on this time of the day price is going to expand, right? That's not how it works. The reason time works is because of price, which means there has to be certain concepts based on price that are in sync with the time factors, and they are integrated with each other in a logical framework, right? And only then the time factor will work so accurately. And if you're going to use it alone without any idea whatsoever, then it's obviously not going to work, right? So what you have to do is you have to make sure that time is in sync with the other concepts for it to work accurately. We know that we look at price with a logical perspective, right? And we use all of these concepts in a logical framework too. The same way we're going to look at time with a logical perspective that is based on a proper framework and not based on patterns. And only then you will be able to see the magic of time and price when they are integrated with each other and when they are in sync with each other. Now, getting back to the breakdown, here you can see that we had this expansion on Monday. And then with this expansion, we formed this Monday's high right here. Now, even though I was expecting bullish prices and the structure was bullish, which means price was rejecting lows and breaking above highs, right? Even with all of those factors, price first had to retrace back to its origin right here and test a key level before moving higher. Now the reason why I expected price to retrace before expanding higher is because of market profiles. We know that according to market profiles, price never moves in a straight line towards its drawn liquidity. It always starts with a range, and then after a range we form an expansion profile and we expand toward the drawn liquidity, and in this case we expanded higher, right? And then after an expansion we always have a range or a retracement before we make another expansion, right? This is generally how price moves. Now the reason this price action right here is considered a key level and we call this is an order block is because first of all this candle right here generated liquidity in the form of this FEG, right? Now remember what I told you in chapter 3. When a particular price action generates liquidity, or it takes out liquidity, or it fills liquidity, such price action is considered a key level. When a price action does either of these three things, it would be considered a key level, and you could call it whatever name you want, right? Or you could just call it a key level, right? Now this candle right here generated liquidity in the form of an FEG. That's why we're gonna call it a key level, and this is going to be a key level on the 4 hour for us, right? From which we can expect price to expand higher if it retraces it to, right? Now you can see that we have this Monday's high right here, right? And then on Tuesday I was looking for that high to be taken, right? And that high to be taken at a key time, right? Now If this high was taken during the London Open or the Asian session, then I wouldn't have had that much conviction in this trade idea, because London Open session and the Asian session aren't that high probability for retracements or reversals. These two sessions are mostly suitable for continuation price action, right? That's why I wouldn't have had that much conviction if price had taken this Monday's high from 1 Eastern time to 5 Eastern time, right? But if this high is taken during the New York kill zone or the London close kill zone, then it would be a high probability trade idea for me, because I know that from 7 a.m. right to 12 Eastern time, which is the New York and London close kill zone, this time tends to be a good macro for reversal and retracement, right? And in this case right here, you can see that this high was taken during the New York kill zone at 9:30 a.m., which is a good macro and a good key time for reversals, right? And then as soon as this high was taken at that particular key time, I started looking for reversal trades on the lower time frame. And as I said before, retracements on the higher time frame I looked at is reversals on the lower time frame, right? Remember that a higher time frame retracement is a lower time frame reversal, right? That's how price logically moves, and how you can look at it with a logical perspective, right? So in this case, you can see that everything was in sync, and there was a proper logical framework behind this trade idea, right? And there was a proper higher time frame and lower time frame thought process based on time and price that were together both in sync with each other, which led me to taking this trade right here. So the main thought process on the higher time frame was that I was looking for this Monday's high to be taken and for it to be purged, and then price to retrace back to this key level right here at a key time, which was the New York and London close scale zone, right? Now going to the lower time frame on the 15-minute, the thought process was the same, but I was looking for a New York reversal, right? And right here you can see that during London Open and Asian session, we formed this range right here, right? We range during that time, and then during New York Open at 9:30 we took that high and then immediately reversed from there. And here I waited for a model 1 entry, which is basically an order block entry here, right? So you can see that this candle right here took that high, right? So this candle took out liquidity by purging above Monday's high, and now I'm gonna wait for this candle to be engulfed, and then when it engulfs and price closes below it, it's gonna become a key level for us, which is known as an order block, right? And then my entry is gonna be at that order block is open, and I'm gonna drive it down with my stop loss above that order block's high, right? And then for target, you can either have a fixed risk to reward ratio, or you could have a dynamic risk to reward ratio and target a key level, right? We're gonna discuss that in the later chapters. Now going back again to the 4-hour time frame, here you can see that as soon as we tested this key level right here, our retracement profile ended, and then we reacted off of it and had an expansion which made another high and continued that trend. Now the way how you could have anticipated or found out that this retracement profile has now ended in an objective and mechanical way is by going down to the lower time frame based on time frame alignment, and then seeing a CSD or change in state of delivery on the lower time frame, and that would confirm that the market profile has now ended, and now we can start another market profile, which in this case was this expansion profile, right? This was the trade breakdown on NQ, and this is basically how you base a trade idea on the concepts that I've taught you so far, right? Next week we'll start level 2 of CPI, which means we're going to start improving and refining our knowledge even more, and we'll move on to a bit more of intermediate concepts which will increase your understanding of price action even more, right? In level 2 of CPI, we'll discuss the rules of range trading, right? We'll discuss what is turtle soup, and we have some other hot topics too based on time and price, right? And of course, I will break down every trade with it so that way you can see the live application of these concepts. Thank you. Hello everyone, welcome to the trade breakdown on EU. I'm gonna start off this breakdown on the daily time frame, right? So right here on the daily, you can see that I've been expecting a retracement since this range high right here was taken. And if you've watched my last few breakdowns on EU, then you'd remember that as soon as this range high was taken, I started expecting a retracement profile. And now right here, you can see that we retraced back to this order block right here. Now it doesn't matter if the drawn liquidity is higher or lower, this order block right here on the higher time frame or any other key level on the higher time frame is going to give us a reaction on the lower time frame, which we can potentially expect on the intraday charts, right? Now, if the higher time frame key level is in the direction of the higher time frame drawn liquidity, then it would be a lot better. But even if the key level, right, such as the order block or the FEG, is in the counter direction of the higher time frame drawn liquidity, then still it's going to offer a small reaction on the lower time frame. Now the scale of that reaction will be different for each level and will depend upon the quality of that key level, right? And I'm going to show you how you can determine the quality of a key level, right? We're going to discuss that in a minute. But you need to remember that every single higher time frame key level will offer a small reaction on the lower time frame, right? Now it doesn't mean that you're going to go and trade every single higher time frame key level. That's not how it works, right? But what you need to remember is that you're gonna get a reaction off of it, right? Now for some key levels on the lower time frame, when they touch a higher time frame key level, it will offer a huge reversal, right? Or which will look like an expansion on the higher time frame. But for other key levels, that are in the counter direction of the higher time frame drawn liquidity, they'll only offer a small reaction like a retracement on the lower time frame, right? Now for most of you, for beginners and intermediate student, it's best for you if you just stick to those key levels which are in the direction of the higher time frame drawn liquidity, and you should ignore the other ones, right? Because trading those sort of key levels on the higher time frames requires more intuition, more experience, and more technical knowledge. Now, as we move on to the next levels of CPI, we're going to learn how we can trade those key levels as well. But for now, you should just stick to those higher time frame key levels which are in the direction of the higher time frame drawn liquidity. Now in the daily right here, you can see that we retrace back to this order block, and we know that our drawn liquidity is still higher, which is this range high right here. So we expected a retracement, and now we can expect this retracement to either end here, or we can go a bit lower again and then maybe expand higher towards this drawn liquidity, which is this range high up above, right? Now, right here you can see that with this retracement, we tested this order block's highs on Monday, which offered a reaction on the lower time frame and formed an expansion swing on the 4-hour. Then what happened is that today on Thursday, again we tested this order block's high and it offered us a reaction. Now, based on that factor, we know that this key level on the higher time frame in the form of this order block can potentially offer us a reaction on the lower time frame. But now we have to figure out and measure how far that reaction is going to be. Meaning we have to basically determine our drawn liquidity and basically a level where we can potentially face opposing momentum or opposing key levels which can potentially drop price in the opposite direction, right? Which basically mean we have to determine our drawn liquidity, right, for the day or for the week. And the basic solution for that is to expect price to take out at least the previous day's high or previous day low. And in this case, we've got this Wednesday candle right here, and we can expect price to react off of this order block and take out at least the Wednesday's candle high, and that is going to be our drawn liquidity, right? That is a basic criteria that you can add to your system. That's how you can determine your drawn liquidity on a short-term basis for your intraday trades, right? That's how you do it. Now also right here you can see that this order block also aligns with another two higher time frame key levels, right? Which is why I expected it to be held upon and expected price to react off of it. One key level that it aligns with right here is this breaker block, and the other one is the weekly opening gap right here. Both of these key levels align with this order block. So on the daily, right? So on the daily, we've determined our drawn liquidity for the day, which is the previous days or the previous candle's high, right? Now let's go down to the 4-hour and refine the thought process and analysis even more and see what we've got there. So right here on the 4 hour, first of all, I'm going to plot out the opening and closing time for the week. So we can see where we are inside the weekly range and how his price played out the past 3 days. So right here you can see that we started out with a range, right? As soon as the week opened, we started out with a range, and then we had an expansion lower during the whole of Tuesday and half of Wednesday, right? Now what happened on Wednesday is that I expected a retracement off of this daily order block and this refined order block right here on the 4 hour, this refined order block, right? What happened is that price tested this refined 4 hour order block and the daily one, and then it reacted off of it and had this reaction and formed this expansion swing on the 4 hour. Now the two factors that led to this expansion swings are that first of all we had an expansion profile, and we know that according to market profiles, after an expansion profile we always have a retracement or a potential reversal, right? And the second factor is that we merged it with a higher time frame key level in the form of this order block. So these factors combined with each other led to the idea that Wednesday is going to have a potential retracement or a potential reversal. So on Wednesday we tested an order block, right, and had this expansion swing, and now on Thursday we can again expect a reaction off of this order block, and maybe we could form an expansion swing higher based on this higher time frame thought process, right? But we know that we cannot expect price to make an expansion straight away, right? First of all, it has to test a higher time frame key level, and then it can make an expansion higher. And the key level here that catalyzed this expansion here was this rejection block on the 4 hour on Thursday, right? This rejection block led to this expansion right here, which I was expecting. Now some people might have been looking for this Wednesday's low right here to be taken as a CRT, and maybe then they could look for an expansion. But as you know, I expected this low to be protected and not to be taken. And the reason for that is simple. You know that when this candle tested a higher time frame significant and important key level already, right? And that key level aligned with multiple other key levels, right? So that was a high quality key level. And along with that, you can see that on the 4 hour we had this CSD in the form of this candle closing above the candle that filled liquidity, which is this candle right here, right? This candle right here tested a key level, meaning it filled liquidity, and then price had this CSD when the next candle closed above it, right? Which mean there was a change in the state of delivery. What you can also see right here is that during yesterday's London close, price reacted to this candle right here and expanded lower for the rest of the day. And then when Thursday candle opened, it formed this small range on the lower time frame. Now if you tell me that whether did I expected this to happen, then the answer would be no, because I literally had no idea what price is going to do after London close and the rest of the day, right? And I didn't even had to expect anything as such, because my job is following my plan and my plan at the right time, and that's it, right? I don't have to do anything else, and whatever happens outside my trading times and my trading session and my trading system, I don't care about that price action. I would just look at it in the next session price action, and I would look at the market and see what is it telling me and what is it showing me at the moment, right? That's what I have to do. I don't have to expect or anticipate anything outside my trading times. So right here you can see that when Thursday's candle opened right here, we formed this range just above the low of this CRT. Now as I told you before, on Wednesday I didn't know if this was going to be a CRT or not, and I could only see it today on Thursday after all of this price action has already formed. So when I saw that price formed this CRT and it reacted to it, I knew that based on the fractals of CRT, our drawn liquidity is first of all this CRT low, and this CRT low also aligns with this rejection block. So when price takes out this CRT, we can have a potential reaction from here towards the upside, and that's what I expected on the first half of Thursday based on what I saw. I only saw this CRT in hindsight during London's open on Thursday, and I couldn't expect it on during Tuesday because I didn't have to, right? I had already taken my entry on Wednesday and I was done for the day, so I didn't have to do or expect anything. But my job was to just stay out and then come again during Thursday and analyze the previous price action and see what is price telling me, right? I don't have to force anything, right? and I have to now expect on Thursday what can it potentially do. That's my job as a trader. Now another thing right here is that if we plot the daily order blocks high right here, we can see that price also tested that order blocks open along with taking out this CRT low in this rejection block, right? Which led to price having this reaction, which offered me a long trade. Now obviously, I couldn't have taken an entry straight away, right? I first of all had to position myself in a CRT on the 4 hour towards the higher time frame down liquidity, which is the Wednesday's candle high or the previous daily's candle high. And that's exactly what I did here. I waited for this CRT low to be taken and for price to test the rejection block, and then as soon as that happened, I went down to the 15-minute and I waited for my model 1 entry. These were the different factors that led me to expect this low to be protected and not to be taken, right? Now let's move on to the 15-minute and see how I took my entry there. So on the 15-minute, I'm going to first of all plot out the opening and closing times for Thursday right here, right? So that we can actually see where we are in the daily range. Now you can see that we straight away started with this ranging profile right here. And then price had this manipulation profile down to this CRT low. And with this manipulation profile, we tested a key level and also took out a higher time frame CRT. Now based on market profiles, we know that when price tests a higher time frame key level with a manipulation profile, the next profile we can expect is an expansion higher in the opposite direction, which is what happened here. Now the way how you can know that this manipulation profile has now ended and now you can expect an expansion in the opposite direction is by waiting for a CSD. And right here, you can see right here that we had a CSD and price closed above this candle and formed this order block, which gave me confirmation that now the manipulation profile has ended and now I can take my entry here. My stop loss was below the order block's low and I targeted the opposing 50% of the CRT and eventually the opposing end of the range is my drawn liquidity. Hello everyone, welcome to Trade Breakdown on Gold. So in this video I'll be breaking down a trade I took on gold yesterday, right? Now I don't usually trade anything apart from euro, dollar and NQ, but I received too many requests asking me to do a breakdown on gold, so here I am. Although I only trade euro, but I do watch and analyze the higher time frame of other pairs like Bitcoin and gold too. I don't trade them, but I do watch them for long-term plays if they offer any, right? Alright, let's get into the breakdown. So we know that as intraday traders, our main time frames are the 4 hour, the 1 hour and the 15-minute, right? But that's not going to be the only time frames we are going to use. We would still use the higher time frames such as the weekly and the daily for our higher time frame analysis. Now we're going to use the daily and the weekly time frame for 3 objectives or purposes, right? And these 3 objectives are, first of all, to determine our higher time frame drawn liquidity, right? To determine a higher time frame buys for our trading, and then last but not least, we would be using them to generate a narrative for us, and then that narrative is going to help us generating a trade idea in the lower time frame towards the drawn liquidity we've determined on the higher time frame, right? That is going to be our objective on these time frames. Now this narrative that we're going to determine is going to be conceptual and contextual, right? And what I mean by that is that we're going to use these concepts such as market profiles, key levels, dealing ranges, EBITDA data ranges, and so on, which are objective, mechanical, and logical concepts, right? We're going to use these together in a logical framework and in conceptual manner to determine a narrative. That's what we're going to do on these time frames, right? Now, here on the weekly time frame, we can see that we're clearly in a bullish trend, right? Now, I haven't concluded that based on patterns or based on what I've seen. I haven't said that just because I can see the price is going up, right? Now, obviously, that's a factor. But the main reason behind why I concluded that price is in a bullish structure is based on the fact that price is rejecting lows, right here you can see, and breaking above highs, which indicates a bullish structure, and you can see it on the charts, right? Now, we've got all this price action right here, but we don't have to deal with any of that. Our goal here is just to determine what is price going to do this particular week and how is this weekly range going to play out, right? And in which direction it's going to play out. That's our key objectives on these time frames, right? If I had to explain to a 5-year-old of what we're going to do on these time frame, is just to determine and just to anticipate what is the weekly range going to do this particular week, right? That's our main objective, right? So let's zoom in and analyze this price action right here. Now right here, you could have expected anything in the past, right? You could have been wrong, you could have been right. That's not the point. Forget about what were you expecting right here and just focus on what price is telling you at the moment, right? That's your objective. Now right here we can see that first of all, we've got this order block, we've got this key level in the form of an order block for us, right? Now the reason this is a valid key level is, first of all, it has taken out liquidity, and second of all, it has filled liquidity in the form of filling this FEG right here, this FEG. So based on these two factors, I'm going to consider this candle, this particular candle, as a valid key level, and we're going to call that an order block, right? Now the reason I've called this a valid order block or a valid key level is not because it's the last down close candle before the move higher or whatever the fuck you've been taught, right? That's not the case. The reason why I consider it a key level is because of two logical factors, which are that it took out liquidity and it filled liquidity. Now recall back what I told you in the last chapters. The only reason any price action, like any form of price action, is considered a key level is because it does either of these things, either of these three things. It generates liquidity, it fills liquidity, or it takes out or purges liquidity. If a certain price action does either of these things, it is going to be called a key level, and price is going to use that particular price action for future reference to react off of, right? Now forget about the fucking color or the last down close candle or the up close or whatever those things are, right? Those are based on patterns, and they're not gonna work for you. And the reason they ain't working for you is because, first of all, they are not objective, which means you cannot turn it into a trading model which is gonna offer you a consistent result over the long term, right? That's the problem with things that are subjective and not objective. That's why I'm teaching you the things that could be consistently used in a logical manner, right? And that could offer you consistent result, right? Now let's get in the breakdown and see what we've got here. Okay, so right here, this is our key level, right? Price closed above it, and now it's going to be used as a support and a future reference for price to react off of, right? So you can see we tested it once here, and then we got back down and tested it again, and also tested this rejection block right here, which is the wick of this order block, and price reacted off of there, and then it went higher, and last week it closed right here. Now forget about how you could have expected, right? That's not the point. You have to just look at what price has done in the past and how it has reacted to certain level, and what is it implying to do in the future, and where it could potentially head towards in the near future, right? And based on these factors, we can clearly see right here that price reacted off of this order block, and now it has closed here just below this high right here. So now you tell me, what's the next thing price is gonna do, or what's the next thing or the next draw where price could potentially go to, right? It's pretty obvious, isn't it? Price closed just below this high and it reacted to this order block, and the structure is bullish. You can see that we build a contextual and conceptual narrative. Now you tell me which is going to be our drawn liquidity, our buys, and our narrative, right? Of course it's going to be bullish, and the drawn liquidity is higher, which is this high right here. And we determine that based on the past price action using concepts such as key levels, market profiles, and all of these other concepts, right? So you can see that based on price action right here, this price action right here, based on what had happened in the past and based on what price had done in the past, it's telling us one thing, that this price is gonna go higher towards that high right here. That's how you determine your drawn liquidity and your buys. It's as simple as that. But you need to remember it has to be logical, and it has to be conceptual and contextual, right? That has to be the key aspect of it. Also at the same time, this is not it, right? We still have yet to discuss other things and other concepts too that are going to assist us in our higher time frame analysis, right? don't think that you've cracked it because you learned this, right? You still have a lot to uncover, right? Now going down to the daily time frame, we can see that last week candle closed just below this high, and on Friday we had this candle right here which tested this high right here and filled liquidity. So now we don't have any unfilled liquidity below us, right? We have liquidity, we only have liquidity above in the form of this high right here, which implies that price is going to be drawn higher, right? So now our job on the higher time frame has been accomplished. We had three jobs there, we had three objectives. First of all, to build a narrative, and we did that, to determine a drawn liquidity, and to determine a bias, and we've done that now. Now we're going to go down to the 4-hour time frame and find a CRT at a key time and then position ourselves and that particular CRT towards that drawn liquidity we have determined on the higher time frame, right? That's going to be our job on the lower time frames. Now on the 4-hour, first of all, I'm going to put the opening and closing times right here, so we can see where we are in the weekly range, right? And we're going to use that to assist us in our analysis. Now I'll be making a separate chapter on opening times in level 2 to explain what they are used for and how are they used, but let's discuss this first. So we know that the draw is higher, right? So now our job is to buy below the daily and the weekly open and ride it higher. If the drawn liquidity is higher, your job would be to buy below the opening, right? The opening time, buy below the open of the candle and ride it higher. Now let's analyze this price section right here. So first of all, you can see that on Friday, price came down lower, took out liquidity and filled liquidity with this particular candle right here. So this candle has done two things. It has taken out liquidity in the form of this CRT low, and it has filled liquidity in the form of testing this FEG and this breaker block right here, right? So now when price closes above this particular candle, it's gonna become a key level for us, and you can see it right here. It closed above it and became a key level, which is going to be used for a reaction higher. Now you can see that with this weekly candle is open, we straight away tested this key level right here in the form of an order block, right? But we tested that at a wrong time, right? Not a wrong time, but basically it wasn't tested at a key time, right? I was the more favorable time for us would be to, if price had tested it such a time such as the London open kill zone or the New York open kill zone, right? That's what our anticipation and expectation is going to be. So but that's not happen, that didn't happen, right? Price tested it at a wrong time, right? Which wasn't those time which we were looking for, right? So what we're going to do in this case right here is stay out of this move right here and not take part, because it has already tested this key level at a different time which is not favorable for our trading system. So we're going to stay away unless price takes out liquidity again in the form of this CRT and tests the mean threshold of this order block, which is a refined key level in itself, right? This mean threshold in itself is an important key level which hasn't yet been tested, and price could test it and react off of it, right? Now your expectation here would be to expect higher prices, right? Because price has already tested a key level, and as I said before, you missed the move, and now you're gonna stay out and stay risk off. But if in some case price tests this mean threshold and takes out this CRT, right, which wasn't tested before, right, then you can trade it and expect higher prices again, right? Now what I'm trying to tell you here is that do not force a trade idea right here. Let me explain it to you, right? If you are right here and price hadn't done this price action right here, then you would be expecting higher prices straight away, because prices tested a key level and now it's gonna go higher, even though the mean threshold isn't tested yet, right? Even though that's a scenario for us, but you're not gonna force that, right? You're not going to force that particular idea at that point, because price at that moment is telling you that it has tested this key level, and you'd be staying out because price tested it at an unfavorable time. So you would have stayed out, right? But then price does this right here and went down to the test the main threshold and takes out liquidity at a key time. Then in that case you can start looking for trades, because now price has tested a different key level, which is this main threshold of this order block, and it has done this at a key time, right? So now based on what price is telling you, you can take a trade right here. So you can see we didn't force anything right here. We just waited and waited to see what price is telling us, and then we took trades based on that, and we did not force anything. We did not force any idea whatsoever. We just took a trade and generated a trade idea based on what price told us and what price done, right? Now another scenario could have been that price could have straight away went higher without giving us an entry, which would have been completely fine for us, because right, because we're gonna miss trades, we will lose trades, they're inevitable. You just have to see what price is telling you and not force anything, right? I hope you've understand what I've told you here. You should rewatch it a few times back to actually get what I'm trying to tell you, right? You're not gonna get it on the first time, right?
So let's recall back. Right here we tested this main threshold and we took out this CRT low, and this 4-hour CRT was purged. And now we can start looking for trade ideas, and we can start looking for our lower time frame entry on the 15-minute. But before we do that, we're going to go down to the 1-hour time frame, which is our intermediate time frame, and we will refine this trade idea even more, and we're going to see what price is telling us on that particular time frame. So right here you can see that inside that 4-hour CRT we've got this another 1-hour micro CRT right here, just above this key level, right? This 1-hour CRT was formed just above this key level in the form of an order block, right? So you can see we've refined the macro larger 4-hour CRT down to a 1-hour CRT, right? And now we're going to use this refined CRT to find a trade idea. Now there is a whole logical framework of how you're going to do this, right? And how you can refine key levels in CRT and the higher time frame down to the lower time frame, and I'll explain it to you in a different chapter. But just know that it's going to take some time, right? And that's how it's supposed to be, and that's how it's meant to be. I could explain all of this in just a single video to you, but that's not gonna serve the purpose well, right? I want to make sure you get enough time to digest all of this and actually get the knowledge I'm supposed to teach you and give you. So be patient with me and don't try to rush anything, right? So right here you can see that this 1-hour CRT, it was purged at a key time, which is the 3 a.m. macro. It's a really good time for CRT purges, and this CRT was purged at that time and also tested this refined 1-hour order block, right? And now we're going to look for an entry on the 15-minute. Now you might be saying that this is a 1-hour CRT, but remember, it's just a refined CRT. The actual CRT is on a 4-hour, and based on time frame alignment, we're going to use the 15-minute for entries for a 4-hour CRT, right? So let's get into the 15-minute time frame. Right here you can see that it was purged at a key time, and this candle was that particular candle that took out that CRT, right? And now we're gonna wait for this particular candle to be engulfed, and we're gonna take our model 1 entry right here. Our stop loss is gonna be below this low, and we're gonna target the opposing 50% of the range and eventually the opposing end of the range, right? That was the trade breakdown on gold. We have discussed our higher time frame thought process. What was our thought process on the weekly time frame and the daily time frame, and then we refined them down to the 4-hour, the 1-hour, and then eventually we took our entry on the 15-minute time frame. That's how you're gonna do your analysis and generate trade ideas.
Hello everyone, welcome to chapter 7 and 8. Now both of these chapters will be explained together in this single video. So this is going to be a long video, so make sure to not just binge watch it, but also make notes along with it. Some of you may not get the information and the technical knowledge inside this video on their first watch. So if needed, you should watch it multiple times to actually get everything out of it and attain the knowledge hidden inside these chapters. The concepts explained in this particular chapter are my favorite ones, right? These concepts, particularly in chapter 7 and 8, influence my technical knowledge the most, and I use them on a daily basis in all of my higher time frame and lower time frame analysis. Now, I use these concepts to build a higher time frame narrative. I use it to build a lower time frame narrative. And most important of all, I use it to determine my drawn liquidity both on the higher time frame and on the lower time frame, right? Now, the subject of the matter is that you should take them really seriously because it may seem a bit ambiguous at first, but as you dig deeper into the knowledge and get to know it better, you'd find yourself being able to analyze the charts, particularly the higher time frame charts, with a better perspective and a refined view, right? Now, that being said, let's get into the first part of the video, chapter 7, which is about weekly profiles. So first of all, as always, I'm going to start off with actually introducing what we are actually dealing with, and I'll make sure to define it in the most refined way possible. That way you'd have a better idea of what we are dealing with throughout the chapter, right? And throughout the video, and you'd be able to understand it better. So basically, the definition is that the weekly profiles are an advanced type of market profiles, right? Now let me tell you what I mean by advanced. So if you watched my previous chapters on market profiles, then you would have noticed that those market profiles were particularly based on price, right? And only the price aspects of charts were discussed. But now with these weekly profiles and intraday profiles, we're going to take those market profiles even further and also discuss the time aspects of the charts with it, right? Which is why I introduce weekly profiles as an advanced type of market profiles, right? Because inside weekly profiles, not only price aspect is included, but including the time aspects too. So basically, in summary, market profile takes price aspect into consideration, whereas weekly profile takes both time and price into consideration, right? This is the exact reason why this concept is my favorite, because they are dynamic, right? And both aspects of the charts are included in it. So, weekly profiles are an advanced form of market profiles used to break down the weekly candles range into manageable segments, right? Each with its own fractals. So, what basically is said in that definition is that with weekly profiles, we're going to divide the weekly range, meaning the weekly candles range, into segments, and each segment will then have its own characteristic or fractal nature. Now, obviously, this fractal nature will be dynamic and will be subjected to change and will be adjustable, meaning there's going to be no black and white around it, right? When we are dealing with weekly profiles, and you're going to have to look at the combination of key levels, PDRA metrics, and dealing ranges to reach a conclusion. Now, as I said before, all of these concepts that I'm explaining in CPI work only when incorporated and integrated correctly with each other in a logical framework. The same way weekly profiles will work only if you integrate it properly, and it won't work alone, right? It will only work if you integrate it correctly with key levels, market profiles, and other concepts like PDRA metrics and so on, right? Now let's move on to the next slide and let's discuss the importance and the significance of weekly profiles and what are the different things that it can help us with, right? So here's a list of the things that weekly profiles will assist us with. The first one we've got on the list, which is also the most important one, which is that with the help of weekly profiles, we will be able to understand the open high low close and the open low high close factor of the weekly candle, right? Which will helps us understand the weekly range or the weekly candles range a lot better. And we'll start to look at the weekly candle range with a more refined and logical perspective, right? Now, the open high low close concept or the open low high close is a different important concept in itself, right? And I'll be making a separate chapter on it in CPI and level 3, and we'll discuss it in great detail. But for now, you just have to remember that with the help of weekly profiles, we'll be able to understand the weekly candles range better, right? Now, weekly profiles will help us break down the weekly candle into multiple segments, and each segment, as I said before, will have its own fractals and characteristics. Now, weekly profiles is one of the main concepts that plays a role in helping us determine daily buys or drawn liquidity. Now, determining daily buys is again in itself requires a whole chapter, and I'll be making one on it at the right time. But you can see that as we go along these chapters in CPI, not only I'm explaining these new concepts to you, but also I'm introducing new potential concepts to you that we will be discussing in the future, like determining daily buys or the open high low close concept, right? We'll be discussing all of them in later chapters of CPI. Now, another thing that weekly profiles will helps us with is determining higher time frame narrative. It will help us understand where price is in the grand scheme of things, where prices came from, and most importantly, where it could potentially go to. This is what we call narrative. This is what we call building narrative, right? There's a lot more intricacies to it which we'll learn in the future, but what you need to know is that weekly profiles will helps us with building a higher time frame narrative, and then we're going to refine and bring that narrative down to the lower time frame, and finally put and find potential trading entries. And also along with that, with the help of narrative, we will gain conviction and confidence in our analysis and our trade ideas. Now, weekly profiles will also help us with our drawn liquidity and targets, right? And this will be possible when we combine it correctly with key level and period area metrics. Now, last but not least, weekly profiles will help us with understanding the time aspects of charts better, right? This is one of the starting concepts that will introduce us to the time factor of charts, right? We'll discuss time in great detail in level 3, right? Level 3 will be mostly about the time factor of charts. Now let's discuss the different concepts we're going to be using in conjunction with weekly profiles to create a proper and logical framework. So down we've got this list, right? The first and most important thing surrounding weekly profiles, and the thing that actually backs weekly profiles and makes it meaningful, are key levels. The second we've got is market profiles. Now obviously, as I said before, weekly profiles inherently in itself is an advanced form of market profiles, which mean it's made off of it. But even then you're gonna find multiple different market profiles inside the higher time frame weekly profile, right? We're going to be using the PDRA metrics to help us with refining the key levels that we're going to be matching with price to define a weekly profile, right? We'll have a lot of key levels both in discount and premium, and we're going to refine them with the help of PDRA metrics and dealing ranges. And then we're going to match those key levels with price to define and frame specific profiles based on the day of the week. Now moving on, here are some important points regarding weekly profiles, right? First of all, we are going to use the Monday's price action and specifically the Monday's candle to base most of these weekly profiles, meaning the Monday's candle in particular will have a huge part in determining and framing the weekly profile throughout the week. Before the weekly candle opens, you cannot for sure expect or anticipate any weekly profiles, right? It's not possible. You will only be able to do that once you measure the price action on Monday, and then you gauge that information, and then you're going to decide and reach a conclusion based on what Monday's candle has done, whether it has tested a key level or not, whether it formed a CRT or not, and so on, right? And then based off of that, you're going to decide which weekly profile you're going to frame. This is how you're going to base and frame a specific weekly profile throughout the week. Another thing is that these weekly profiles are dynamic, right? And adjustable, meaning the type of weekly profiles can indefinitely change based on how price action forms throughout the week, which implies that there is no certainty in weekly profiles. There's like no black and white surrounding weekly profiles, and it may change throughout the week depending upon how price action forms. So keep that thing particularly in your mind, and never treat weekly profiles rigidly, right? Another thing is that weekly profiles are subjected to change in adjustments, as I just said now, and these changes are going to be made throughout the week based on how price reacts to certain key levels and based on how price action forms. The last thing that you can use for weekly profile is the news calendar, and it can assist you with framing the right weekly profiles, right? We're going to learn about this later. So here we got some important weekly profiles. Now remember, these aren't the only weekly profiles, but instead we've got other ones too. But these in particulars are the one that I use the most to frame a narrative or a weekly profile throughout the week. And these are the particular ones that usually plays out most of the time, right? And if you just stick to these ones, which I do, they're going to be more than enough for you to be consistently accurate with your analysis, right? So let's discuss each one of them in detail, and let's discuss their different intricacies. Now, first one we've got is a classic expansion weekly profile. Now, what happens in this sort of weekly profile is that we start off Monday with a range, and Monday's candle is particularly smaller in her size comparatively, and basically it forms a ranging candle. Then what happens on Tuesday is that price takes out Monday's candle, and along with that it tests a higher time frame daily or weekly key level. During Tuesday, price tests a discount key level and then it closes higher. And then the rest of the week, price continues higher until the drawn liquidity is reached. In this case, the drawn liquidity is particularly reached on Thursday. Sometimes it can also happen during Friday. Now, depending upon when the drawn liquidity is reached, if it's reached on Thursday and during Thursday's price action, then the Friday's candle is likely going to be a retracement. If it's reached on Friday, then maybe during Friday's London Open or New York Open, then Friday is going to be a reversal, which will look like a higher time frame retracement, right? Now you can see right here, depending upon the day of the week, we are dividing the whole weekly candles range into multiple segments, and then each segment has specific fractals depending upon how price reacts to key levels on the higher time frame, right? Now with this weekly profile, price forms the high or the low of the week, particularly on Tuesday, right? More often than not, you're gonna see that the low or the high of the week is formed on Tuesday. Now for bearish scenarios of this weekly profile, it's the exact opposite of this example shown. In bearish classic expansion weekly profile, the high of the week is formed on Tuesday, and then the low of the week is formed on Thursday or Friday. Now what you can also see here is that the open, low, high, close of the weekly candle is also defined in here, and you can see how the body and the wick of the candle are formed and how you could have exploited each part of it, right? Moving on, here you can see the whole weekly candle broken down to various lower time frame market profiles. So you can see Monday starts off with a ranging profile, Tuesday has a manipulation profile with which it also tests a higher time frame key level, and then Wednesday and Thursday has an expansion profile towards the drawn liquidity or towards the opposing higher time frame key level, which is our target. And then when the key level is tested, it leads to a retracement on Friday. Now for some of you that learned about market profiles, you might be wondering about how you can classify these market profiles, right? And here's the answer to it. Now remember, this isn't the only way of looking at market profiles, right? There's other ways too which also works, but the most refined way of classifying market profiles and dividing them is by using time. And in this case, we're going to use the time of the week, which is the day of the week, and we're going to classify each day into a different market profile, right? This is the most refined way of how you can classify market profiles. More often than not, Monday's candle is likely going to be a ranging profile, and then Tuesday happens to be a manipulation profile, and then Thursday and Friday uh, uh, and then Wednesday and Thursday leads to an expansion profile, and then Friday is usually a retracement profile, right? Now let's see how it would look on the daily time frame. So obviously right here you can see that these two lines represent higher time frame key levels, right? So what happens in this sort of weekly profile is that Monday's candle happens to be a ranging profile or a ranging candle which doesn't test any sort of key level, and then Tuesday takes out the Monday candles and tests a higher time frame key level, right? And then Wednesday and Thursday candles expand higher, and then you can see that the Thursday candle reaches the higher time frame key level, which leads to the Friday candle being a ranging candle in a retracement lower. Moving on, here is the second type of weekly profile,
of the one that we discussed before, the classic expansion weekly profile. Now this one is also a classic expansion weekly profile, but in this case what happens is that instead of the Tuesday being the high or low of the week, Monday tests a higher time frame key level, and Monday starts the week with testing the key level straight away. Now as I said before, you cannot anticipate a weekly profile right away. You're gonna have to first wait for the Monday's candle to form, and only then you can decide what type of weekly profiles can we have. Now you cannot know if Monday is gonna test a key level or Tuesday before the price action forms. But what you can do is wait for the price action to form and then analyze the price action and anticipate a certain scenario or a certain profile and frame a weekly profile based on how price is formed on Monday and based on what price is telling you. So in this case, Monday test a higher time frame key level, and the rest of the week we start our journey higher towards the opposing key level and the drawn liquidity, right? And we meet and reach the weekly objective. And once that objective is reached, the Friday's candle is a retracement. So in this case, you can see that during Wednesday we have a retracement before we expand higher again, because we know that price never moves in a straight line and always moves in market profiles, right? So right here the weekly candle is again divided into lower time frame market profiles, and you can see that Monday starts off with testing the higher time frame key level straight away, and then Tuesday and the rest of the week we start moving higher and expansion profiles along with retracements in between the expansion profile to rebalance the expansions. Now right here you can see that as soon as we hit the weekly objective either on Thursday and Friday, we then retrace lower. Now in this case, if the weekly objective or the opposing key level is reached on Wednesday, then we would form the high of the week on Wednesday, and Thursday and Friday price action is going to be a retracement, right? You're going to wait and see what price when this price reaches the higher time frame key level, and then you're going to decide your weekly profile and build a narrative based on that, right? You're going to build a narrative based on a logical framework. Here is how it would look on the daily chart. Monday starts off with testing higher time frame key level, and then it expands higher. Moving on, here we got another interesting type of weekly profile. This is a bit more advanced, and as I said before, you cannot anticipate it right away, but instead you're gonna have to wait and see how the price action forms on Monday and Tuesday, and then you're gonna frame this weekly profile, right? Here's what happens in this sort of weekly profile. Price starts out with a small expansion on Monday, but the nature of this expansion is weak because it originates without testing a higher time frame key level. And due to this nature, the expansion on the Monday's candle form a CRT, right? In most cases, it forms a CRT, and then the Tuesday candles happens to be a ranging candle or an inside bar in most cases, right? And the Tuesday candle happens to be a ranging candle. Then what happens on Wednesday is that price takes out the Monday CRT and tests a higher time frame key level, and then it reverses and expands from there, and then it starts its journey higher to take out the opposing end of the range and eventually reach a higher time frame opposing key level, right, inside the dealing range or the PDRM matrix. So in summary, Monday's candle form a CRT, Tuesday candle happens to be a ranging candle inside that CRT, meaning an inside bar candle, and then Wednesday candle purge the CRT range and expand higher on Wednesday and Thursday to meet the weekly objective, right? So what you can see right here that every single month or every single week and every single daily candle has a particular objective that it needs to meet, right? Every candle starts out with first of all testing a key level, and then and it ends and closes after it reaches an opposing key level which finishes its objective and the objective is being met, right? In this case, the key level is tested on Wednesday, and then the objective or the weekly objective is met by reaching a higher time frame key level either on Thursday or Friday. Here is how it would look based on lower time frame market profiles. So you can see that Monday starts off with an expansion profile out of nowhere, meaning the expansion profile is weak and it originates without testing a higher time frame key level. And then Tuesday candle is a ranging candle and an inside bar, and then on Wednesday, the Wednesday's price action manipulate below the Monday CRT and test a higher time frame key level, and then it expands higher.
and that's where we start our expansion higher and start our journey towards the drawn liquidity, right? And this is exactly how you can catch weekly expansion. You first wait for price to test a higher time frame key level on one side, and once there is a lower time frame confirmation after the higher time frame key level has been tested, right? And the lower time frame confirmation has been made in the form of CSD or a structural shift, and you can position yourself towards the drawn liquidity and exploit the weekly range. And in this case, you wouldn't trade the Tuesday candles because there's no purge inside of it, and you would wait for Wednesday. And then on Wednesday, when the CRT purge happens, then you're gonna wait for a 4-hour CRT and position yourself towards the drawn liquidity on the higher time frame and trade that, right? Here is how it would look on the daily time frame. You can see that the Monday's candle is a CRT, Tuesday is an inside bar, and Wednesday candle purge the CRT and then expands higher again. And again, the drawn liquidity is reached either on Thursday or Friday. Moving on, here's another type of weekly profile. This is also an advanced one, and again, based on what I've said before, you can only anticipate it based on how price action forms throughout the week. As I said in the start of the chapter, these profiles are dynamic and adjustable, so you're gonna adjust them based on how price action on the previous days of the week. So what happens in this profile is that again we start off with an expansion on Monday, and that expansion originates without testing higher time frame key level, which leads to it being a weak and indecisive expansion, right? Then that Monday candles also happens to be a CRT. Then what happens on Tuesday is that price forms an inside bar, right? And doesn't do anything significant. And then on Wednesday, price takes out a Monday CRT high and expand lower. And then during Thursday's price action, price tests a higher time frame key level, and then it expands from there. Now there are multiple variants of even this single weekly profile, and you could use them all, and you're gonna build the confidence around it based on gathering data and backtesting it as much as you can. Now one scenario can be that the Wednesday candle also forms a range inside the Monday CRT without taking out the Monday's high, and then on Thursday we purge the Monday's low first and then expand from there again. So you can see in this other scenario, even the Wednesday formed an inside bar and price consolidated from Monday till Wednesday and didn't do anything significant at all. And then on Thursday, maybe we had a high impact news which led to price taking out the CRT and led to the CRT being purged. And after that, we expanded higher. You can see that we can even add news events to it and potentially frame a narrative based on that. Another scenario could be that the Monday's candle don't form a CRT but just forms a ranging candle, and it just consolidates, and then price continues that consolidation till Wednesday's close, and then on Thursday we manipulate that below that consolidation or that range and then expand higher towards the drawn liquidity. So you can see that even though there are multiple different scenarios of this single weekly profile, right, the narrative is still the same, and you can frame the same weekly profile based on these different price action, right? All that matter is the narrative and whether it's logical or not. And here you can see that it's pretty logical and objective. Another scenario could be that there's no high impact news event till Wednesday, and maybe there is bank holidays, which is why price consolidated and didn't do anything significant till Wednesday. And then on Thursday, maybe there is CPI or PPI or any other high impact news event which led to the expansion. Here is how it would look based on market profiles. On Monday, price form an expansion. Tuesday is basically a range, and then on Wednesday, price takes out the Monday CRT high and expand lower, and then on Thursday we test a higher time frame key level and reverse from there. And this is how it would look on the daily time frame. You can clearly see that we have this CRT, and then we purge that CRT on Wednesday, and then we purge the other opposing end of the range of that CRT on Thursday, and then we expanded higher. You can also imagine how the different scenario for this weekly profile would look based on what I told you just a moment ago. Now let's discuss some example here based on how you can frame these weekly profiles on charts, considering key levels and the price action on Monday and throughout the week. As I said before, these profiles are adjustable, and you're going to see that in a minute and see how. So we've got this first example here. Right here you can see that it's a negative chart and we don't know what's going on. So right, so what we're going to do is mark out the different key levels and also mark out the weekly candles price action and the different days of the week and see how price reacted to those key levels and what are the different weekly profiles we can frame based on this price action we've got right here. So after plotting out the key levels on this chart and the day of the week, we can see that we've taken out this range high and we are testing a higher time frame key level on Wednesday. Now what you can also see right here is that we actually tested this range high on Monday and it offered us a reaction, but then what happened is that price came above again and took the Monday's high and this range high again on Wednesday. Now if you ask me why this happened, then the answer would be that I don't know. But what I do know is how to frame a narrative and trade idea. And what I also know is how to manage risk. And one another thing I also know is that I know that no trading system or concept will allow me to have a 100% win rate or even a 90% win rate. And I'm always going to have time like these where price goes against my analysis and I lose trades. But at the same time, I also know that my risk management and my psychological aspects are strong, so I wouldn't let these losing times and these losing scenarios mess up with my head or mess up with my performance, and I would just treat these scenarios or these losses as an inevitable part of the game. I know that if I do my analysis out of 10 times, I'm only going to be right about 7 times, and the other 3 times I'm going to be wrong, which is completely fine because the goal is to not reach perfection but just to gain enough and adequate amount of knowledge with which you can be consistently profitable for the long term. If you have a win rate and strike rate of 70%, then you are ahead of 90% of the traders out there. And if you consistently stick to your plan and follow your system, you are then ahead of everyone. But if you're going to be an amateur and always cry about how price went against your analysis and how you lost this trade, then you'll never succeed. When I lose, I feel nothing and I embrace those losses because I know that they're inevitable and I treat them as a business cost. You know, when you're doing a business and you're running a business or you're starting a business, you always need an initial capital or or a business cost that you must spend in order to run that business. And at first, you're going to be at loss. You're going to be at loss. But as you stick to your business plan and you run it diligently, and as time goes on, you're going to become profitable. But that doesn't mean that you're going to stop losing. No, that's not how it works. Even when your business starts to become profitable and it starts earning you money in the long term, you're still going to incur cost or what we call in business term expenses in the short term. You're still going to incur these expenses and they're going to come in the form of labor cost, payroll, material cost, operating cost, and so on, right? And the profits that come by that at the end of the year will make sure to compensate for those expenses. And when you subtract your expenses from your whole revenue at the end of the year, you're always going to end up in profits. But if you are being an amateur and you always let those costs mess up with your head and mess up with your performance, then you wouldn't be able to run that business properly, right? Therefore, a good businessman know that in order to run his business, there are going to be costs, and you have to embrace those costs in the short term because you must know that in the long run you're going to end up with profits because your business will earn revenue far more than the expenses, and the difference between them will result in profits for the company or the business, right? In the same manner, it's your job as a trader to treat trading like a business and think in terms of costs and revenue instead of profit and loss, because when you treat losses as an operating cost or expenses, your emotional attachment to them will be lower and they won't make you panic or you won't cry about it anymore, right? So treat trading like a business and don't let losses and wrong analysis mess up with your performance, and instead journal them, embrace them, and most importantly accept them, right? Okay, so with all of that being respectfully said, let's look at the charts again. So as I said, price on Wednesday tested that higher time frame key level in the form of this range high, and Monday and Tuesday price action were basically a consolidation or a range, and they didn't do anything significant. And our drawn liquidity is lower. So based on this, you can see that we can frame a weekly profile here, which is the midweek reversal profile, because Wednesday tested a higher time frame key level, Monday and Tuesday price action is ranging, and the opposing drawn liquidity is lower. So we're gonna expect Thursday and Friday to be an expansion lower. Let's see what happens here. So you can see right here that Thursday and Friday expanded lower towards the drawn liquidity. You can see that it didn't reach there, but it did expanded lower, which means you successfully framed a weekly profile and a narrative here, and you could have traded this on the lower time frame, right? That also means you could have had 2 days of price action where you could have positioned yourself and CRT on the lower time frame, and you would have had your drawn liquidity and your bias analysis correct. Let's move on to another example. Right here you can see that this is again the same chart here, and let's see how we can again frame a narrative based on this price action. Right here again, after drawing out the key level, you can see that this candle right here is the Monday's candle, and to the left to it we can see that after last week price action we formed this order block. Now the reason this is a valid order block is because it purged liquidity and price closed below it, so this will be a valid key level for us. Now the opposing key level or drawn liquidity is this order block right here, right? So right here you can see that on Monday we started out with this candle and we straight away tested a higher time frame daily key level in the form of this order block. So now Monday has tested a key level and the drawn liquidity is lower, which is this order block. So you tell me what sort of weekly profile can we expect here, right? Of course, it's going to be a classic expansion profile lower towards the drawn liquidity, right? And right here you can see that on Tuesday and Wednesday we expanded lower to test the opposing drawn liquidity, and the weekly objective has now been met, which was this order block of this opposing key level. What you can also see right here is that we are predicting and analyzing this price action on the daily time frame, candle by candle and turn by turn. We are literally analyzing the candle one by one and predicting and determining where it's gonna go, which is what we call determining daily buys. Now we're going to discuss this in later chapters of CPI, but this concept right here, weekly profile, is one of the main one with which we're going to be doing this, with which we're going to be determining daily buy. So we are introducing it, right? Right here, you would have again had 2 days of price action in your favor, and you would have correctly determined your drawn liquidity, and you would have been right about price and your daily buys. Now here we got another example again on the same chart, and we're gonna see how we can frame another weekly profile and narrative here. So if we mark out the key levels and the day of the week on the charts, then you already know what happened on the first 3 days of this week, which is that we had a classic expansion lower because Monday tested the daily order block and then Wednesday reached the drawn liquidity. Now right here again we've got to measure what can happen on Thursday and Friday. And what we can see is that Wednesday tested a key level in the form of this order block right here, and we've also formed this new FEG right here, which could be our potential drawn liquidity. This potential drawn liquidity or opposing key level is also the Wednesday's candle high, which aligns with this FEG. So on Thursday and Friday, we're going to expect price to go higher and reach that drawn liquidity in the form of the FEG. So let's see what happens. And right here you can see that we did exactly that, and Thursday and Friday were up close candles and we reached the drawn liquidity. Now right here on Thursday you can see that the Thursday candle tested a drawn liquidity of the opposing key level, which met the weekly objective. That's why you can see that the Friday candle was an inside bar and didn't do anything significant. It was basically a ranging candle. Moving on, here we got another example. So we've got this naked chart, and let's plot on the key levels in the day of the week and see what we can frame here and what weekly profile can potentially play out. So right here you can see that this candle right here is the Monday's candle, and what happened on Monday is that we took out this CRT low and we also tested this order block. Now this is a homework for you to tell me how is this candle a valid order block and which criteria led to making this order block a valid one. This is a homework for you. and you gotta send me the notes. Okay, so moving on, we've tested a key level on Monday right here already, and the drawn liquidity is higher, which is this range here right here. So we're gonna expect a classic expansion weekly profile higher, and let's see what happens. And right here you can see that that's exactly what happened here. On Tuesday and Wednesday we expanded higher and reached the drawn liquidity. So here we got another example here. Let's put on the key levels and see what we got here. Right here you can see that on Monday we've taken out this CRT high, which is in itself a key level, and you can treat it as a higher time frame key level, right? And also to the left you can see that we've also taken out this range high last week, and we've also had this down close candle which potentially shifted the momentum to the opposite side. And along with that, we've taken out this CRT on Monday in the drawn liquidity or the opposing key level as this range low right here. So based on that, we're going to expect and anticipate a classic expansion weekly profile, because on Monday we've already tested a key level and the opposing drawn liquidity is lower, right? So we can have a classic expansion weekly profile lower. And right here you can see that that's exactly what happened here, and we expanded lower the rest of the week towards the range low or towards the drawn liquidity. Now right here you can see that this is exactly how you frame a narrative and a weekly profile on the higher time frame. Remember this, that you would never use this alone, but instead you're going to use it in conjunction with all the other concepts, and you're going to combine time with it, right? And only then it will work. This is basically an introductory concept to the stuff that we're going to be dealing with in CPI in the future, right? This is basically a stepping stone, and we still have yet to deal with a bunch of other things in CPI that we are going to learn. Now we move on to chapter 8 of CPI. In chapter 8 we will discuss intraday profiles and how intraday profiles will assist us in our trading. So first of all, let's define and introduce what intraday profiles are. So the definition of intraday profile is as following. So they are basically an advanced form of market profiles with whose help we can break down the daily candle into manageable segments, right? And each segment is going to have its own specific fractals and characteristic, right? Now you can see that the definition might be similar to the ones that is of the weekly profiles, and that is because the core concept of both these concepts is the same. The only difference is that with weekly profiles we dissect the weekly candle into segments, whereas with the help of intraday profiles we dissect and divide the daily candle range into multiple segments, right? And then each of these segments are going to have their own fractals and their own nature. And obviously again intraday profile will only work when they are incorporated or integrated correctly with profiles such as with concepts such as speed arrays, key levels, and dealing ranges, and so on. Moving on, intraday profiles will help us with the following, right? We've already discussed it for weekly profiles, and for intraday profiles the only difference is that we'll do it for the weekly candle instead of now we'll do it for the daily candle, sorry, instead of the weekly candle. So intraday profiles will help us with understanding the open high low close or the open low high close of the daily candle. We're going to use it to break down the daily candle, right? We're going to use it to help us determine intraday narrative and intraday session buys. And last but not least, it will help us understand the time aspect of the intraday charts better. Moving on, here we got the different important intraday profiles that we'll discussing, right? That we'll be discussing. So these are the most significant one, okay? So let's discuss each one of them one by one. Now before we move on, you need to remember that the first two intraday profiles here that we've got basically deals with the first half of the day or the daily candle, meaning the first two profiles deal with the Asian range, the London open and the London lunch, whereas the rest of the two profiles deal with the second half of the day, meaning from New York open to London close, and the rest of the day until the daily candle closes, right? Okay, so let's discuss the details of each one of these intraday profiles. So first of all, right here, you need to first of all know the framework that we are dealing with, okay? So this section right here represents the Asian range or flout, and this segment of time represents the London open, which is from 2 a.m. to 5 a.m. Eastern time,
and then this empty segment represents the London lunch kill zone, which is from 5 a.m. to 7 a.m. Eastern time. And after that, we've got this segment which represents the New York Open, which is from 7 a.m. Eastern time to 10 a.m. Eastern time. And then once New York Open ends, the London close starts, and the London close kill zone starts, which is from 10 a.m. to 12 a.m. Eastern time. So this is basically the daily candle divided into multiple segments, right? Which also we call kill zones, and each one of these segments are gonna have their own characteristics, and price is gonna have different nature when it's inside of these different kill zones. So in this sort of profile, the first one that we got, what happens is that the Asian range, which is this segment right here, it starts out with a ranging profile, right? And it also potentially forms a CRT. Now the Asian range of flout or that time of the day is the first 2 4-hour candles of the day. And more often than not, price forms a CRT with these two candles on the 4 hour. And then what happens during the London Open from 2 a.m. to 5 a.m. is that price purges that CRT low, and it takes out that CRT and that Asian range and tests the higher time frame key level. And after that, it expands higher from there to the upside until the opposing key level or drawn liquidity is reached. In this case right here, you can see that the New York Open is a continuation profile because it continued the price action until the drawn liquidity was reached. We will also discuss this profile further in the chapter. Now let's look at how it would look based on lower time frame market profiles, specifically on the 15-minute or the 5-minute. So you can see right here that the Asian session or the Asian range starts out with a ranging profile, right? It ranges at that time of the day. And then London Open, which is from 2 to 5 a.m. What happens is that during London, the price action manipulates below that range and tests a key level, right? And then it expands higher. New York Open then continues that expansion higher until the drawn liquidity is reached till London close. Here is how it would look on the 4 hour. The first 2 4-hour candles of the day, which is basically the flout or the Asian session, you can see that it forms a CRT, and that CRT is then purged during London Open, and price manipulates below to test a key level, and then it expands higher. Moving on, here we got the second intraday profile, which is the delayed protraction profile. And this profile, what happens is that the day starts with the Asian range or the Asian session expanding straight away and testing higher time frame key level. Now in this case is the higher time frame key level in this case has already been tested during the Asian session. What happens during the London Open is that the price action expands straight away without having any manipulation profile like it did in the normal protraction profile. This is how it would look based on lower time frame market profiles. You can see that the daily candle starts with an expansion towards the higher time frame key level straight away instead of forming a range, and then London Open expands higher straight away without any manipulation profile in between because the higher time frame key level has already been tested. This is what we call a delayed intraday protraction profile. This is how it would look on the 4 hour. Now moving on, here we got the second half of the profiles, which as I said before, these two profiles that we're going to be discussing now will deal with the second half of the day, meaning from New York Open till the daily candles closes. The first two profiles that we discussed dealt with the first half of the day, whereas the rest of these profiles will deal with the with how price forms throughout the second half of the day during New York Open and London close, right? So we can see that the London has already expanded higher, and now we have to determine what happens during New York Open and London close right around from here. So the way how we're going to determine that is by looking and seeing whether the London Open zone has reached the drawn liquidity or the opposing key level or not. If the answer is yes, then New York is most likely going to be a reversal. But in this case, you can see that it hasn't reached the drawn liquidity, so the answer is no, right? So the New York Open is most likely going to be an expansion higher towards the key level. Right here you can see that during New Year Open, what happens is that the New Year price action, we have a turtle soup and then we continue the expansion higher, and we expand higher again towards the drawn liquidity. The next New York intraday profile we got is the New York reversal profile. Now in this one you can see that the London Open has reached a key level, which means the daily candle has now reached its objective, and now we're gonna have either a retracement or reversal. In most cases we have a reversal profile in New York if the key level is significant. Here you can see that the London Open almost reached the higher time frame key level, and then as soon as the New York Open segment of the day starts, it tests the higher time frame key level and then reverse from there immediately.
So moving on, here we got another type of New York reversal profile. In this case, what happens is that during the whole first half of the day, price doesn't do anything significant and it just ranges the whole day and forms a range. And then during New York, price manipulates below that range or that consolidation to a key level and test that key level, and then it expands from there. And this is how it would look based on lower time frame market profiles. Price ranges the whole first half of the day without any significant move, and then during New York it has a manipulation profile, and then after testing that key level it expands higher, which look like a reversal on the higher time frame. Now let's discuss some examples before we end this chapter. So right here you can see that this price action on the 4 hour, right? Now these two lines represent the opening and closing times for the day, right? What you can see right here is that during the Asian range, we form a range without testing a higher time frame key level. So based on that, the most likely scenario for price is to manipulate lower to test the key level during the London Open and then expand from there, right? So we're gonna wait for price to see how it reacts and which intraday profile and narrative we can frame here. So right here you can see that during London Open, which is these 3 hours right here, price manipulates lower and test the higher time frame key level, which means we can now have a normal protection profile here. Now based on this, we can expect London Open to now expand higher. And you can see we have an intraday normal protection profile here and price expanded above. Now let's analyze this again and see whether we've reached the opposing end of the range or the drawn liquidity during London Open or not. And the answer to that is no. We can clearly see that price didn't reach the higher time frame objective or the opposing end of the range. So now based on that, we have to expect or anticipate which sort of intraday profile can we expect during New York Open. And you can see right here that the answer to that is a New York Open continuation profile, because we haven't reached the objective. And right here you can see that during New York Open we reached the higher time frame drawn liquidity and these equal highs right here, and the daily objective has now been met. Moving on, here we got another example here. You can see that again during Asian session we formed a range and we did not do anything significant, right? And right here you can see that we still have yet to test a higher time frame key level. So based on this, we can expect a normal protraction intraday profile during London Open. Let's see what happens. And right here again you can see that during London Open we manipulated lower, tested that higher time frame key level, and we had a normal protraction profile, and then we expanded above. Now again right here you have to determine what happens next during New York Open, and you're gonna decide that based on seeing whether the drawn liquidity is reached or not. And right here you can see that it's not reached because we still have yet to take out that range high. Hence that's why New York Opens turns out to be a New York continuation intraday profile. Right here you can see that we retraced to the key level again before moving higher, but you can see that the low formed during London Open was protected and we never took out that low. Moving on, here we got another example. Right here you can see that the Asian session has already tested a higher time frame key level. So based on this, we can expect a delayed protraction profile, and we can expect London Open to expand straight away without any manipulation profile, because we've already tested a higher time frame key level during Asian session, right? And right here you can see that that's exactly what happened during London Open. Now also right here you can see that during London Open we've also tested another higher time frame key level or the opposing drawn liquidity, and that has been now reached. So now we have to determine what happens during New York Open. So right here you can see that the drawn liquidity has already been reached. So New York turned out to be a New York reversal intraday profile.
SilkRoad5.com. Buy or sell for free.
Hello everyone, welcome to Trade Breakdown on EU. So I'm going to continue the theme of these breakdowns by explaining these trades and their thought process right from the daily chart, and then we're going to move on to the lower time frame and discuss how this trade was taken and what were the factors that led me to taking this trade and why did I have so much conviction in this trade that I managed to execute it properly. Also, as these new chapters are released every weekend, I'll start adding them to these breakdowns too, and will show you the live application of all of those concepts. That way you can replicate them in your own analysis and trading, and they'll assist you more than anything. The weekly chapters alone are good enough to help you understand the market dynamics, but what actually gets you to the next level and make sure that you actually get everything out of these concepts is by watching these trade breakdowns and seeing how I've used these concepts in my analysis and how they've led me to taking trade ideas or generating trade ideas. So let's look at the charts and see what we've got here. So right here, first of all, you can see that with this expansion swing, we took out this range low and this range high. Now, if you watch the previous breakdowns, then you'd remember that our drawn liquidity is still higher, which is this range high right here. And we derived that from the weekly chart analysis, right? So the drawn liquidity is higher, and we've taken out both range high and range low with this expansion swing, which means it's a bullish dealing range, right? So inside this bullish dealing range, we'll have both discount and premium region, and each will have their own respective key levels. Now, if you remember the previous chapters about dealing ranges, then you'd remember and you'd know what type of reaction each key level offers depending upon their position inside this dealing range. So premium key levels would only be able to offer retracement or small reactions, whereas the discount key levels inside this bullish dealing range would be able to offer reversals on the lower time frame or expansions on the higher time frame. So right here we're gonna see what are the different key levels we've got inside this dealing range and what sort of reaction they offered. So right here you can see that the first key level we've got inside this bullish dealing range is this order block right here, which lies in the premium region, right? And then we've got this FEG, which is inside the discount region. And along with that, we've got this order block, which is also in the discount region, along with this FEG. Now, if you look at this price action right here, then you would see that price first retraced to this order block right here inside the premium region. And because it was in the premium region, it only offered a retracement and a small reaction, right? And then it expanded lower. Now remember, just because it offered a small reaction or retracement, it doesn't mean that you cannot trade it or that I didn't trade it, right? If you remember the previous breakdowns, then you'd remember that I actually had a long or a bullish trade right here in this price action, and my target for that trade was this FEG right here or this Wednesday's candle high. And even though I took a trade here on the lower time frame and it brought profits to me, I was aware and conscious of the fact that I have to be vigilant and cautious when trading inside this price action, because I knew the price can expand on me lower again because it has to test a discount key level before it moves higher. Now there were multiple factors behind the trade that I took here, And the reason why I was so confident in that trade idea is because there were multiple factors like weekly profiles, intraday profiles, and time backing up that trade idea. That's why I took it, right? Then after price had this reaction right here and it found this new FVG, it reacted to it and expanded lower again to test a discount key level in the form of either this discount FVG or this discount order block before it starts moving higher again towards the higher time frame drawn liquidity, which is the range high above. Right here you can see that as soon as this week opened, what happened is that the Monday's candle had this down close candle, right? And what Monday also did is that it tested this daily key level right here straight away from the start of the week, and this key level was in the form of this FVG, right? And also with that, our opposing drawn liquidity or opposing key level that price can potentially be drawn to is this discount key level right here in the form of this FVG, right? So you can see based on this framework right here, we can work with this range and we can potentially look for shorts inside this range with our drawn liquidity being this discount FEG, because we know that if price is going to expand higher, first it will have to retrace to a discount key level, which is this FEG based on the bullish dealing range, right? So based on Monday's price action, we can expect a Monday high of the day because Monday tested a key level, right? And potentially for the rest of the week, we can expand lower towards the drawn liquidity. Now, what happened on Tuesday is that we had this candle right here, right? I didn't found any setups on Tuesday, so I stayed away. And then on Wednesday, what happened is that we had found this new FVG right here, this new key level that can price react off of potentially. So on Wednesday, I expected this FVG to be tested as a key level, right? And then I expected price to expand lower again towards the drawn liquidity, which is the FVG below us. Right here, based on this price action right here, you can see that not only you would have expected a Monday high of the weekly profile, but also a Wednesday midweek continuation profile too, because Monday first retraced back higher to test a key level and then it expanded lower to continue the weekly expansion lower towards the drawn liquidity. So that was my daily high time frame thought process on Wednesday, right? Expect this FEG to be tested, right? And then look for a short and trade it on the lower time frame and trade it towards the drawn liquidity lower. So you can see that the main two objectives on the higher time frame, which are determining my daily buys and intraday buys and determining my drawn liquidity, have now been accomplished. And based on our analysis, we determined that price is going to be drawn to this FEG right here. So the higher time frame thought process and analysis has now been done, and we've determined our drawn liquidity, which is lower. Now we're going to move on to the 4-hour time frame to find a CRT there and then position ourselves in that CRT towards the higher time frame drawn liquidity and then potentially trade it on the 15-minute time frame or the lower time frame based on time frame alignment. So let's go down to the 4-hour time frame and see what we've got there. So on the 4-hour, first of all, we're going to plot out our opening and closing times for the week so that we can see where we are inside the weekly range and what sort of weekly profile can we potentially expect. Now I've already explained all of this price action right here to you on the daily time frame, but let's revise it here again. So Monday immediately with the weekly opening tested a key level and expanded lower, and then Tuesday had this price action right here in the form of this ranging profile, and it didn't offer any favorable price action for me to trade, so I just stayed away. And then what happened on Wednesday is that we expanded above to the daily key level, which is the daily FVG, but not only that, we also expanded toward this 4-hour key level in the form of this FVG during the 5 a.m. candle. Now right here, I waited for this candle to close, and once it closed, I took this candle as a CRT and traded it on the lower time frame. Now right here, if you look at the closing of this candle right here, then you'd see that there is a whole dynamic in the closing of this candle in itself. If you look closely, then you'd see that this candle tested this FVG, but it never closed inside of it or above it, but instead it closed below this FVG, which suggests that the price action is showing bearish sign because it wasn't able to close inside of it. That's one of the reasons why I had so much conviction in this trade idea, right? The closure of this candle right here. This is also a factor that you can add to your analysis, right? You can look at the closure of the candle
and that can in itself tell you a lot about what price is telling you. Now if this candle had closed inside this FVG instead of closing lower, then I still would have taken it, but I would have been more cautious around here and I would have risked lower than I usually do because of this factor, right? So right here, once this candle closed, I took this candle as a CRT because first of all, it not only tested a 4-hour key level, but also a daily key level in the form of this FAG. The second factor is the closure of this candle, which is that the candle was unable to close inside the FAG, which showed bearish signs. The third factor is the timing of this candle, right? It's the 5 a.m. CRT, which are potentially good CRTs for reversal trades. And not only those factors, but also this CRT was purged at a key time, which is the 9:30 Eastern time, which is a good macro for CRT purges, right? The reason 9:30 is a key time is because 9:30 is the Nasdaq opening time, which is a key time for manipulation, expansion, or CRT purges. So all those factors led me to taking this candle as a CRT, right? I'll be making a separate chapter on CRT in later levels of CPI, discussing all of the factors and intricacies, but these were some of the factors that led me to taking this candle as a CRT. So you should note these factors and potentially look for these factors in your CRTs as well. And if your CRT doesn't follow and doesn't have these factors, then you shouldn't be trading it. So on the 4-hour again, my objective is accomplished, which is that I had to find a CRT, right? And then position myself and that CRT towards the higher time frame down liquidity, right? So now I'm going to go down to the 15-minute time frame and look for an entry there. So let's go down to 15-minute and see what we've got there. Right here, first of all, I'm going to put on the opening and closing times for the day, and then we're going to see what we've got. So right here, you can see that during the first half of the candle, we had a normal London protraction profile, due to which London had a manipulation profile and took all of this liquidity, and then we expanded higher, and with that expansion we tested a higher time frame key level, and we know that our higher time frame drawn liquidity is lower, right? So based on these factors, we can expect a New York reversal profile, because we not only tested a higher time frame key level during the New York session, but also our drawn liquidity is lower, our higher time frame drawn liquidity is lower, right? And also with that, we've got this CRT on the 4-hour as well, which we're gonna trade. So based on these factors, I expected a New York reversal intraday profile. Now right here, you can see that this CRT high was purged on during the 9:30 opening time, which means we had turtle soup during that time, right? Now there are different ways with which you can trade a CRT, right? We've got the model 1 entry, which is basically the order block entry. We've got the breaker entry, the case out date or the KOD entry, and we've got many other models too, right? There are many entry models with which you can trade a CRT, and your job as a trader would be to test all of those models, right? And gather data around those models, and then see which model suits you and your style the best, and then stick to that model and consistently trade it, right? Now in later levels of CPI, I'll be sharing all of these models with you, so don't worry about that, right? It's all predetermined and pre-planned. Now my favorite ones are, first of all, the model 1 entry and the turtle soup advanced entry, right? Now the model 1 entry has a confirmation factor to it, whereas the turtle soup entry doesn't require any confirmation, right? So for most of you, you should just stick to model 1 entry, because that one has the confirmational factor to it, right? But once you get more advanced, you can trade the CRT based on the turtle soup entries too. Now the turtle soup entry has got a lot of intricacies and details which will require a separate chapter on itself, but let me discuss it briefly here, and let me discuss how I took a turtle soup entry on this CRT. Now there's a proper logic behind choosing between model 1 entry and turtle soup entry, and we're going to discuss it later, but here I choose to trade this CRT based on the turtle soup entry, right? Now one way how you can trade it here is basically, as soon as this high gets purged, the CRT high gets purged, right? You take a market order entry there, and then you put a stop loss of 8 to 10 pips, right? Or you divide the range of this whole CRT
and then determine your stop loss based off of that, and put your target either at the 50% of the CRT or the opposing end of the range of the CRT, right? Now this way of trading CRT is a bit risky and aggressive because you have to be really cautious of the price action right here, and this type of entry should only be taken at specific key levels and only when specific factors are backing up a trade idea or the CRT. As I said before, I've shown this to you just for educational purposes, guys. Alright? And most of you, if not all of you, should just stick to the model 1 entry because that one is more objective in terms of its stop loss placement, entry and targets. Now the reason I said put a stop loss of 8 to 10 pips here is because I've tested that myself, right? And for cases as such or scenarios as such, that stop loss placement works for me on the 15-minute time frame, right? This isn't the same for all time frames, remember. It depends upon your entry time frame too. For example, if you are, let's say, trading it on the 1 hour time frame, then your stop loss in terms of pips would be much higher and larger because the momentum on that particular time frame is larger than the 15-minute time frame, right? In other cases, you can put the stop loss above another block's high or FVG is high on the 15-minute too, right? And this type of turtle soup entry. But as I said before, I've discussed it briefly here just to spark your curiosity and give you a sneak peek to what we're going to be dealing with in later levels of CPI, right? This was the trade breakdown. Now right here you can see that this is my execution of that turtle soup entry, right? My stop loss was around 8 pips and then I target this CRT low right here, and that was my trade. I also took this trade right here on Thursday. If you want me to break down this trade as well and what were the factors that led me to taking this trade, then you can let me know, right? Hello everyone, welcome to yet another trade breakdown on EU. We're gonna start off again with the daily time frame and we're gonna see what we've got there. Now if you haven't watched the breakdown that I uploaded before this, then you should watch that one first and then come here and watch this one. So moving on to the breakdown, right here on the daily time frame, you can see that we've got this bullish dealing range right here. Inside this dealing range, we've got multiple key levels in the form of discount and premium key levels, right? This premium key level right here in the form of this order block only offered a retracement or a small reaction, whereas this key level in the discount region offered a complete reversal because we are in a bullish dealing range and now price has rebalanced the whole range by testing a discount key level, right? And now it can continue going higher towards the drawn liquidity. Now remember the chapter about dealing ranges, what I said in that chapter about how price react to key levels based on their position inside dealing ranges and expansion swings. What I said in that chapter is if we are in a bullish dealing range, then premium key levels would only be able to offer a retracement, whereas discount key level would offer reversals or higher time frame expansions, and that's exactly what happened here. So right here what happened is that we came back down to this discount key level during Thursday price action, right? Now my drawn liquidity for the first half of the week was this discount key level in the form of this daily FVG, and now price has reached that drawn liquidity on Thursday and now we can expect a reversal from here. The reason I and you're gonna expect a reversal in this case is first of all a discount key level has been tested, right? And the dealing range as a whole has been rebalanced, meaning we've retraced back to the equilibrium and now that range or the dealing range has been rebalanced and now price can go higher. And also along with that, it's the first week of the month and we've got NFP, right, which is a red folder high impact news event which will act as a catalyst to drive price higher towards the higher time frame drawn liquidity. So based on this framework, I expected Thursday to form the low of the week. Now for the first half of the week, our high of the week was Monday because Monday tested a key level, and that stayed true for the remaining rest of the week until Friday because now Friday has NFP, right? As I said in chapter 8 about weekly profiles, I said that weekly profiles are dynamic and adjustable, which means that they're gonna change based on price action of previous days and based on how price reacts to key levels inside dealing ranges. And now that price is reacted to this discount key level inside this bullish range, I expected the Thursday weekly profile from here, and that's exactly what happened here, right? So my drawn liquidity in buys, my daily buys after this key level was tested, turned bullish, and my drawn liquidity was then higher. So you can see that the daily objective has now been accomplished, right? I have determined my drawn liquidity, which is higher, and I've determined my daily buys, which is also bullish, right? I'm gonna go down to the 4-hour time frame and try to find a CRT there and position myself in that CRT and then potentially trade it on the lower time frame. So moving over to the 4-hour time frame, right here you can see that we expanded lower on Thursday towards this discount FEG, right? Inside the whole bullish dealing range. And we tested it on Thursday. Now we know that after an expansion tested discount key level, the only outcome is a reversal profile, right? But obviously we have to first position ourselves in a CRT and only then we're going to take an entry. And another thing is that price tests this key level during Thursday. So based on that, we can expect a Thursday reversal weekly profile here. So we've added another factor which can act or which can assist us in our analysis. Now what happened on Thursday here is that we've got this candle right here, and this candle closed just above this key level, and this is the 1 a.m. candle, right? So I took this candle as a CRT and I decided I'm going to trade it on the lower time frame. I waited for this CRT to be purged and the key level to be tested, right? And then I expected a reversal from here. Now let's move over to the 15-minute time frame and let's see what we've got there. So right here on the 15-minute, you can see that the weekly candle, the daily candle opened here, and straight away it went into a ranging profile. And with this ranging profile, we tested a key level in the form of purging this CRT high, right? So right here you can see that during the Asian session, we already tested a key level, right? So now during London Open, we can expect a delayed protraction intraday profile because key level has already been tested, and now we don't need to have any manipulation profile, and we can expect London Open to expand straight away without any manipulation profile whatsoever. And you can see that's exactly what played out here. Now also during London Open, you can see that with this delayed protraction expansion, we came down lower and we tested a discount key level in the form of the daily FEG, and we reached the drawn liquidity, and the higher time frame drawn liquidity has been now met, right? So based on this, we can expect New York to be a reversal intraday profile, right? Because the drawn liquidity is now being reached, the daily objective has been met, and now we can expect New York to be a reversal profile. Another thing is that I also took my entry here during the London lunch, which is from 5 a.m. to 7 a.m. Eastern time, right? The reason I expected a reversal during this particular time is because when a higher time frame significant key level like this daily fair value gap is traded to during a key time like London lunch, it most likely results in a reversal, right? In a reversal profile. And that's why I had conviction in this trade idea and traded it. I waited for a model 1 entry here, and as soon as we got this entry set up right here and we formed this new order block, I put my entry at the order blocks open with my stop loss below the order block low, and I targeted the 50% of the CRT, right? This was the trade breakdown. Hello everyone, welcome to chapter 9. This chapter is going to be about market structure and how we're going to use market structure to build a narrative and gain insights to the market dynamics. Now this is one of the most underrated concepts, and it's quite overlooked by the ICT and CRT community. And in this video I'm going to make sure to explain everything about market structure, its advantages, disadvantages, and the correct way of using it to probe and measure order flow. I'll also be giving you some important points regarding basic and advanced market structure that you need to be aware of when using it in your analysis. I'll be explaining both basic and advanced market structure and we'll differentiate between the two, and then I'll give you a framework for how you can correctly identify and use market structure in a proper way and manner. I'll also provide you with the time frame that you should be looking for market structure, both as an intraday trader or as a swing trader. So let's move on to the chapter. So first of all, we're going to start off with introducing what market structure is and what are its key elements and how you're going to be dealing with it, right? So the framework within which price movement occurs is called basically market structure. Now we're going to objectively define that framework, and we're going to discuss how you're going to approach that framework logically. So basically, when you look at the charts and see price with a naked eye and without any annotation whatsoever, you may have conflicting ideas about it, right? And it may seem a bit ambiguous. But then as you start analyzing it with the concept that we've discussed so far in CPI, you're going to see that it starts to make sense, and you'll then get a range to work with, right? And a framework to work with, and price would be stuck in that range and framework, right? Now for that range of framework of price, you're going to use market structure to deal with it, right? And to approach that framework properly. That particular framework of price within which market movement occur is called market structure. Moving on. Now, the key elements of basic market structure are just simple highs and lows, right? We know that the markets are made up of multiple and various types of highs and lows. And it's actually these highs and lows which makes up the whole market and defines its structure. Now, there are multiple methods to approach these highs and lows, and that will define your type of market structure and your position as an analyst, right? If you approach it basically with just highs and lows and define and generate opportunities or trade idea based off of that, then that means you're using basic market structure. But if you're using advanced methods to approach those highs and lows with a more logical and slightly more objective framework, then you're going to be approaching that particular framework with a more enhanced perspective, and that means that you're using advanced market structure, right? So the basic and key element for market structure doesn't matter whatever type of firm it is, it's just simple highs and lows or swing points. These three things are the main things that make up market structure, right? It doesn't matter whatever form or type it is, right? These three things, highs, lows, and swing points, make up market structure. Now, another thing about market structure is that it's inherently quite subjective in its core concept, right? Because highs and low can have multiple forms and they can be defined in multiple and various manners. So due to that fact, market structure can be quite subjective and ambiguous at times, right? But there are certain ways with which you can make it a bit more objective and logical around its framework, and I'm going to show you in that way. I'm going to show you that in this video. So due to the fact that market structure is inherently subjective, that's why market structure would be only be used as a confluence for pre-existing ideas or pre-existing frameworks, right? Which means you must never use it as a main basis. You should never start analyzing the charts with market structure. And that's the exact reason why I explained market structure to you later in CPI, because I didn't want you to approach it as something that could be used to define the charts and define trade ideas predominantly, right? I didn't want you to have that perception about market structure. That's why I explained it later to you in CPI, because I want to give it to you as something that could be used as a confluence rather than as the main basis. So you should be only using market structure for previously existing ideas and frameworks, right? And only use it there as a confluence to either gain more conviction in your analysis or to assist you in your analysis, right? And you could also use it to classify different ideas in terms of their probabilities. So for example, if you've got a pre-existing idea and it's a bullish trade idea, right? And then you analyze the charts with market structure and you see that the structure is bullish, then you could classify that particular idea as a high probability idea. Whereas if you have a bullish idea or a trade idea that is in the bullish side, right, or a long trade idea, and then you analyze the charts with market structure, and the market structure is actually showing you that price is bearish, then you could classify that trade idea as either an average probability trade idea or a lower probability trade idea, right? That's how you classify different ideas in terms of their probabilities with the help of market structure. So to summarize market structure and its introduction, first of all, it's a framework within which market movements occur. Secondly, its key elements are highs and lows and swing points. And last but not least, it is used as a confluence rather than a main predominant basis. Alright, let's move on to the next slide. So first of all, we're going to start off with basic market structure, right? Now, basic market structure is something that I only used in my initial stages of my journey, right? And I've stopped using it. But the reason why I'm going to explain it to you here is because it's going to build your basics and fundamentals, right, surrounding market structure. And as we move on to its advanced prototypes and protocols, you'll be able to understand those parts better and easily if you are aware of its basics, right? And it stays true for any other thing or every other field. Even though we know that we're not gonna use a basic concept or a basic theory for making money or making business decision, but we still learn them at first because we know that in order to move on to the next level and reach that next level, right, or to become more advanced and more competitive, we have to first build our basics and fundamental understanding. And that's why it's necessary for you to be aware of its basics, right? Even if you think that you've learned it before, right, it will be completely worth it for you. So as I said before, the main and key elements for basic market structure are highs and lows, right? It's basically what is it made of. Second thing is that it should only be used as a confluence, right? As I said before, and not as the main basis for generating or defining trade ideas or frameworks. Third thing is that basic market structure is not that significant in its core concept inherently, but it's good to be aware of to build your subconscious biases, right, and subconscious ideas surrounding price when you're dealing with it. Now remember, I'm talking about basic market structure here, right, and not the advanced one. So remember, there's a difference between the two, and we're going to explain the advanced market structure once we go through this one right here. Moving on, in basic market structure, we've got three types of market structure, right? We've got the uptrend, the downtrend, and last but not least, we've got the range, right? Now we're gonna move on and we're gonna see how each of that structure is made up of, right? And what is the combination of each of that structure, and what is the combination of highs and lows, right? Some of you might be aware of it, but it's good to revise. So let's move on. So right here we've got an uptrend, right? There are multiple names to it. You can call it a bullish trend, a bull trend, or anything you want, right? But the idea is that that uptrend is made up of highs and lows, which consistently moves higher, right? Just as the name suggests. Right here you can see that we start off with a low, and then what happens is that price continues moving higher and makes a high. Now that price is made a high, it has to first retrace back before it's move higher again. So when it forms this retracement right here and then it ends it, that retracement forms a higher low, meaning a low that is higher than the previous low, as you can see, right? That is how we define a bullish market structure in an uptrend. Similarly, when price keeps moving higher again, it eventually makes or forms or produces another high, which is higher than the previous high price had made earlier, which is why we call this type of high as a higher high. And that framework continues and price keep making these higher highs and higher lows until a higher time frame objective or drawn liquidity is met, right? This is how we define an uptrend in its core concept, right? This is just basic knowledge. Now let's move on and define the second structure, which is a downtrend. So a downtrend or a bearish market structure starts with a high, and then what happens is that price moves lower and makes a low. Then after that low, we have a pullback or a retracement, right? before we can continue moving lower again, right? That retracement, right, after price makes a low, forms another high which is lower than the previous high, which is why we call this type of high a lower high. This lower high represents that the structure is bearish, right? Similarly, we form another low which is lower than the low it previously formed, which is why we call this particular low a lower low. And then price continues that framework of this bearish market structure. This is what we call a downtrend. Moving on. And again, last but not least, we've got a range, which is another type of market structure, and it's a bit more advanced and has much more details. But the core concept is that when price forms two significant points, right, in the form of a high and a low, and then price is stuck between that high and low, and it isn't able to break above or below that high and low, right, or those swing points, and it doesn't show any signs of a trend or momentum, that type of structure is what we deem as a range, right? Now range has a lot of more details and there are different intricacies to it and how you could trade it, right? And I'm going to be making a separate chapter on it too, discussing everything about range, right? And how does it look and how it works on a basic and minor level, and how you could approach it on a much more advanced level and how you can trade it, right? I'm going to be making a separate chapter on it in later levels of CPI. So yeah, okay. So moving on, now that we've discussed basic market structure, we're going to move on to advanced market structure, and that is going to be our predominant focus in this chapter. I'm going to be showing you how is it an advanced version of structure and how you're going to be using its detail and intricacies to deal with price in different situations. So this type of market structure provides a more refined and accurate perspective of price and how you're going to be approaching it. This type of market structure or advanced market structure considers breaking and rejecting of highs and lows. Now we're going to discuss what each of them means in just a minute, but that's what it's specifically based around, right? Breaking of highs and lows and the rejecting or rejection of highs and lows. Another important thing about advanced market structure is that it integrates or combines other important and critical methods with which you can gauge, measure, or probe market order flow or structure. And the thing about those methods is that they are based around practical concepts that actually relates to price, and you're going to be able to see them on the charts in a logical fashion, unlike basic market structure which is based around unrealistic theory and which you won't ever see on the charts and they're just cherry picked, right? Basic market structure is just to build a fundamental understanding, right? But the thing about that is that when you look at the charts and price, they never look like that, right? The underlying concept is going to be there, but it'll never look clean and sweet to you like that as I shown you in the images before, right? But with this type of structure, advanced market structure, the framework and ideas that I will discuss with you in this chapter, you're going to see that perfectly on the charts when you combine it with the other concepts, right? And you would be able to classify price action into different structure easily, right? And simply based on objective rules and criteria that I'll give you in this chapter. Now let's move on to the next slide and let's discuss the different methods, right? So first one we've got here is the breaking and rejection or rejecting of highs and lows, right? Now if you go on the charts and use these exact concepts and criteria, then you're going to see that this is exactly how price moves. But remember what I said before, you must never ever use these concepts alone or as something to define an idea in the first place, right? It should only be used as a confluence or as a second hand when you've already developed frameworks or trading ideas, right? So you must remember that. Now let's define an uptrend or a downtrend based on this. So when price is consistently breaking above highs and rejecting below lows, which means that price is only able to break above highs when it, right? And when it comes to lows, it's only able to reject them and unable to displace below those lows, right? Then this type of structure is what we deem as an uptrend. And this right here is refined and as close to real structure as it gets, right? It's the most refined definition for an uptrend or a bullish market structure that I could find. Now, by breaking above highs, I mean that price is consistently closing above highs and is and having proper displacement and expansions above highs, right? And it is consistently making higher highs, right? Which defines a bullish market structure. And by rejecting or rejection of lows, I don't mean that it's not able to close below it or price isn't able to go below it, right? It definitely can, and it does oftentimes in this type of structure. But what happens is that these closes, right, or these moves below these lows are often faded, and price reacts from there and goes higher immediately. And the reason why it does and it forms these rejection below lows is to manipulate traders into thinking that the structure is shifted when in reality it hasn't, and the only thing that it's doing is rejecting or rejection below these lows, right, to take out liquidity. Rejection could also come in the form of price closing below too, but then what happens is that price immediately goes above without staying there for a large amount of time. That's what we call rejecting below lows or rejection of lows, right? Similarly, for a downtrend, it's classified when price is consistently breaking below lows and rejecting above highs, meaning it's unable to go have a displacement or expansion above highs, which is what we call rejecting above highs, and predominantly it's only able to expand lower below lows by breaking them and closing below them, right? This is how we classify a bearish market structure: breaking below lows and rejecting above highs. Now let's move on to the next slide and see how each one of them would look. So right here we've got an uptrend or a bullish trend, which means that our drawn liquidity is higher, or that we've done our analysis and everything, and we know that our objective is to move higher to reach the drawn liquidity, which is higher basically, right? So right here you can see that we've got these highs and lows right here, right? And what you can see in this price action is that the price is in a bullish trend, and it's pretty obvious because it's making consistent higher highs and it's breaking above old highs to make new highs, right? But if you zoom into this price action right here, then you'd see that price actually went below this low right here, and maybe it even closed below this low, right? Now if you were looking at this price action with a typical or basic market structure, then you wouldn't then you would have inaccurately and wrongly classified this as a change in structure, right? But because you're using advanced structure and you're using logical framework, you know that this move below this low is just to manipulate retail traders, and this is just a rejection below this low, right, to rebalance the whole range. And you would know that it's pretty common for uptrends. So with this in mind, you wouldn't have gotten scared by this reaction, but instead you would have approached it and traded it, because you know that this is just a counter reaction to take out retail traders or take out liquidity. Whereas we are looking at it, right? Take out liquidity, right? That's how you look at this price action with a refined perspective, and you can approach it with a logical perspective, right? This is what we call rejection of lows. This is exactly what happened even here. We got below this low, but eventually we expanded above to break the high to make a new high called higher high, and we continue that trend towards return liquidity. So you can see right here, this is how price moves in a bullish trend. It reject below lows and it break above highs, right? If you go on and practice this exact thought process, then you'd see that more often than not, this is exactly how price generally moves. Now let's move on and see how does a bearish trend looks. Again right here you can see that the drawn liquidity or the higher time frame objective is lower, right? And what happens is that price starts this journey and start making these highs and lows. But the reaction to these highs and lows aren't typical, right? You can see that price is moving logically by breaking below lows consistently. But not only that, price is also taking out counter liquidity in the form of rejecting above highs and manipulating out retail or basic traders, right? This is how a bearish advanced market structure looks. Price break below lows and reject above highs by taking out liquidity. This rejection could come even in the form of closing above it, but what happens is that price isn't able to stay there for a long amount of times, and that rejection is short-lived. This is how we classify a rejection, right? Now we're going to move on to the next slide, and we're going to add another filter to market structure, and we're going to make it even more advanced, right? So in basic market structure, we only have highs and lows, right? And higher highs or higher lows, or lower highs or lower lows, right? But when it comes to advanced market structure, we also include short-term swing points or intermediate-term swing points. We have another one which is called long-term swing points, but that's not a topic for now. You can only deal with the short-term swing points and intermediate-term swing points, and that would be more than enough for you. So inside short-term swing points, we've got short-term highs and lows, a short-term high, and short-term lows. And with the intermediate swing points, we've got intermediate term lows and intermediate term highs, right? Now we're gonna accurately define what each of them means, and how we can classify them. But you need to remember that these are the main aspects and key elements which makes up advanced market structure. So right here we've got a bullish trend or an uptrend, and our drawn liquidity is higher, right? That's a framework we're working with. So we learned that in an uptrend, we break above highs and we reject below lows. That's how we accurately define and objectively classify market structure into an uptrend precisely, right? So what you need to know is that that each high and low price forms will be called or classified as a short-term high or a short-term low. It doesn't matter whatever high or low is it. Every single high or low that price forms will be considered a short-term high or either a short-term low, right? So for instance, this low right here is a short-term low, and that high is a short-term high, which means every high and low you see is either a short-term low or a short-term high. If it's a high, then it's a short-term high, but if it's a low, then it's a short-term low, right? So that's basically how we classify short-term highs and short-term lows. It's pretty basic, right? The way how it gets advanced is when we add intermediate term swing points or intermediate term highs and intermediate term lows. And there's a unique way to classify these highs and lows, right? So we know that in an uptrend we reject below lows, but those rejections are pretty dim, right? Meaning they are short-lived and price expands above quite immediately after that happens, right?
So when price rejects below a low and then it expands above, it forms a low there, which will be regarded as a short-term low as well. But then what happens is that price retraces back and form another short-term low to the right of that short-term low that we had formed earlier after rejecting below that other short-term low, right? This one. Do you understand what I mean? Let me say it again. First of all, we form this short-term low, right? And then price comes down again and reject below this particular short-term low and have this rejection right here. And after this rejection, we form this new low right here, right? Now this low will be also regarded and considered as a short-term low. But then what happens is that price expands above and it retraces back. And now that it retraces back again, it forms another short-term low. So now you can see that this short-term low right here has two short-term lows to its opposite side. The first one it has is to the left, which it rejected below, right? So we've got this short-term low, price rejected below this short-term low, and then we've got another short-term low which form after the retracement. So due to this low will now be regarded as an intermediate term low, right? You can see it to the opposite side of this short-term low that we formed after this rejection. We've got two short-term lows, and now this short-term low is going to be classified as an intermediate term low because it's a unique one. First of all, it formed after a rejection below a low, below this low, and second of all, we've got not one but two short-term lows to its opposite side, right? One to its left and one to its right. So for that reason, this low would be regarded as an intermediate term low, right? Now the unique and important thing about this intermediate term low is that this low is what we also call a protected low. You may have heard me or Romeo talk about protected lows in high, right? And you might have second guessed yourself, wondering what the fuck we are actually talking about, right? And and if you didn't know the answer, then this right here is exactly the answer to that, and how we classify protected highs and lows, right? A protected low or intermediate term low, or a protected high or intermediate term high, are basically swing points which forms after rejection below highs and lows, right? And either bullish trend or bearish trend, right? And they've got two short-term highs and lows to its opposite side, right? And that is why we call these type of short-term highs and lows intermediate term lows or highs, right? And right here you can see that this protected low, which formed after the rejection below this low and this bullish trend, right? And now we've got two short-term lows to its opposite sides, uh, and that is why we consider this particular low as an intermediate term low. And this is the exact low, right, that could be used for two main purposes. It could be used for placing your stop loss, and it can even be used for invalidation areas, meaning areas where your idea or potential idea is invalidated, right? And you're going to ditch that idea if price goes below that low, because now price has shown you weak signs, right? This is how we classify short-term highs and lows and intermediate-term highs and lows, right? uh, another thing about uh, uh, another thing about this is that rejection below lows in an uptrend only occurs below short-term lows and never below intermediate-term lows, because intermediate-term lows are always protected and you'd never see price go below an intermediate-term low in an uptrend. It is only able to go below a short-term low, right? These are some of the important points regarding short-term swing points and intermediate-term swing points. Similarly, if you are looking for liquidity to be taken out and you want to see whether where could the turtle soup occur, or the purge of the liquidity or rejection of the lows occur, then for that you should be looking for short-term lows and not intermediate-term lows, right? Remember that. Last but not least, you can see the price breaks above highs in a typical fashion and continues the uptrend. Now let's move on and let's define intermediate term highs and short term highs and short term lows in a downtrend. So right here again you can see that price is consistently breaking below lows and rejecting above highs, and is moving towards the higher time frame objective or drawn liquidity. We know that each of these highs and lows are basically classified as short term highs and lows without any confusions or doubts whatsoever, right? Now the way how we classify an intermediate term high is through the following manner. We wait for a short-term high to be rejected, meaning we look for price to reject or go above that short-term high to take out liquidity. And then once price does that and it expands lower again and forms that new short-term high after that rejection, we wait for a retracement and wait for another short-term high to be formed to its right. And once that short-term high is formed and produced, that other short-term high that was formed after the rejection of the short-term high to the left is now classified as an intermediate term high. And that high would be an important level for price because it can be used as an invalidation area. And most of all, that high would be protected at most of the time, right? And price usually never takes that high out unless and until the drawn liquidity is met and the objective of the higher time frame is reached, right? If you need to rewatch this video, then make sure to rewatch it again, because this one has got some really good details that you can make notes of. Now we're going to move on to the next slide and we're going to discuss how we can identify correct, logical and proper structural shifts, right? Now we know that market structure shifts is a weak and incorrect and improper concept, right? And it never works the way how you've used it, right? Typically. But at the same time, we have to define and know how we can correctly identify and classify an advanced structural shift. It's going to be different from the typical that you know of, right? And that you've heard of is going to be different than that. And and I'm going to discuss this in this chapter. Before we do that, we've got some prerequisite and requirements for structure shifts, right? Because just as I said before, you would not be using advanced market structure alone, but you're going to be using it rather as a confluence for the pre-existing concepts and ideas, right? The same manner you're going to be using the concept right here only in conjunction and integration with other concepts and profiles, and only then you'd be able to identify correct structural shifts, right, accurately. So the main important prerequisite for structural shifts are the following. First of all, you need to be in line and in sync with the higher time frame drawn liquidity, and you must never trade against it, right? That's what you need to remember first of all. Another thing is that you would only be classifying and defining and finding structural shifts only and only and only if they occur at a higher time frame key levels, right? Write that down. If they haven't been formed at a key level and a higher time frame key level, then fuck it. Don't classify that as a correct one, because a higher time frame key level is a must for this concept right here. Similarly, the most accurate, precise, and significant shifts and changes occur during key times in macro. For example, they occur during important days or during kill zones, right? So this is also an aspect you could add to your arsenal when looking for shifts at key times at higher time frame key levels, right? And only in the direction of the higher time frame down liquidity. These are the prerequisites that must be followed, otherwise you'll be inaccurate and imprecise. Now moving on to the next slide, let's discuss how we can confirm a bearish structure shift while using all of the concepts in conjunction with the advanced market structure. So what you're going to look for is you're going to wait for the low that breaks the high and leads price to a test a key level to be broken. And once that particular low is broken, the structure changes and it shifts to bearish. Now again, this only stands true if price tests the higher time frame key level and then the next higher time frame objective or down liquidity is lower, right? And the shift happens at a key time. When the low that breaks the high gets broken, it's result in a correct structural shift. And let's see how it would look. So right here you can see that first of all we are in a bullish trend, meaning we are breaking above highs and rejecting below lows. And then what happens is that this low right here breaks above this high, and not only that, but it also tests a higher time frame key level. So now if the higher time frame objective has been met and you're looking for a structural shift, then the way how you'll anticipate that is by waiting for this low to be broken and closed below. The reason I chose this particular low is because this was the exact low that broke this high, and this exact low led price to test a key level, a higher time frame key level, which means this is the significant low, and when it's broken below, structure will change. And you can see price came down below, broke below it, and after that point right here, we've shifted the structure to bearish. Again right here you can see the same framework. When a bullish trend and then right here this low breaks above these highs and also test a key level after this low. So this is a significant low for us, which we'll look for to be broken to anticipate a structural shift towards the bearish side or downside, right? And after this exact particular low is broken, it will result in a downtrend, right? This is how we identify or classify a correct structural shift. Now moving on, here we'll discuss how we're going to confirm a bullish structural shift, right? Again, will you be using the same logical framework but in the opposite direction? The whole core concept remains the same, right? When a high that breaks a low and leads price to test a key level is broken, that structure changes and shifts to bullish. Let's look at it right here. So again, price is in a downtrend because it's breaking lows and rejecting highs. And then right here it tests a key level, and this key level is tested with this swing high, this swing or expansion right here. And this swing originates from this high, and this high not only led price to test a key level but also broke this low right here. So that means this high is a significant key level, and when this high is broken, a structural shift will occur and structure will be changed and it will shift to bullish. So let's look at some examples right here. So this is the first example we've got. Right here you can see that the drawn liquidity is higher, which is this range high right here. We started this bullish trend right from here when price tested this key level, and you can see we are moving higher in a fashion where price is repeatedly breaking above highs and is only able to reject below lows. This classifies this structure as an uptrend or bullish market structure. you can see this low is rejected right here, and immediately price expands above. You can see that all of these rejection below these lows are short-lived, and price isn't able to stay below them because the structure is bullish. This is how rejection below low looks. You can see that right here price even closed below it, but it doesn't mean it broke it, right? It broke below this low, because breaking low is when price displays lower and expands with a big bulky candle. And not only that, it also continues going lower and isn't short-lived. But in this case right here, you can see that even though price closed below it, it immediately went above and expanded higher, and that closing below that low was short-lived, and price did not stay there for a while. This is what we call a rejection below a low. Rejection below low can also look like this, where price just wick below lows instead of closing below them, right? Whereas if you look at the highs, you can see that price is clearly breaking above highs by not only closing above them but also staying there for quite some time, which suggests breaking instead of rejection. And rejection below lows or above highs, the price can close, but it then reverses immediately. But in case of breaking, it not only closes but also at the same time it stays there for a while, which suggests breaking of highs or lows, right? This is how you classify rejecting and breaking of highs and lows. This isn't subjected to just closing of candles, but also how much time does price stay there for, right? You have to comparatively weigh in both, and you're going to see that if the structure is bullish, then when price closes below lows, it only stays there for a while, for short term, for short amount of time, and then it expands and reverses immediately. Whereas in terms of when it comes to highs, it closes above those highs, and not only that, but it also displays above those highs and stay there for a while, which suggests that the high have been broken instead of rejected, right? Moving on, right here you can see that as soon as price took out this low, it started this bullish trend towards the higher time frame drawn liquidity, which is high. You can see that price is clearly rejecting lows and breaking above highs, which suggests an uptrend and a bullish momentum. A strong uptrend is where price is not only consistently breaking highs but also rejecting lows, just as shown right here. Right here you can see an example of a downtrend or a bearish advanced market structure. Price is consistently rejecting highs and breaking below lows, which suggests a bearish momentum, and price is maintaining that bearish structure until and unless a higher time frame drawn liquidity is reached. In that case, the structure would be shifted, right? Here is an example of a bullish structure shift and how you can correctly identify it, right? You can see right here that this high or this short-term high led to price taking out this low or short-term low, and not only that, but with that, but with this swing, price also tested a higher time frame key level. So you can see that this short-term high right here is a significant high or short-term high, and we would look for it to be broken, which will confirm that now a bullish structure shift has occurred and a bullish structure has started and the trend has shifted to an uptrend, right? Another thing you can also see right here is that this low right here is an intermediate term low. This can also be classified as a long-term low because it tested a higher time frame key level, but you can just classify it as a intermediate term low. And the reason for it being an intermediate term low is because it has two short-term lows to its opposite side, one to its left and one to its right. And then this intermediate low is protected, which means the only reason price is going to start the uptrend and the uptrend is going to stay intact and it is going to continue if this low is protected and price doesn't break or reject below it. And you can see it stays protected and price starts its journey higher towards the drawn liquidity in a fashion where it's rejecting below only short-term lows and the intermediate term lows are protected and it's breaking above highs, right? Here is an example of a bearish structural shift. This exact low or short-term low led price to taking out this high, and not only that, but this also, this low also originated this swing, which tested a higher time frame key level, right? So based on these two criteria, this is a significant low. And if price breaks below this low, the structure would be changed to bearish. Once price breaks below it, the structure shifts to bearish, right? Because this law follows two criteria. First of all, it broke above a high, and second of all, it originated a swing which led price to testing a higher time frame key level. So this means that this low is significant, and if price breaks below this low, the structure would be changed to bearish. Here is another example of a bullish structural shift, right? This high broke this low and tested a key level. So you can see this high follows the two criteria for a well structural shift. First of all, it broke below this low, but not only that, it also tested a key level. So that means this high is significant. And when price close above this high, the structure will be changed to bullish and we will start an uptrend. And you can see right here that price closed above here, the structure changed, and then price continued that uptrend by rejecting lows and breaking above highs. You can see it right here. You can also see that this you can also see the intermediate term low and the short term lows right here. It's a homework for you to tell me why is this low an intermediate term low and what classify it as an intermediate term low, right? This is a homework for you and you have to tell me that. Let's move on to the next slide and let's discuss some important points regarding advanced market structure. First of all, again, as I said before, it's used as a conference. I've said that multiple times and I'm going to say it again. Because I don't want you to use it alone, but instead you should use it in conjunction with the other concepts, right? It must never be used as the main basis, which means you should never start analyzing price right away with this, right? But instead you should only use it later once you've already established and built a narrative and you want to gain conviction in that narrative or that framework or that trade idea, right? It's used to gain a refined perspective into the structural aspect of the charts and prices, right? Last but not least, you're only going to use the advanced market structure in methods that I've shown you throughout the chapter instead of the basic ones because those ones don't work. The only ones that work and that work accurately is the advanced market structure that I've shared with you throughout the chapter. Last point about market structure is that you should only be using it for your higher time frame. Now it's up to you what is your higher time frame based on your time frame selection and time frame alignment. But you need to remember only higher time frame, right? As I'm an intraday trader, that's why I only use it for the 4-hour time frame. Similarly, if you are a swing trader, then you should only use it on the daily or the weekly time frame, depending upon your time frame alignment and time frame selection, right? You should never use it for your lower time frames or intermediate time frames, but only for your higher time frames, because then that create confusion and noise and create just useless or worthless distraction for you, right? So only use it for your higher time frame.
Hello everyone, welcome to Trade Breakdown on EU. We're gonna start off with a daily chart to do two things here. First of all, to determine our drawn liquidity, our higher time frame drawn liquidity, and then to determine our daily buys for the day, right? These are the two things that we're gonna do on the daily time frame, and we're gonna make sure that we do it accurately and precisely with the things that we already know, right? Now, once we've accurately determined those two things, we're going to move down to the 4-hour time frame, and then there we're going to find a CRT, a hyperability CRT, to position ourselves towards the higher time frame drawn liquidity and potentially trade it, right? That's going to be our objective as a trader, as intraday traders. So first of all, right here, you can see that we had this bullish dealing range, right? I've been talking about this daily range since past few breakdowns, right? Now we know that our drawn liquidity is higher, which is this range highlight here, right? So you can see I've determined this high to be the long-term drawn liquidity based on range dynamics and based on advanced market structure, right? This weekend chapter is going to be all about
range trading and its dynamics, and turtle soup and how you're going to be using all of them in conjunction with each other to trade the charts accurately and determine higher time frame drawn liquidity and biases, right? So right here you can see that we've got this bullish dealing range, and here you can see that we've got this discount key level in the form of this fair value gap, right? Now we know that this is a bullish dealing range, and before price could move higher toward the higher time frame long-term drawing liquidity, first of all, it will retrace to a discount key level to rebalance this whole range, and then it will test a discount key level and then expand higher from there. And that is exactly what happened here. You can see that we've got this discount FVG, price retraced back to this FVG, this fair value gap, and then it reacted from there explosively towards the higher time frame drawn liquidity. Now what happened on Friday is that we had this explosive expanding candle, right? And you can see that the drawn liquidity is still higher and the objective hasn't been met, uh, right? So based on that, we're going to expect Monday to continue expanding higher to do what? To reach that drawn liquidity and test the key level. But obviously, first I had to merge it with a 4-hour CRT trade, right? CRT there, and then actually trade it on the lower time frame, right? So now you can see on the daily time frame, I've determined my drawn liquidity, which is that range here there, and my bias for the day, which is also bullish, which is towards the upside or higher. So we've done our two things on the daily time frame. Now I'm gonna go down to the 4-hour time frame and look for a CRT purge there at a key time and trade that on the 15-minute time frame based on time frame alignment, right? We can also combine intraday profiles there and intraday buy sessions there as well, right? So let's go down to the 4-hour time frame and let's see what we got there. Right here you can see that we had this expansion right here, right? And then today we had this price action on the 4-hour. Now as we determined on the daily that our drawn liquidity is higher, right? And it hasn't yet been met. So what we're gonna do, we're gonna wait for a purge here on either of these 4-hour candles and then trade it on the lower time frames, right? Now the premise of CRT is that every single candle can be treated as a range, right? You can take any candle as a CRT, but then there are high probability CRT and low probability CRT, and then there are different protocols uh, for how you can choose a correct CRT, a high probability CRT that will work, right? And that also depends upon the framework that you are working with, and depends upon the higher time frame drawn liquidity and what price has done in the past few days or few weeks, right? That also depends upon those factors, but also whether there's a key level below the CRT or above the CRT, or whether at which time the purge has occurred, right? Or if there's an inside bar to these CRTs, inside these CRTs, and then it also depends upon the intraday profiles, like what sort of intraday profile do we have on the intraday 15-minute charts, right? So we're gonna combine and integrate all of these factors together, and then based on that, we're gonna decide whether we will trade this CRT or not, right? But the premise is that on the higher time frame, you can trade any single candle, right? You can take any single candle and you can treat it as a CRT and trade it on the lower time frame. But obviously, not all of them will work, because first of all, you have filters, you have certain factors which you'll use to filter out or weed out the lower probability CRTs, and then at the end you'll only end up with the ones that will work accurately and precisely, right? So that's how you're gonna go about these CRTs. So right here you can see that what happened is that price took out the low of this candle, and not only that, it also took out this low candle as well, and it purged it during the London Open zone, which is from 2 a.m. to 5 a.m., right? So now I'm gonna take this candle and I'm gonna regard it as a CRT, because price purged at a key time, right? And we've combined it with an intraday profile, which is the intraday normal protraction profile, right? And you can also see that we've almost reached the drawn liquidity, the opposing end of the range, right? So that means we are in the last phase of the sequence, right? The T skew, which is the kiss of death sequence, right? And which is basically the last phase, the last counter liquidity purge before the return liquidity is reached. So based on three factors, because we are in the last phase of the sequence, right? We can match it with an intraday normal protraction profile, and then uh, it also has that time factor to it. We purged it during the London Open zone, which is a key time for manipulation profile to occur, or a key time for intraday normal protraction profile to occur, right? So based on these factors combined, I'm going to take this candle as a CRT and I'm going to trade it on the lower time frame, right? So right here you can see that as soon as this low was purged, I went down to the 15-minute time frame and looked for an entry there, right? So now let's go down to the 4-hour time frame and let's see what we've got there. So on the 15-minute right here, first of all, I'm gonna plot out the opening and closing times, right? So we can see that where we are inside the daily range, right? So right here you can see that as soon as the candle opened, the daily candle opened, we straight away went into a ranging profile, right? During the CBDR and the Asian session, we found this ranging profile. And then after that, we went into this manipulation profile right here, right? And during this manipulation profile, first of all, we took out the range high and then we manipulated below these lows and had a purge there. And all of this was a manipulation profile, right? Now, if you look at the timing of this purge right here below this low, then you'd see that this purge happened at a key time, which is during the London kill zone at 2 a.m. Eastern time, right? Which makes it a high probability purge, right? And combining it with all the other high time frame thought process that we've done just before, when we combine it with all of that, then this purge during this particular time becomes even more high probability because everything is coming together, right? That's how you're gonna know when you're finding or generating or trying to look for a trade idea and you're trying to see what the market is telling you, and you do all of your higher time frame analysis and you do it in this top down approach where you are refining and bringing down all of the higher time frame thought process down to the lower time frames, then you'd see that it follows a logical framework. And as you keep integrating these concepts and trying to look at it with a refined perspective, you'd see that everything is trying to make sense, right? You would see that everything is in sync with each other, everything is aligned with each other, and there's nothing that what do you say? And there's nothing that actually takes it off, right? So you're gonna see that once you do all of these things, the trade idea that you've generated or that you formed based on these concepts that I've explained to you in CPI, you would see that it actually makes a lot of sense. That's why it makes it a high probability trade area. And then you're going to trade it based on your entry model or your entry setup, whatever that is, right? So, along with all of that, right here you can see that we are also in an intraday normal protraction profile because we purged below these lows and we had a manipulation profile, right? So Asian session in the CBDR was a ranging profile. Then during London Open, we had a manipulation profile, right? So now you can see that based on this framework, we are in an intraday normal protraction profile, right? So the next thing that we're going to anticipate here and the only possible outcome for price after all of this has happened is an expansion higher. So we purge below CR2 at a key time, ground liquidity is higher, we have a normal protection profile, right? So we have all of these factors which are pointing towards the bullish side, right? And that means we can expand higher. But obviously I couldn't just take an entry right away here, right? What I did is I waited for my entry setup to form in the form of a model 1 entry, and then as soon as we had this CSD and we formed this order block right here on the 15-minute, I took my entry there with a market order, right, as soon as price tested it, and then my stop loss was below this low right here, and I targeted the opposing end of the CRT or the higher time frame ground liquidity, right? This was the trade breakdown on EU.
Welcome to Trade Breakdown and EU. So I'm gonna start off with the daily time frame and we're gonna discuss what we've got here. So in the last few breakdowns, I kept mentioning this range high is our long-term drawn liquidity or our long-term target, right? Now you can see right here, it has now been reached. Now we have to determine what happens next after the drawn liquidity has now been reached, right? And to do that, we'll first have to use market profiles to determine what happens after we have an expansion, and with that expansion we test a key level, right? We have to answer that question first, and obviously we know the answer to that, right? After price expands and that expansion profile ends, it often leads to a retracement or a reversal profile. Now in order to expect a reversal, our long-term drawn liquidity has to be lower, and in this case it isn't, so we're only going to expect a retracement profile, right? A retracement profile before we make another expansion higher. Now the question that arises is that where could we expect this retracement to go, or simply how far this retracement is going to be, right? And we know the answer to that as well. What we're going to do is we'll take this whole swing as a dealing range. You could just take it as an expansion swing as well and divide it into two halves, but because it has taken out both range high and range low, right? So it has taken out both range high and range low, so for that reason it's also a dealing range for us, right? So right here, when we take this swing as a dealing range and we divide that into two halves, we see that this Monday's candle low, right? This low perfectly aligns with the 50% of the equilibrium of this dealing range. And below that, we know that this is the discount region, right? Below equilibrium, we've got the discount. And we've got an FVG there as well, which can potentially be our discount key level for this dealing range. So the framework is that the Monday's candle took the range high and then it formed this new dealing range. And now for the rest of the week, we're going to expect price to retrace back to this Monday's candle low or this FVG, which is our discount key level. And once that is tested, then we can expect an expansion from there, right? So last week I expected price since Tuesday to take out this Monday's candle low, and that's exactly what happened here. Now right here you can also see that the Monday's candle also tested a key level in the form of this range high, right? So keeping that in mind, we'll also expect a Monday half the week profile, weekly profile, right? And I'm going to expect, and we're going to expect the rest of the week to continue to retrace lower to the discount region of this bullish dealing range, right? That is our higher time frame thought process, right? So since Tuesday, I determined my drawn liquidity to be this Monday's candle low and this discount FEG, and my bias was bearish, right? And I determined that based on multiple factors. I determined it based on market profiles, based on dealing ranges and key levels, and not only that, but including weekly profiles too. So all of these factors led me to determining my drawn liquidity for the week, which was the Monday's candle low or the equilibrium of this dealing range. So now again, we've done the two main things on the higher time frame daily chart, right? And now we're going to move on to the 4-hour time frame to find a CRT there. You can see that in all of these trade breakdowns, I'm using a logical process with a logical objective framework, right? And that framework has specific factors and protocols, right? Which tells me and based on which I decide whether we're going to expect higher prices or lower prices, right? It's as simple as that, right? And that's exactly what you should have for as well. But what you should do is keep your charts clean and just use this logic to understand what price is telling you and not what you want price to do, right? You don't have to force anything. So let's go over to the 4-hour time frame to find a CRT there for a lower time frame entry. So right here on the 4-hour, we can see this dealing range, right? and here's the discount region of this daily range. Now we already determined that our drawn liquidity is this Monday's low on the daily chart, right? Now our objective is to find a CRT on the 4-hour, and then we're gonna position ourselves in that CRT and then trade it on the lower time frame based on time frame alignment. Right here you can see that during Tuesday and Wednesday's price action, we had this move lower. I couldn't find any CRT or any entry on Tuesday and Wednesday, so I stayed away and just kept waiting for a CRT and a high probability CRT to form so that I could trade it. You can see I waited 2 whole days for an entry to form and I did not force anything. That's what trading is all about. It's mostly about being patient and waiting for your entry setup or your model to form at the right time, at the right place, right? Sticking to your plan at all times is what you should aim as a trader. And if you're not going to stick to your plan and routine, it's going to mess up with your performance, right? If you force anything on the charts or if you force anything on the markets, it's never going to work, right? And if you always have that feeling of missing out or FOMO, that will mess up with your performance and your performance would not be optimal, right? So right here, what you can see that even if we had reached the drawn liquidity, right, and I missed out on taking trades there, I still would have been content with it because I know that I can just trade another week, right? That's not a problem for me. So make sure to keep following your plan and staying disciplined at all times, no matter what, right? Now right here you can see the way how I found a CRT here on Thursday is first I waited till London Open to see what the Asian session does, right? And what sort of price action are we gonna have. And right here you can see that we've got this FEG right here, this 4-hour FEG. And if we divide this FEG into 2, we can see that right here we've got the midpoint of this FEG, or what we call, or ICT traders call, the consequent enroachment of this FEG, right? You can call it whatever you want. The idea is that it's the premium of this FEG, the upper half, whereas the lower half is the discount region. Right? That's the idea. You can call it whatever name you want. The upper half, lower half, premium, discount, it doesn't matter. Now you can see that we've already tested the lower half of this FEG during Tuesday's Wednesday's price action, right? And now during Thursday, what happened is we tested the upper premium half of this FEG and then we expanded from there. Now what happened during Thursday is that during the Asian session in CBDI, we did not test any higher time frame key level and we just formed a range, right? We formed these 2 4-hour candles right here, right? And now as soon as the London Open kill zone started, I took this candle as a CRT because first of all above it is a key level in the form of the premium region of this FEG, and also with that we purged this CRT at a key time, which is the London Open kill zone. And not only that, but also this CRT was formed at this range high, which usually tends to be a good place for CRT to be formed, right? And such CRT always has high probability. That's why I took this as a CRT and decided to trade it on the lower time frame once it was purged, right? Now our analysis on the 4-hour is done as well. We found a CRT, right? And now we're gonna move over to the lower time frame to trade this CRT with an entry setup or a model. So first of all, we started with the daily, right, to determine our drawn liquidity and daily buys, and then from daily I went down to the 4-hour time frame to find a CRT there, and now our objective is to go down to the lower time frame to find an entry setup. So let's go over to the 15-minute time frame and let's see what we've got there. First of all, we're going to put on the opening and closing times, right? Now, right here you can see that during Asian session, we did not tested any higher time frame key level, and we just ranged, right? And we generated liquidity and formed a higher time frame CRT on the 4-hour, right? We did not do anything significant other than that, right? Then during London Open kill zone, which is from 2 a.m. to 5 a.m. Eastern time, we purged that CRT And after that, I started looking for my entry in the form of model 1 entry. But there's a but, right? Remember, my entry was a bit refined in terms of times and key levels, right? Let me show you how. If you had taken a model 1 entry here, then you would have first lost a trade here, and then the second one you would have won it, and then you would have been still in profits after that. But you would have lost the first trade based on model 1 entry, right? Because we had this CSD right here after the CRT was purged, and then it went above to take the stopper, so you would have lost that trade. But I didn't took that trade because I had a more refined entry in terms of time and key levels, right? And also I waited for a lower time frame key level to be tested, right? That's another important thing you could add to your entry criteria as well. We already know that we must have a higher time frame key level on the 4 hour to consider a CRT as valid, right? Which we had in the form of the 4 hour FEG and the premium region of that FEG, right? We already had that. But also along with that, you could also add another criteria, an optional criteria, which is a lower time frame key level too, right? And right here, what I did is I looked to the left for a key level, and right here you can see that we've got this expansion swing, and we've got this breaker right here, and which originated from this expansion swing. Now, if you watch the last chapters diligently, then you'd know why this is a breaker block, because this is the load that purged the high, and then it got broken below, so this load became a breaker block. What I did is I also waited for this 15-minute breaker to be tested as well. Now remember, this is not a must, right? It's just an optional criteria to rather refine your entries. It's not a must, remember that. And also, if it's too overwhelming for you, then you can just avoid it, right? You can avoid it. But here is what led me to refine my entry. I just wanted to show you, if some of you, if it's not too overwhelming for you, then you could add it to your entry criteria. But remember, it's gonna have its pros and cons, right? Now, what happened is what happened here is that I knew that first of all we tested a higher time frame key level, right, already. But if I want to define it even more, it could potentially test this 15-minute key level as well in the form of this breaker. Now remember, I could have missed out on this opportunity if, let's say, the first trade had worked out, right? Then in that case I would have missed out on this opportunity. But the thing is, I would have been content with it, right? So take this with a pinch of salt, because everything has its pros and cons. For me personally, I'm satisfied with missing some trades and only catching the high probability trades. That's why I've added this criteria as well. Now again, let me say it again, if it's too overwhelming and it could cause a bit of chaos for you in your trading, then you can avoid it, because it's not a must, it's just an optional, right? So once the key level was tested, I waited for a model 1 entry, and then I took an entry here with my stop loss above, and I targeted the opposing end of the range and 50% of the range, right? I actually closed my entry quite below, because I let this trade play out till the higher time frame drawn liquidity was reached, right? We're gonna learn about that in later chapters as well. Hello everyone, welcome to this higher time frame case study session on NQ and Bitcoin. So in this video I will be giving you an overview of what's happening on these pairs and what has actually happened on these pairs over the last few weeks, and how you could have approached out of that price action with a logical framework and with a refined perspective. Right? So basically this video will give you some insights to how you could analyze the higher time frames of these pairs and charts, and how you could replicate this exact thought process on any other assets or time frames. Now, the overall core concept remains the same, and in this video you will see what each time frame is used for, and how you could use the higher time frames to first of all generate a narrative, a higher time frame narrative, and to determine your higher time frame drawn liquidity, both short term drawn liquidity as well as long term drawn liquidity, right? Now, if I talk about myself, then I only trade the euro dollar or EU for trading, and I only trade that pair. But there are some students who have been requesting to me to make breakdowns on these pair, so I've decided to share this video with you here, right? Now, I also do analyze the higher time frames of these pairs and assets from time to time, just to be aware of what's happening on all of these major financial markets. But when it actually comes to trading, I strictly trade only the euro dollar, right? Now, if you watched all the trade breakdowns on EU, then you'd see that I use that exact same framework and thought process here, right? Even on these assets and charts, which indicates that these concepts are fractal and they work on all assets and time frames, right? Now there are some differences on the intraday charts in terms of time, but the higher time frames overall for all of these assets follows the same process and framework, right? So let's get into the breakdown or case study. So first we're gonna start off with NQ, and we're gonna start right from the monthly chart, right? The monthly chart is usually where I start my analysis at the start of each month or each week, right? There isn't a lot to do here, but it does offer me a wide perspective about what price is doing, where it is at the moment, and what is it trying to do, and what is trying to tell us, right? Also look for key levels on the monthly chart and look at it with a perspective based on market profiles and dealing ranges, uh, that tells me what price is trying to do, right, and where price could potentially be headed to. Now, I also look for key levels on the monthly chart that could also potentially be refined down to the weekly and the daily time frames, right? Also, before we move further, we know that this week will mark the end of level 2 of CPI, right? The first two levels, we mostly discuss the price aspects of charts, how price moves, what are key levels, how they're formed, and what are intraday and weekly profiles, right? We discussed almost every aspect of price. Now, next week we will start level 3 of CPI, right? And level 3 will particularly deal with the time aspect of charts. And we'll learn how time influence moves in the markets and how can you catch timely expansions or reversals in the markets and how you could use time to assist you in your analysis and trading, right? So the point is that each level of CPI will focus on a particular thing and they are already pre-planned, right? And I've organized it in the most refined and proper way possible. Similarly, moving to the next levels, we'll learn about integration of time in price, and then I'll show you different entry models that you can use to trade CRT and turtle. So we'll discuss CRT to its core details and intricacies and CPI, right? Along with that, I'll also give you a framework for how you're going to be objectively doing your higher time frame analysis and thought process. In the same manner, I'll give you a framework for lower time frame thought process, and then we'll learn about how to combine and integrate both of them together, and so on, right? Similarly, at the end of level 7 of CPI, we will deal with the execution and the psychological part of trading, and we will learn about different risk management plans, different trade management plans, and how to actually journal properly, right? And how to backtest and how to execute properly. We will discuss all of these aspects in detail in later levels of CPI. And then last but not least, my trading plan and routine, and there will also be a few one-on-one session with some of the students, right? And then that will mark the end of CPI, and I can assure you that almost all of you will be independent traders at the end, and I mean it, right? Now, enough of that. Let's get in the case study and let's see what we've got on the monthly time frame. So on the monthly chart, what you need to remember and write down is that you don't have to look all the way back, right? You don't need that. You just have to analyze the current price action of the last 8 to 10 candles and just look at what the latest price action is telling you. and then you have to potentially determine where the current monthly candle or the next monthly candle could potentially close, or where it could be headed to, right? You have to look at the open and the close of the monthly candles, and also consider significant swing points where price could expand to or reverse from, right? You will also look for candles as CRTs, and then those CRT will guide you towards the correct drawn liquidity and potential areas where price can face invalidation or opposing liquidity. You would be looking at the monthly charts with multiple concepts such as quarterly shifts, EBITDA ranges, dealing ranges, the open high low close concepts, the power of three, and so on. We will discuss all of these in level 3 and level 4, right? Now you will determine your drawn liquidity based on these factors, right? So right here you can see that since the start of the year we've been making new all-time highs, and we kept moving higher to make new highs. Now obviously we know that according to market profiles, price usually tend to have retracements and the ranges before price make new expansions or new higher highs or lower lows, right? Similarly, right here you can see that the June's monthly candle had this expanding candle, right? And price closed above to make a new all-time high. Now to figure out where this candle can be taken as a CRT and can be treated as a CRT, you're going to look at multiple factors. You're going to look at the price action of the next monthly candle, and not only that, but you'll also have to see how it's purged and at what time it's purged, and along with that you'll also have to look at the lower time frame price action to say to see whether there is a lower time frame confirmation making this CRT a valid one, right? And whether are we seeing signs of reversals on the lower time frame. And once all of those things align with each other, you will take this monthly candle as a CRT, and your target and your drawn liquidity will be the monthly candle's low, and first of all the 50% of this monthly candle, right? And then eventually the opposing end of the range, which will be the CRT low or the monthly candle's low. Now, to consider a monthly candle or a weekly candle as a CRT, there must be all of those factors behind it to actually make it valid. The open high low close of the next candle, the timing of the purge, the framework of that purge, and how is it purged on the lower time frame or the time frames below it, right? And what sort of market profile we are in, and what is the dealing range telling us, right? All of those factors will lead you to being confident in your higher time frame analysis and thought process, and will lead you to gain conviction in what you see and what the market is telling you. So right here, this monthly candle had all of those factors behind it, right? That's why I took this candle as a valid CRT, and I determined that the drawn liquidity is now the 50% of the CRT and eventually the low of the CRT. Now let's go down to the weekly time frame and let's see how you could have analyzed these charts on the lower time frames, right? Now, right here again, if you look at all of this price action in terms of market profiles, then you'd see that we started off with a range, and then after that range we had an expansion, and then we know that after each expansion we can either have a range or a retracement before moving higher. You can see we have a retracement here, and then after that retracement ends we've got another expansion higher right here, right? Now obviously after this huge expansion we cannot have an expansion right away. We must either have a ranging profile or a retracement profile or a reversal, right? And in this case we had this kind of reversal on the lower time frame or this retracement on the higher time frame. Now you would have expected this reversal on the lower time frame, and you would have traded all the way till this CRT low is taken out and the drawn liquidity is reached, and you would have had multiple weeks of price action where your drawn liquidity would have been on point, and it would have been correct, and you could have easily profited off of it, right? Now another thing you can see right here is that this monthly candle CRT, right? If you look at it and if you look closely here, then you'd see that it was purged with this big bulky candle. The monthly candle height was taken out with this weekly candle, and now that weekly candle in itself could be treated as a CRT because that candle purge a higher time frame CRT, and it's a big one, right? It's an expanding candle, and more often than not, such types of candles eventually ends up being CRT. What happened is that we also purge this weekly CRT, and after that, you know that you now have enough confirmations to first of all target the low of the weekly CRT and eventually the monthly CRT low, because all of the factors are pointing towards and turning towards that particular direction, towards the lower one, right? Another thing right here you can see is that after we reach the drawn liquidity for this weekly CRT, we also closed below it, right? And based on key levels, you can see that this particular candle, this particular CRT purged liquidity in the form of purging the monthly CRT or this range high on the weekly, and now price closed below it, below this candle. So you're gonna use this candle as a CRT. Now you're gonna use this CRT and this candle as an order block, right, for NQ to push price even lower towards the monthly CRT, because this particular candle to purge liquidity and then price closed below it, so it becomes a valid order block. First of all, we had the CRT, then price closed below it to form this key level in the form of this order block, and then price tested that order block in key level and push lower towards the higher time frame down liquidity, which is the monthly CRT low. One important thing about CRT that you need to write down is the highest probability CRT are always formed above range highs and below range lows. Now make sure to backtest this exact thought, and you'd be amazed to see how accurate and precise this is, right? Let me say it again. The highest probability CRT are formed at range highs and range lows, and they usually tends to purge liquidity or fill liquidity, right? Now you can see that right here throughout all of these weeks, your drawn liquidity would have been lower, and you would have had 5 weeks of price action where you would have had correct drawn liquidity, and just imagine how much you could have profited off of it, right? Now there are different ways to exploit all of this, and we will learn that in CPI. Now let's move over to the daily time frame and let's see what else we got there. Now right here the price action is pretty clear, right? After the purge of the monthly CRT, we have the sequence where first of all we got the order block entry, then the breaker entry right here, an OTE, and then last but not least we've got the kiss of death or the KOD entry here, because price almost took off liquidity, but then it had this counter turtle support, this counter liquidity was taken, it was purged, and then we expanded lower again and had this case of death or KOD sequence, and then eventually we took out the monthly CRT low, and we reached the drawn liquidity. Here on the daily time frame, you would use the same concepts and the same logical framework to predict the direction of each daily candle, right? And you would use market profiles, dealing ranges, after data ranges, key levels, and so on to assist you with that, right? Okay, so right here we've got the Bitcoin monthly chart. Now again we're gonna be using the same logical frameworks here, the same one we used for NQ and Euro dollar, right? And we'll see what the market is telling us and what is it trying to do. We're not gonna force anything on the markets, right? We're just gonna use what the market have told us, and we're gonna make decisions based on that, right? So we're gonna start off by looking at it with first market profiles in dealing ranges, and then we're gonna see what sort of story are they telling us based on these concepts. So at here you can see that we've had this huge expansion above, and with it we made another all-time high on Bitcoin. It's pretty self-evident, right? Now obviously again before we make another significant move, we got to first either form a range or retrace back to the equilibrium of our dealing range before we could move higher, right? Now, a retracement profile or a ranging profile is highly likely after an expansion. So after this new high is made, we'd be expecting price to either form a range or a retracement before it will move higher.
Now we cannot decide if it's going to be a range or a retracement at first, but then as price keeps printing a new price action forms that will guide us and tell us what could potentially happen. Now, also along with that, we can see that we've got this expansion swing as a dealing range as well. And right here, we've got the equilibrium of this dealing range. So if we are expecting a retracement, then this 50% or this equilibrium region of this dealing range is a high probability area for price to retrace to, right? And right here, you can see that that's exactly price went for and reached to, right? It's almost as precise and accurate as it gets, right? You can see price exactly hit that point and then it retraced from there. Right here, first of all, I took this candle as a CRT because right here, first of all, I took this candle as a CRT because it formed this FEG and I thought maybe price can take that candle's high and then retrace. And for this whole month, I had a correct on liquidity, but then price struggled to take that high and it started reacting to this rejection block. So I changed my mind and adjusted to the new conditions and expected a retracement profile, and that's exactly what happened. Now remember, there are going to be times where price doesn't respect these concepts and just does whatever the hell it wants, and it's inevitable. You cannot avoid that. But what you can do is embrace those things, and instead of letting them mess up with your head and ruin your performance, you should accept them and just embrace them instead of aiming for perfection, right? The best traders I have known, the best traders I've seen have losses. Every single profitable trader has losses. But what makes them unique is the fact that they don't let losses mess up with their head and just accept them, because they know and I know that I can never have an edge that offers me 100% accuracy or precision. There will always be some margin of error, and that's unavoidable and that's inevitable. But over a long period of time and over a long track record of data, you will always end up being profitable because the edge will always be in your favor, right? That's something you must accept in order to succeed.